Everyone, and sincere apologies for the delay. There was some inconvenience because of which the program got delayed. Welcome to the fifth module of the session, which is revisiting the Income Tax Act. So we have Professor Sri Lakshmi Valli from Chennai for this session. I request Madam to come over and I read the
Thank you very much.
Sri Lakshmi Valli is a graduate in banking management, chartered accountant, cost accountant, and a practicing advocate. She holds an advanced diploma in international taxation from Chartered Institute of Taxation, London, and a diploma in international taxation from the Institute of Chartered Accountants of India. Overall, she has about 18 years of experience, having worked with multinational and with public sector entities as a practicing advocate. She was co-opted member of the Committee of International Taxation of this SIRC, that's Southern India Regional Council, of ICI in 2014 and in 2017. She has also contributed for publication of book on transfer pricing. It's a pleasure to introduce Madam Sri Lakshmi Valli to all of you. Ma'am, thank you so much for being here. Over to you, ma'am.
Thank you, ma'am. Good evening, everyone. It's a pleasure to be in the Institute before you all members to share my thoughts on the Chapter 12. Actually, Chapter 12 is a rather vast one. That's why the heading itself was given to me, saying that, okay, leave the non-resident portions and also which will be required. Consider that so only important. The heading itself will say that important provisions under special rate of tax, Chapter 12. The special rates, hopefully they could be lesser. That is the expectation always. So what will we cover? The major one will be the tax, because this is on special taxes. So the taxes on companies, individuals and HUF, the long-term and the capital gains, and all the others we will touch upon. At least we will not miss out, we will try to cover all. First one, a short quiz, because this is most of numbers and the crunching part of it, how you go about. So I just thought that to just liven up a bit, have a short quiz, and there will be a pen as a gift. This is all MCQs. Nowadays, no one wants to write. After the Corona period, it is just ABCD, even be it NEET or anything like. They just want whichever you say. At least I have an option to check, but no negative marking. That is one advantage. So with that, we will go ahead. I think if it doesn't come, then I will ask the question, and then we can go about with it. Then I'll try not to fiddle much. I should not go for that. Did the answer come? Oh no, what is this? Why this sign is coming?
We didn't see the answer.
Even otherwise, at the end of the day, what is the purpose? We should be able to understand, go with something being carried from here. That is the understanding, even by seeing or not seeing, whatever it is, it's fine. So I'll just read the question. Allowance granted for encouraging academic research and training pursuits in educational and research institutions are dash under section 115 BAC 5 or BAC 115 BSc 1A. Are we entitled to exemption or not entitled to? This is allowance granted for encouraging academic research. The latest one, the old regime and the new regime. In the new regime 1.0 and the 2.0, which is the latest one. In that, are they allowing? Not allowing. Just a guess. Huh? Very positive person. Allowing. Another option? Who would like to go for no? No one wants to try that? No? No for? I want to give this. Entitled? Take both the stand so that one of them will get it. No, I heard from yourself. Yes? Entitled? No. Okay. It's actually not entitled. Please, put green. Second question. I think we should clap. Clapping is good for our own health. Encourage and also for our own health. The second question. If the assessee has filed Form 10 IEA for the assessment year 24-25 within the due date specified under section 139(1) and to opt for out from the new regime 115 BAC, but could not file the return of income within the due date specified under section 139(1), which one will suit? Whether he cannot file the return at all, can file the return under 139(1), cannot claim deduction. Yes, I heard it from one sir first. Who was it? Please volunteer. Madam came second, actually. Yes. From next time, ma'am. Maybe a bit tricky, but if at all you're vigilant, yes, can get it. From assessment year 24-25 in HUF, resident in India whose income is chargeable to tax under section 115 BAC 1A shall be entitled to rebate under section 87A to the extent of 100% of the amount, 0% or 7 lakhs.
0% of amount of
No. No rebate is allowed. Why? Why? MCQ, so should not go to the next question. We should stop with that. It's actually only individual, not HUF. That's a trick. They just, even when they extended it to individual HUF, AOPBO and all, rebate just stands with individual. Just to keep that in mind, I just thought I'd highlight this. Now, surcharge. Under BA, BAB?
15%. 10%.
10%. I think I should have waited a bit, sorry. Surcharge in case of short-term capital gains, etc. Surcharge. Not the tax. Surcharge when it is short-term capital gain, long-term capital gain, etc. Under 111A, 12A, etc. What would be the surcharge? 15%. That's the trick here, like, the tax, then the surcharge. It will keep varying. So to that extent, again, I thought that as a maximum rate of surcharge under the new regime. This should be easier.
37%.
25. Who was it, sir? That one benefit they gave because they wanted it to be less than 40% now overall tax rate. So that tweaking was done. Income neither derived nor incidental to manufacturing or production of an article or a thing, and in respect of which no specific rate of tax provided separately under this chapter, it will be taxed under section BAB itself as 30%, 20% with deduction, 22% with deduction, 22% without any deduction.
30%. 30%. 22% and no reduction.
22% and no deduction. So actually you can keep it. Keep it. Next one. In case of option under section BAB, the total income of the company will be computed without any deduction under any provisions of chapter 8 other than the provisions of 80J, JJ and ADM, or only 80 out of 3?
2. 80 GGA or section 80.
I think there was another person also for the benefits because you wrote. Who was the other one? Please volunteer. Oh, sir. They added the ATM. Okay, fine. Let it be so. Now, intimation to employer would or would not amount to exercising option in terms of 115 BAC.
Not. Would not.
Someone here, sir. First row. The last one. Whether written filed in new regime
No.
or old regime as opted by the assessee in ITR, I'll just wait sir, I'll just finish it off also. Or as opted by the assessee in ITR of assessment year 13, 23, 24, affect the decision or procedure for assessment year 24, 25.
If it is individual, no.
No, he has become clear, like he gives with the answers.
No, already answered, told me.
Already answered. Yes. He was first in the beginning itself. No. No, so one. That's all. Thank you for the participation. It was really nice. Thank you very much. Now, with this in perspective, I think if we go through the sections in detail, answering them will not be difficult at all because everything is picked up from there. The only thing is we get carried away by what is being given as a lot of tidbits, snippets, etc. come in. So we get attracted to that FAQs, etc. but miss out on the act per se. So which is important. I think for this reason only this module has been brought in where they wanted us to revisit income tax, go through the sections in detail so that everything gets into mind and answering them would be easier. So the first one will start with 115 BA, BAA and BAB. Start with BA. BA is actually, as of now, the rate is 25%, not required, and everyone will now move to BAA or the BAB only. But to give a prelude, I think this one would be helpful. So for that reason, I will just start off. There are only 4 subsections in this. What does it say? 115 BA says tax on income of certain manufacturing domestic companies. If we read the section headline of the 3 sections, that itself will give way. They have made it such that generally they say that if at all you have a doubt while going through the sections also, better read the section heading. What does it say? What was the intention? So that actually will come out in these 3 sections. Actually, 115 BA, thank you sir. 115 BA, it says starts with notwithstanding anything contained in the Act. So this one will take precedence. So immediately they say subject to other provisions of this chapter. So there are 2 things. They say notwithstanding and subject to together. So notwithstanding is with respect to the Act and subject to is with respect to this chapter. So basically it is all other things remaining, this will take precedence, but with respect to the rates subject to, because capital gains 111, 112, 12A, etc. have special rates. There are other sections also having special rates. Those special rates, always special will precede the general. So there, that will get precedence and this section will not take precedence. So for that reason, it is notwithstanding anything in the Act, but subject to the provisions of this chapter, other than those mentioned in 115 BA, BAB. And if you take all the 3, BA only will prevail, BAA and BAB will not prevail. So for that reason, again that exception within an exception. So all these 3 have been brought in this one single line. Now IT is, income tax is payable on the
entire Act, notwithstanding entire Act and the 2 sections. Other than the 2 sections, we have.
Yes. Only the, other than these 3 sections, the other sections of chapter 12 will apply. Yes. IT payable on the total income of a person being a domestic company for any previous year relevant to the assessment year 17-18. So it's an old one. So from that assessment year, at that time the rate was 30% and 29%. So 25% was a benefit being there. So at that time they offered the 25%. But they told there are certain conditions to be followed because it is manufacturing domestic company. So there are certain conditions related to manufacturing which has to be fulfilled. What was that? The condition says that there are only 2 of them. If the section, subsection may look a little bigger, but if we break it down, very simple. The first one says that the company has to set up and register before after 1st of March 2016. So after that, if you have started, the company is not engaged in any business other than the business of manufacture or production of any article thing, and research in relation to or distribution of such article or thing manufactured or produced by it. This will remain the same for BAB also. So this can be gone through. So again there will be a little bit of a modification only in 115 BAB. Otherwise they have kept the same thing. Now these are the two things they have to do. Certain things they should not do. That comes below. The total income of the company has been computed without any deduction under so many sections. I am giving you a benefit of a reduction in taxes. I'll give in one hand, take it in another. Whatever benefits were given earlier in other sections, those and all I will withdraw. Withdrawing that, I'll give you a benefit. So that again, always we have to do. We cannot, if a new provision comes, we cannot forget the old one. Always we have to remember the old one, even the new regime, old regime also, we cannot forget the old rates. Keep remembering the old one, add the new one, 1.02, everything gets added only, never gets deleted. But these are the deductions which cannot be claimed. And if you see, I have highlighted 3 of them, 32 AC, 35 AC and chapter 6A. A watch can be kept on these 3 sections, these 3 provisions. Why? Because it is here, it is not there in BA and BAB. So there they have allowed it. So we need not have to go specifically like, okay, these are all the sections which are not there. In minutely if we go through these 2, 32 AC and 35 AC is not there in BAA and BAB. So in that case we can take the deduction. However, in chapter 6A, if you see here they restrict themselves. Under any provisions of chapter 6A, under the heading C, deductions in respect of certain income. So chapter 6 alone is not allowed. All others are allowed. They got smarter in the next one. There they took off fully chapter 6. But here it is, chapter 6 is deductions alone. The next one is any loss carried forward could not be set off. So this again was a very great thing which a person has to leave to catch the 25% benefit. Whether I should, how much of losses do I have? Whether I have to leave that to get this. This was one dilemma which the companies would have gone through and would have done elaborate workings to get into this. These and all set off and losses are all related to the deductions under subsection 1, clause 1 above. Those are only related to that alone. Chapter the depreciation is under 32 is allowed, but 32(1) 2A is not allowed. So that is the additional depreciation for new plant and machinery. That alone is not allowed. This is just the list of deductions here. It may not be that specific, but this will be easier to refer rather than going through the section. This may be easier. For that reason, I just written it down. They add one more line here. They just don't say that the loss will not be, you cannot set it off. They say that it will be deemed to have been given effect. Why they should say this? And already they say now you cannot take it. In case tomorrow,
If option is
again I get back, can I claim it? They close the door fully. They say that it is deemed to have been allowed. If you get it, you cannot take that loss again once. So they are very specific here. The last one is how to take the option. Exercising it is you have to exercise by filing a form before the due date under section 139(1). And there is one thing they say that if at all the option has been exercised for any previous year, it cannot be subsequently withdrawn. So we ourselves cannot withdraw. Ask for withdrawal. This is one thing, again a difference, like at least in BAC they gave option, once you can come back. Here it is, they say that you cannot withdraw at all. But they say that if at all you want to go to BAA, that will be treated as withdrawn. That we allow. So this is the nut and pith and substance of 115 BA. We go to BAA. This would be relevant because if you see the heading, tax on income of certain domestic companies, there it was manufacturing. Here manufacturing has been removed. So all companies can come in. Why to have a restriction? All companies can come in. So this would be beneficial for all. Now here again, notwithstanding is there, subject to is there. Here they will say BA and BAB. This is from which year? Assessment year 2021. That was 17-18. Now this is from assessment year 2021. Here the rate they reduce it further to 22%. So this is certain amount of a benefit. Okay, another 3% reduction, an incentive for me to go for it. And here they say if the conditions contained in subsection 2 are satisfied, only then you can go. Else it will become invalid in that year, and subsequent assessment years, other provisions will apply automatically. Now if we see the deductions under subsection 2 plus 1, the similar list, the 32 AC, 35 AC will not be here. And chapter 6A alone it says, it doesn't say deductions. So that is the difference here. Then in this clause, additionally apart from set off of loss, they say even the depreciation relating to the earlier provisions, if at all is there, even that will also be not allowed. If at all an entity was amalgamated, there the earlier losses, that also relating to these sections, that also will not be allowed. Then the depreciation under section 32(1), subject to 32(1)(a), 1(2)(a) will be allowed. Here again they block saying that if at all any loss or depreciation, it will be deemed to be allowed. And any depreciation, so deemed to be allowed, so any depreciation which is pending there, they want to add it back to the WDV now itself and then close it. So this is one thing which needs to be now added back. Since there is a depreciation involved here, they want to add it back. This is just for the IFSC. Any unit in IFSC, they will get 80, chapter 6A deductions, 80, LA alone will be deemed to be allowed. So they can get the benefit. Unit IFSC will get now 22%.
After deductions? After these 2 deductions?
After deducting, then you can apply the rate. The 80 LA deductions will be allowed. After that, we will come for the computation and then the rate. Now here again the condition, now you have to again opt for it. And if at all, if the option exists, here in BA we found that if at all you want to go to BAA, we will consider it as deemed to be withdrawn. Here they say, if at all in BAB you are not able to follow some conditions, you have the right to come here. There is always some interconnectivity being provided. So here they say, in BAB you go, have some difficulty, then don't go back to the 30% or the 20%, you can come here. Because this is for all companies, if you are not a new manufacturing company, have some difficulty, you can always come back here. So that is being provided in 115 BAA.
But 115 BA only is beneficial, madam. Even for domestic manufacturing companies also?
That rate is 15%, sir.
15%?
15%. So rate wise, if you see, that would be beneficial.
This is 22%?
22%, because general, all companies, new manufacturing.
Okay.
BA, the first one.
Okay.
First one is 25.
25.
First one is 25. So manufacturing company, when it was in 2016, after 2016 means, then it is 25%.
Okay.
But new manufacturing company, after 20, if that comes here. As relevant assessment year is 2021. If you start in this period, then it is 15%.
BAB.
BA. So 25, 15, 25, 22, 15. They gradually reduced it. So if you see the heading here, 115 BAB, tax on income of new manufacturing domestic companies. First one was manufacturing, next one was certain companies, and here it is new manufacturing domestic companies. So with this itself, if we have in mind, we will be able to tell the rate 25, 22 and then 15, new manufacturing, so further reduction. The same notwithstanding subject to taxable income from assessment year 2021. And here it is 15, conditions are given in subsection 2. Here the condition, again the date has to change. What is the condition now? The company has been set up and registered on or after 1/10/19. There it was 16, here it is 19, and commenced manufacturing or production of an article or thing before 31st of March 24. This was extended, given a year extension only. So we had 4 to 5 years time to start a company and start the production. If it was done within this time, then you are eligible for 15%. Additionally, they say that new companies, generally the tendency will be there to split and form. So there they have put the restriction that if it is formed, it should not be formed by splitting or reconstruction of a business which is already in existence, except undertaking under section 33B. 33B actually relates to rehabilitation allowance. If at all due to some natural calamity a company had to close down and within 3 years they are trying to revive, They don't want to say that as the reconstruction part. So that is allowed, that is separate. Subject to 33B, a company should not do a splitting. In the second condition they say is a plant and machinery. Because it's a new manufacturing, then the importance is given to plant and machinery, that should be new. If at all you want to bring in something from outside, imported one, then they say that restricted to 20%, not more than 20% of the total plant and machinery, and it was not previously used in India, and no depreciation should have been allowed in this act. These are the three things that they specify. So, does not use plant and machinery previously used for any purpose which can be imported from outside India, but no depreciation should have been earlier claimed under this act by any of the other entities. In that case, then it is allowed. And that plant and machinery should not exceed more than 20% of the total plant and machinery which is being brought in. The third condition, additionally, they say that any building which was used as a hotel or a convention center and a deduction under 80 ID was being claimed, please do not bring it here. That also is exempted. So, subject to this, if it's a new manufacturing entity, you are putting in some new plant and machinery and producing some articles, you are eligible for 15%. Simple to say that, but there will be many difficulties around me. But the company is not engaged in any business other than the business of manufacture or production of any article or thing, research in relation to a distribution of such article and things. However, the exceptions are, these are not allowed. Development of computer software in any form of media, mining, conversion of marble blocks or similar items from slabs into slabs, bottling of gas into cylinder, printing of books or production of cinematograph film, or any other business as may be notified. So these things they have already excluded. However, electricity generation is included. The same thing, they say that these reductions are not allowed, except that 80JJAA, that is that the employment opportunity for all gives salary, so that is allowed. ATM, you receive some dividend and you also pay dividend. To that extent, there will be a deduction from the receipt of dividends. If at all you declare a dividend, ATM deduction is there, that deduction is allowed. Other than that, Chapter 6 will not be allowed. If it is an amalgamated entity, here if you see the laws related to the above section, that is not here. Earlier they told that any laws relating to the above sections, that will not be allowed. It goes waste and it cannot be carried forward also, but that is not here. What could be the reason? This is just to take a break from to take water. But understand, sorry sir?
New company set up.
Exactly. New company, so there will be no earlier loss, so that provision is not there. However, 72A is there because it could be because of some amalgamation still they are allowing, so that loss they have kept. Then depreciation 32 is allowed, 32(182) is not allowed, additional depreciation. 72A.
So, madam, once I opted, being a new company, I will opt this section. So 2 years I will make a profit, I will pay tax. Third year if I make a loss, then also it will not. Fourth year I setting off itself is not there.
No, this loss is those sections and all you cannot claim.
Clear.
So, in your compute your total business income PGBP at that time less this 35AC, AD, those things and all cannot be claimed.
Oh, so there is no concept of carry forwarding losses once you opt.
Yes, so it will not be there at all. So you would not have claimed, so that loss carry forward doesn't come into.
No.
This is just a provision that if at all any difficulty, board has the power to bring in some loss. And this one, they anticipate that how the splitting, though they say splitting could happen, companies may form a company from their own, so there would be certain transactions between them. So what to do? So considering that they have already brought in, they say that if the assessing officer, I'll just read that subsection itself, where it appears to the assessing officer that owing to the close connection between the person to which this section applies and any other person, or for any other reason, the AO feels so or for any other reason, the course of the business between them is so arranged that the business transacted between them produces to the person more than ordinary profits which might be expected to arise in such business, then the AO shall, in computing the profits and gains of such business for the purpose of this section, take the amount of profits as may be reasonably deemed to have been derived therefrom. If at all a company, holding company, wants to start a subsidiary company, push the profits there and claim 15%, and the AO feels that this transaction is only to transfer the profits, then the AO can identify which is the profit relating to this type of a transaction, and that transaction will be taxed separately. So earlier itself there is one GAR here, GAR sort has already been put, avoidance arrangement has been put. The second one is this has been added to the specified domestic transaction, like electricity is there, electricity generation, etc. So anything related to the group entities, that again is covered. This amount is the excess amount which the AO will deem to be the income. Though already the assessee also would have shown it as the income only, this will be deemed separately as the income and taxed separately. And to this extent, I will come back to one provision, one slide which I left at that time. This is part of the charging section itself. There it states it is a 15% taxation. Apart from that, income which is neither derived, this was one of the questions, income which is neither derived nor incidental to manufacturing or production of an article or thing, and in respect of which no specific rate of tax provided separately under this chapter be taxed at 22%, and no deduction or allowance in respect of expenditure of allowance be allowed. So, if at all other than manufacturing income, any other income comes, that no deduction, straight away 22%. Expenses deemed to have been allowed and 22%. So, to the extent possible, this entity should have only manufacturing profits alone. All others keep another entity. When you form this, when this was formed for manufacturing, retain it only for that. All other income, let there be in another company. Otherwise, it will automatically have the higher rate, which is not worth it. And it is no deduction also. Without deduction, it is at 20%. So, gross 22 is very high. Income of the person deemed so under subsection 6 second proviso to be taxed at 30%. What we saw, which if AO finds there is a super profit there, that he will tax it at 30%, not even 22. So we have to be careful that that type of a transaction is not brought into. This is kept up to the extent possible clean. Then short-term capital gains derived from transfer of capital asset on which no depreciation is allowable. Again, that is 22%. So generally 15%, otherwise 22%. No deductions, otherwise 30. This is the with a slab within the slab. There are three taxes which are here. And provided further that if the conditions are not satisfied, option shall become invalid in respect of that assessment year, and subsequent and other provisions will apply. So otherwise you will not only get back to the owner.
Madam, now say for example I manufacture something like a fan or anything. So I mean I will give a installation service also. Then manufacturing fan comes under, whether that installation also will be different, ma'am? How? If I charge
By the exact words, this is as per the section I have taken it. It says the company is not engaged in any business other than business of manufacture or production of any article or thing, and research in relation to or distribution of such article. It doesn't look so that service may come into it.
service, so I have to sort of.
That's a valid question. You can have a further research. You can share your number. I will do some research and then get back to you.
Sure, madam. Thank you.
Interesting one. Thank you. 115 BAB 7. How you have to exercise this one? You have to start. It says you see the word which is highlighted first. For furnishing the first of the region of income, it says from the first. So can't I go in between? It looks so no. First return itself should go under, when I start off, I should be under this. Only then I can take this, because for that reason only the loss, prior losses also is not there. So be here from the beginning, be here or continue here. That is how is the intention seems to be. Now since the slides will be shared, I have prepared this to differentiate, so that at one stroke you can easily identify. It will be easier to go through rather than the sections and the subsections make it difficult. But I have tried not to miss any of the important words. All the keywords have been put in respective sections. So 25, 22 and 15, and the heading if you see, sir. 115 BA, tax on income of certain manufacturing domestic companies. So manufacturing is there. BAA says tax on income of certain domestic companies, manufacturing left out, and tax BAB, tax on income of new manufacturing domestic companies. So this is a given, 25, 22 and 15. Additionally, there are 22% and a 30% slab also available here in the BAB. And this second one is relating to the conditions. If we see in BA and BAB, there are conditions. Before, after 16, you have to be set up, or this one is after 19. No such condition in BAA. So that is a little comparatively better. That's why 22% tax. Then the deductions, the differentiation. 32AC, 35AC is there only in BA, and it says in chapter 6 here only the deductions. And only 80JJAA is there in 115BA. While there is a difference that in these two, there is additionally the 32AC and 35AC is not there, and chapter 6A, but they give 80M additionally. Here, no set off of loss. This one is no set off of loss and depreciation. And in BAB, nothing because it's the first year, so no earlier loss will be there. Depreciation is allowed, 32A is not allowed. This one thing, 32A2 deduction, additional depreciation is common for all the three sections. 72A amalgamation is there for the two of them. Loss will be deemed to be allowed, and if there is a depreciation, then WDV will be adjusted. Option, you have to exercise the option before 139. One, there are specific forms given, that form has to be utilized and opted for. There is the middle one alone has IFSC because financial service, so it cannot come under the manufacturing, so it will be only under the BAA. Difficulty, they can bring in rules. Close connection only under BAB because there they anticipate that there could be some split up. These are the rules and these are the forms that has to be filed before 139(1). And when I went through, apart from this, what else we can share? If you see the case law are all relating to condemnation only. No other thing has been discussed. The service part has not come till now. So here it is only the condemnation, if at all there has been a delay in filing of the form and not before 139(1). The condemnations, they themselves extended it. For assessment year 2021 and 21-22, they extended, saying that they gave additional 3 months time. And they said that if at all you have opted in the return of income, at least have you opted for yes, and then you have filed your filing at least now within the 3 months, then you are cool. And case laws are all in favor of the SSC. They say that it is not directory only, not mandatory, only directory. So that is allowed. MAT applicability, here they have waived for two sections alone, the last two. The first one, being the first one, has certain disadvantages, so no MAT provision. At that time, if they had MAT, they would have lost it. But here, now they say in this circular 29 of 19, they say that anyway for BAB it is not applicable. BAB will be the new entity, so that is gone. But BAA, they say that if at all you feel that you have MAT and carry forward losses, etc., first utilize them and then come and join. There is no hurry. BAB only there is a hurry that the first year itself you have to come. Here there is no hurry. If you have something, all the losses and all you satisfied, fully complete it, then you can come. But we will not give you the credit. Though credit, that was actually like advance tax. The money was paid. Effectively speaking, they should have given credit. It was with the intention that tomorrow I can take it back. With that intention, genuine intention, the SSC would have paid. But then they tried to give a carrot and the stick approach that whatever was paid may get lost. But to that extent, certain benefit in the 115 JAA or 115 BAA. These are the three case laws which may help with respect to the identifying whether it is a split up or not. Whether a similar kind of an activity, similar article itself is being produced, then how the courts had held it earlier. These are all old ones, but new ones yet to come evolve. But this may give some precedence, where they say that in order to hold a new entity, undertaking is not formed out of the already existing business. There must be a new emergence of a physically separate industrial unit which can exist on its own. It should not be dependent on any other entity.
The new activity, they say, may produce the same commodities of the old business, or it may produce some other distinct marketable products, even commodities which may feed the old business. These products may be consumed by the associate as old business or may be sold. This are, with a pinch of salt, old decisions. Nowadays, it is not seen from the same perspective. They may not be that liberal, so there may be the difference in the way the courts themselves may look at. Being a beneficial provision with 15% of tax, because that is half of the normal. So they may be strict. So to that extent, if anything had happened, this could be resorted to, but otherwise not for planning. So in all of them, they insist that they should be able to exist on their own. If that is satisfied, then it's okay. BAD, 115 BAD is on the similar lines of 115 BAD. This they give it for this certain resident cooperative societies. So it will come into the middle bucket. So any cooperative society wants to take the benefit, then they can go under this. Here, notwithstanding and subject to is there, they have except BAE. BAE is similar to BAB, New Manufacturing Cooperative Society. So for that they have excluded here. This starts from 21-22 and the tax rate shall be 22%. So the exactly similar to the 115 BAA, the middle law. A similar set of deductions which they cannot claim. Losses against relating to it cannot be claimed. 32 can be claimed, subject to 32 to 8. The loss deemed to have been allowed and WDV will be added for the depreciation part. IFSC allowed. Now, here it is. This is the option. Option you have to again under 139(1) you have to opt for it for furnishing the return of income, and if at all you do not. The last one is provided that once the option has been exercised, it cannot subsequently be withdrawn for the same or any other previous year. We ourselves cannot go and withdraw it. We have to go into it. Once gone, we are there. The heading, the next one, BAE. It says tax on income of certain new manufacturing cooperative societies. So it will have the similar thing. So I think if we read one section, almost all the 5 sections are similar to it. It will be easier. And we have to keep only differentiating between all of them. Here it will be from 24-25, the latest assessment year, 24-25. 15% new manufacturing, so 15% lower rate. And here again, the 22%, if at all any income is not related to manufacturing, no deduction, but 22%. If at all deemed income, that will be 30%, short-term capital gain 20%, 22%, all others are similar in nature. Here what they say, here there is one thing which I felt to be a little difficult. They gave the setting of date as 1/10/23 and commence manufacturing or production before 31st March 24, which is too short, especially for any entity, especially for a cooperative society. I don't know why the hurry, maybe ma'am may extend it shortly. That could be the thing, but otherwise this is a very short window that has been given. As if someone was always waiting and then immediately started off, which could not be the case, especially when it is a manufacturing involved. And the same split up plant and machinery is the same. Here that convention center, etc., that building 80 ID is not there. So these two are the main conditions. You should not split and form the manufacturing entity, and the plant and machinery should not have claimed depreciation in earlier years by any entity, and it should not exceed 20% if at all you are going to import it and use it. The same exceptions that these business cannot be gone into. Generation of electricity is allowed. Same 33, these deductions not allowed. There is one thing again which I felt this I have highlighted by, because they say that without set off of any loss carried forward, etc. Then we found in BAB, this was not there. Since a new manufacturing entity, prior laws will not be there. For that reason, the subsection was not there, or the clause was not there. Here they have it. This is a new manufacturing entity. I don't know why, because just for that reason I went and saw in the option. The first was there. So the first return should go into this. then how we would have had a loss, but they missed and kept that. That is what I feel so. Maybe you all can also have a look at it and then accordingly take a call. The depreciation part is there. The loss will be deemed to have been again this one. Here, since the section is there, then they have put this loss deemed to have been. Actually, this could not have come unless otherwise there is an amalgamation. Here, this is not so. So again, this should not have come. I forgot to underline. The same thing, the assessing officer, if he feels that there are unreasonable profits, then there is a 92BA, some specified domestic transaction, then all this will be treated as a specific income and this will be taxed at 30%. This should be the first of the returns to file. This will be the year assessment year. This will be the first year. So till now, anything that have covered as the BAA, BAB, the group manufacturing related. Generally, they want to give certain benefit, but on the other hand, take certain benefit. I think this has always been the case, which we have seen even in the next one where we are going to see. Give something, take something. I think even in the MAT, that was the case when they brought in. Always they give deductions when they want MAT. When they introduced, they said no, we will not give this. All add, etc. So I think at one end they want to show. Government wants to show that yes, we are giving a lot of benefits, but the other end, they say that there are many richer entities which go scot-free, which are the sore of the eye. So to tax them we are going, but at the end, in between, other entities also get stuck up and then there is a lot of work involved. Can I go to 115 BAC, sir? Am I fast or slow, or can I go in the same speed, sir? Any questions? We'll be happy to take, or in the end too, anytime. Even for my own return, I don't know. Only when I work out, I will know which one I should go into. That too, especially when at least they could have kept like each year you decide. They say each year is specific. You cannot look at residence. Then why for this alone? For a business entity means then you decide once now, how can we project the future? Should they not have given that option even to the unnecessarily one pro? It's only getting added. Be a little bit open. That would have been my humble thought.
The motive is to earn money.
No, they always what I
If
feel.
there is an option, no, it will be like a reducing the income of a government. Now the motive of the government is very clear, no madam.
Motive is clear, but if at all it is in the positive way, why not? Let little bit of adjustments should be there. We never know what will happen when. Nowadays, in a 5-year plan itself, no, I don't think that doesn't happen. It's just 1 year is a long-term plan. Below that only is the short-term plan. So to that extent, when we are deciding, and then why this restriction? They just want to hold back a little. I feel even in the society, out of the total people, I feel like 90% are good. All are good. With 90% bias is 10% are like on the wall. We just fall. Even a good person may fall. When I was working in Canara Bank, my senior manager used to say that it's like when you're traveling in the road, there will be a yellow line. Yellow line sometimes we go the other side. Actually, we should not. But sometimes, due to some reason, maybe to avoid someone, we could have gone. That is for a good thing. We go there. But what should be done? Come back. That is the only thing. So always that leeway should be there. That leeway, if you give now, you feel free. If at all there is a median, you cannot go. Then you will go bump. So to avoid that benefit could have been there. Okay, maybe taxes authorities, they have traveled so much. Going forward, we can only be hopeful that it will be much more better only.
What they think, no madam, now government now, if I give any lenient, they will think that everyone will cross that yellow line and they will come. That is the problem. That is what the present mindset.
That is there, but not for all. That is what I feel.
Earlier
The
government is different,
10% now that
government
gets
is
magnified, like in the movie or in the serials, something bad, now that they get projected again and again. It looks as though that is what is happening in each and every family. Is that so? Never. But that is how it gets projected. So we are looking at that alone, leaving the rest 90.
If Madam wants more litigation, that's
More
all.
litigation. That is a
Should not be. Though yes, being in that field is there, but this is certain things when it comes, no, we feel very sad.
Litigation in turn benefits chartered accountants. That's a vicious circle.
Sir,
Yeah.
so which
That
one?
gives us more jobs.
Yes, chartered accountants and advocates, it is good. But it should be like, if it was really something, yes, which it needed. Like a substantial question of law, yes, I really admire that. Tax case appeals are really good things. But what is happening in writs? It's only principles of natural justice. That too what? Nowadays nothing gets quashed. Only return back. Do it again. That's all. That is the maximum good relief allowed. What is it? It goes back. That is the thing nowadays. To that extent it has happened. But should that be the thing? We should be doing something constructive. So that is missing maybe in tribunal. The member was saying a day that we have certain things like certain days, all simple issues will be posted. Simple issue. What it is? It's basically that no opportunity given. Those issues and all, like you have to just send back. What is happening that half a day, it will all be sent back. The department side, we will say that Lordship, one opportunity, one more opportunity. Other side, what is Lordship, at least cost. Department side, they will say, okay, when you are sending back, we can't do anything, okay, cost. So this is the only argument. Opportunity, cost, okay, I will think and then accordingly I will pass orders. If that this happens for half a day, means about 50 cases minimum if we see. What is happening? So much time and efforts and money is being wasted. So at the end you don't feel happy what I did today. So that need not be there. If at all it is really, yes, we argued for it and then won the case. Even if it is lost also, it's fine. Because here it is nothing big, but it's only the taxes at the end of the day, not a criminal case. So to that extent we are happy. That is what is being looked for. But sooner I think it will get, because now they are looking at litigation, reducing litigations. So we will be there soon with that hope. 115 BAC, tax on income of individuals, HUF and others. Any returns filed till now? You would have filed, sir? What has been the experience? How is it?
Now, if you file the return, if you do the verification, immediate in minutes, either you will get the message your return is processed or your return has some defect.
What type of defects are coming, sir?
Like there was the rent, one yesterday I filed, there was the return rental income from the plant and machinery along with the labor. But the company has deducted the rent under 194 IP, rent to plant and machinery.
Are they going so in depth and so many checks have been kept now itself that this is coming out?
Yeah. So once I filed as a business income, immediate it shows that in defective return, when I went to know the defective return region, there they are mentioning your TDS is deducted under section 194I, but you have shown as a business income, so ITR 4 is not applicable.
But if at all the system could give such a prompt now, you could have done that at the time of filing the return. Isn't it? Again, see, one step before itself we would have addressed this. What could have been done later?
That much opportunity will not be, madam.
Huh?
That much opportunity will not be.
No, see, at least now it is earlier in all it used to be in the mail. They will say that it will come separately. That mail, finding it is very difficult. Getting it from client is very difficult. But this is good. So it's coming immediately. It gets addressed. We need not have to wait for long. Good thing.
But
Anything on the BAC?
For that, I talked with the AO that since it is the business income, because I am giving the plant and machinery on rent along with the labor, it is my business income, so it should be, I should file as a business income. But you don't know, if you will file as a business income, your return will be defective 139. So you have to show as a other source.
Other income.
Yeah, other source. Or you have to show as a rental income.
Or split, so that at this point of time the return goes. Anything on BAC, sir? On the options, choosing the options.
It is by default, it will be selecting
New regime, yes. And just asking, because there again this is something new we will be facing now, that though the new 1.0 was there, now this is the 2.0. And
Madam, that query, no, whatever we had a faced problem, whether it is legally valid, I mean, I can file business income now actually.
actually that cannot come up in 143 at all. That is what is my thought. It cannot
Yes,
come up.
The it is
That's all
subjective
you have to go
now.
into it. You have
When
to-
it is not a subjective, it can, I mean, it can, but
Exactly.
when it is a subjective, it should
cannot-
not.
Yeah, and that's for that reason I'm saying show a minimum amount in one part and then file it and then take it up with the AO later. That is how it could be done.
It's like system is already in the.
Yes, that is true. Okay. Now the this 115 BAC actually like 115 BA, they brought separate sections each time, so it was easier. But here everything they are adding it here itself. So when you read one section here, this you have to look at, okay, this is from 1.0 angle. This is next one is from 2.0 angle. That is how you have to read it. I don't know why it was mentioned, but the first one is now from the 1.0 because it says 1421 to 24. Notwithstanding anything contained in this act, but subject to the provisions of this chapter, the income tax payable in respect of income of individual or HUF only was there at that point of time when it was a new 1.0. For any year, any previous year relevant to assessment year after 1421 but before 24 shall at the option of such person be computed at the rate of tax given in the following table if you satisfy the conditions which are there in the next subsection 2. And they told that instead of 5, 20 and 30, which was a jump 5 to 20 to 30, they gave a 5% jump every 2.5 lakhs. And what they told in that proviso was that if at all you do not satisfy the conditions under subsection 2, then your return will become invalid in respect of that assessment year. And another proviso to say that invalid for subsequent assessment year also. So once you do not follow the condition, then option becomes invalid. And they brought in the 1A now. So we will go like a movie, 1A, like new 1.0, 2. Now this is 2. Notwithstanding anything, but subject to the provisions of this chapter, the income tax payable for an individual HUF, AOP, BOI, whether incorporated or not, artificial juridical person, and they say other than the person who has exercised an option under subsection 6. So if at all you have gone under, the 6 is for the 1.0, that also you have to exclude. Excluding that, for any previous year relevant to the assessment year 24-25 will be computed as per this. So instead of 5 lakhs, they gave a 3 lakhs. Every 3 lakhs there is a variation. So this is actually the amount wise, if they say it is a great benefit, it looks like a great benefit. And a list of subsections which we will not be able to claim. And certain things are very difficult to digest also. Is it able to see, sir? I wanted to put it in one slide so that it is easier to fathom. The first one is the leave travel concession, will not be allowed. Second one, HRA not allowed. Certain allowances under 1014. Remember while reading the, during the CA examination times, we have to kill compensatory allowance. It's mostly I remember it was all relating to the service. Those who are in service and that they are in difficult conditions, etc. Those and all they have removed. I don't know why they should be separate. For this reason that I could not digest again. Allowances for MD, this I am happy. Then deduction in respect of income of minor, not at all worth a deduction, but still. Then deduction for SE is that unit. Then 16, in the earlier one, 1.0, they told even standard deduction of 50,000 was not allowed. So it was very difficult. Now, maybe because of the backlash, they brought that. And additionally, I put that 57 where that is the pension. Pension again a measly sum of 15,000. That never gets any amount they put, whichever is lower, they never increase it. 1/3 of the amount, the salary amount, or 15,000. 15,000 stays. That is again still there. So this one. Then 24B. This again, those who are paying it will feel the pinch. Maybe for others it is okay. Interest in respect of property, if it is overall 2 lakhs. If at all, we lose means 2 lakhs will be lost there. So we have to consider the 2 lakhs as compared to the benefit that we get. Then 32, this and all, I'll just leave 32, 32, AD, 33, AD, ABA, 35.
Madam,
Yes.
I have one question.
Yes, sir.
Suppose I have rental income with home loan, then I will get the benefit in new scheme of home rental income with home loan.
Rental income, not self-occupied, na?
No.
Not self-occupied means it will not come here, sir. But they catch that if you cannot, they will not allow you to set off. There is another 2 lakhs. This 2 lakhs is for the deduction. Under 24 deduction. if we go to here, if we see, sir, under 2, without set off of any loss, B, under the head income from house property with any other head of income. So here there will be the loss sitting now. The previous year loss, if at all any interest paid, that will come here. So according to me, fully gone.
Like,
Current year and the carry forward, both gone. Current year itself you don't allow, gone. Carry forward also gone. From now on, nothing.
like if I am going this new regime, loss from the house property for the self-occupied up to 2 lakh, that is gone.
Gone.
Now, suppose I have a house property that I have given on rent and I am paying the bank
I am,
interest.
according to me, it should not. You cannot claim because that is what it says. It doesn't give anything because there, if we see, it says property referred under 23(2), that is for self-occupied. Here in this deduction, when they say 24B, it is the interest. They say with respect to the property referred to in 23(2). 23(2) relates to self-occupied.
And rented property?
Huh?
Rented property.
Rent here you can here you will not get only the 2 lakhs relating to self-occupied.
Okay.
There you will not get
Here set off.
set off not available.
Set off itself is not available.
That year's loss if you have you can claim that year, you know, carry forward. That is what is my understanding.
Not of carry forward. Madam.
Huh.
Setting off. See, current year I had a.
Sorry, with no set off, nothing.
That's
nothing.
what I'm telling you.
Here it will go.
So, I am not asking for
Everything
occupied.
here, everything
I am
gone.
asking for the rented property.
According to me, no, sir. Because here they do not take off the 24.
Because earlier also for rented property limit was unlimited. You can.
Yes. This is 2 lakhs. There it was unlimited.
Yeah.
Yes, sir.
Now that unlimited is also abolished in new regime.
That is what I think so. For this reason only I went again and again. There is a 24B. Here it is not there. So loss.
But I have tried yesterday filing with back. It was
allowing for set off, sir.
In the software it was allowing. But
No, if in software no proceeds, no, sir. That is what we saw now. The act. So it is allowing.
Yeah, software it is.
What was it that was given as a deduction, sir? What was taken as a set off?
Whole renting.
You showed rental income, then you had a interest payment, so it was a negative.
Yeah.
That negative you set it off against?
Then it was becoming 0.
Set off against what, sir?
Interest. Suppose my rent is 2 lakh. I have paid interest 3 lakh. So it was showing 0
Okay.
tax. Or suppose if rent is 3 lakh, interest is 2 lakh.
So the
then
wordings,
what
if you see here, sir, under the head income from house property with any other head of income. So you have done it with same head of income. Within the same rental you have done that.
Yeah.
That is allowed. Here it says under any other head of income.
Okay.
So that, I think this example clarifies now further.
Yes.
Thank you very much, sir. So to repeat, so self-occupied,
No.
nothing, it will not be allowed. Rental income, within that rent you can adjust,
Yes.
but no set off with any other head of
Yes.
income. That is what comes out of this. Thank you.
No.
No set off, no carry forward.
Okay.
Yes. With heavy heart. I think this is very difficult, isn't it?
Food allowance.
Nothing is
Food allowance
allowed.
also is not. Food allowance is also not allowed.
That comes as the rule. So just to close this off, under chapter C, they say chapter C not allowed other than 80 CCD, which is contribution to pension income, they allow. CCH Agniveer, I think for compensation for that and all they remove, they say Agniveer, this one I allow, and maybe that is one thing they thought of. And ADJJ, new employees. So these are the exceptions. Then what actually, how it will be computed without set off of any loss, carry forward or depreciation from any earlier assessment year, if such loss or depreciation is attributable to any of the deductions relating to the above sections. Then under the head income from house property, depreciation 32 allowed, 32(2) not allowed. Then without any exemption or deduction for allowance or perquisite by whatever name called, provided under any other law for the time being in force. There was actually a notification which I will cover where they have touched upon 3 rules. Now this again they say that loss or depreciation will be deemed to have been allowed and the WDV will be adjusted. Now BAC 3, the further that in the case where the assessee has not exercised the option under subsection 5 for any previous year, the income tax on the total income of the assessee is computed under subsection 1A and there is a depreciation allowance. This is actually this one WDV adjusted for regime 1, this WDV adjusted for regime 2. That's why the second proviso. This is only a proviso. Now we go to subsection 4. 4 is for the IFSC. There they give a benefit here. Under this section they give a benefit, and which again I feel for IFSC why they should come under BAC and all. But given.
The very purpose of savings general public, it is discouraging, no? That chapter 6A deductions like LIC.
At least for that reason we used to put in 1.5 lakhs. 1.5 lakhs is nothing nowadays.
They are discouraging the general public savings option.
No, at this point actually, even when I discussed with one of the senior, he mentioned that nowadays our savings are very high in India. Maybe because of that there is a shift between. But still I feel, then should we move over to US model?
Yes.
That is the worst model and we are in a good model, then we should, whatever goodness is there, we should keep it up, improve it.
And now that will be for this insurance company, they are telling you will climb the deduction under chapter 6, see you will get the benefit this much tax. Here they will do like this, who is the questioning, madam?
I only think of ration shops. Ration shops nowadays, actually they give food, in the sense rice, oil, dal, etc. A person, a family can at least subsist on that, sustenance can be there. No, but they feel that instead of this, why not give money? How much money they can give? They are thinking in the range of 100 to 1000. That will be spent in a machine. And what they will do for food? The children will suffer, the family will suffer. That they are not looking at. They are looking at simplifying, but at what cost? Both are not being looked into. So it is just going in one way. I fully agree with you, sir. This 1.5 lakhs should not have been taken.
Now retail investors, madam, what I felt no, madam, insurance whatever they are mentioning, they will give something like 6% if you see the return. And also the person compared to the earlier, now the people who are saving, the saving mentality has been increased, irrespective of maybe, and also to the reduction of department work also, they would have reduced. She told me, madam, OCD guidelines, we want to remove the exemptions, we want to remove the deductions. Based on that guidelines, maybe.
Fine, sir. As sir mentioned, I feel for savings you should, when you can give so many exceptions, 80 JJA can come, their ATM can come, IFSC can come, when these can come.
In the last 2-3 years, we have
One
seen
second,
that the scam for the salaried editor.
Hmm.
So they are telling all the salaried people, they are doing only the, they are mentioning fake housing loan, fake APC. To curb this only, they are making for the.
That's what. How many people would do that? How many of us will suggest that? We will not. 10%, 5%, 1%.
Yeah.
For that, all the rest suffer. Someone here was saying something. Before I come over to you. Someone here?
No, that finance minister itself saying, Nirmala Sitharaman madam, we are simplifying the tax. What is the purpose of giving two options? Old version, new version?
No, sir. This old will go off, sir. This is only.
Will go off.
I feel this is temporary.
At a time if you stick, no sir.
Students will suffer now. They have to read 2 provisions. All confusion. For us, we are spending so much of time to read it and apply it and then check in both the methods. See what tomorrow if anything goes wrong, the client will easily come and say, why you did not look into it?
Yeah.
But so much of effort goes into it. Everything for a waste. As well they could have managed. But there was one press also that they have told. Even now we are not taking off the old one. If you want, you can still go. There is some fake news going around that we have removed it. So they do not want to give a shocker song. They want to be in the good books and then easy. One day they will. Now the regime has changed. Again has come down. Maybe now in the second year or so, not the first year I think. Yes sir.
Not only ADC, even ADT is also required to use life insurance against health insurance. Actually, it's like make it as a mandatory customer.
No, they should actually take care, sir. At least we were doing
Take it
it.
action.
Now even that they are removing. Where it is going, I don't know.
And they will do government hospital, man. If they tell you Government hospital they tell.
Some credit needs to be given. In Tamil Nadu, they are saying that government hospitals are doing very good job. The service is very good, but the only thing is takes time, which we cannot afford. If we go, we cannot come back in 1 hour, 1 day, which we cannot afford. So that problem is there, but they are also improving. It will take some time. Again, hope, sir. Only on hope we survive, sir. Especially when we read this, we have too much of hopes.
1947 book ma'am.
1947, if you mention, then immediately I can think of only the average age, 40. Now 60 is gone, now we are approaching 70. So hope again.
No better vehicle, no cars around us around zero insurance. How can a person is AED? Is it not care for life also? That's not the problem.
That's true. That's true. Very difficult. But now I think.
Like you said, savings are increasing is okay, but now the youngsters who are now coming into the job, they may be having 5 lakhs, 6 lakhs income now. If they definitely go for this thing, they say the tax, but the thing is, they don't have any sort of fix.
That we have to take care ourselves. But now I think even that insurance companies and medical insurance, lot of scams are happening. If you have insurance, then the amount they charge. If even for vehicle, insurance, you claim it now and they charge so much. So I think that may reduce. Now we will think, no, this is not doing. I'm not getting a reduction. Maybe some awareness will come there. Or I read in for this actually I was a lot of reading required, and I was looking into Ganga and Kalki biology, and there sir has mentioned, Kalki sir has mentioned that in India we have lot of patience. That's why we are bearing with this much of a tax. No? Worst tax, so many changes every now and then at their whims and fancies. They keep changing, and if at all had it been there in some other country, there would have been a revolution. We have patience only. Okay, IFSC. Then this is now we have to read on last line. So this one, this is for the new 1.0 because this is the 2020 honor after shall not apply honor after 24. Here actually they say that if at all you opt, what all can happen. That is as per the new 1.0 regime. I will skip and go to the 1.2 regime. This is BAC. This is 6 is for the current one. What they say, notwithstanding anything in subsection 1A, nothing contained in subsection 1A. 1A is the new regime rates. Every 3 lakhs also the new regime rates. 2, version 2 rate. Nothing contained in subsection 1A shall apply to a person where an option is exercised by such person in the manner as may be prescribed for any assessment year, and such option is exercised on or before the due date. Under subsection 139 subsection 1 for furnishing the return of income for such assessment year in case of a person having income from business, and such option once exercised shall apply to subsequent assessment years. If we have a business income before 139(1), we have to file the form. Then only we are eligible for, and once exercised shall apply to subsequent assessment years. And the next one they say that along with the return of income. For others there is along with the return of income, it can be filed, but it has to be furnished under subsection 139. So in the earlier case, a business income guy files the form, does not file the return of income. That was one of the questions. Does not file the return of income, still will get the benefit. But an assessee not having business income does not file, need not have to file the form, so have to file the return before 139(1). So this is little bit of a toughness for them. There, at least you can decide every year, but decide it on time. That condition has been now put for them.
By mistake it is delayed, then we cannot opt.
But this one is to opt out, sir.
Or to opt out.
The earlier one was opting in, so this is opt out, so they are happy. If you miss the deadline, they are happy. You will come into the new regime automatically. Provided that once the option under clause 1, once exercised for any previous year, can be withdrawn only once. I am just reading this because there are very small integrities just to keep in mind. Once exercised for any previous year can be withdrawn only once. So we can withdraw it only once for a previous year other than the year in which it was exercised. So if I exercise it now, this option, in revised return if I want to go back, it will not allow because it says, that is what is my reading, in this year I cannot withdraw. If I take the option, suffer this year, next year maybe you can withdraw. So revised return option will not come here. But I think that will not apply for business entities. The business entities, they file the form. So there, even if you file later, even if you later revise it, whether, no, I think there also it should not. There also it will not, because it's not the revised return perspective. So they cannot, in that year, no one can revise it. No one can change. Once you choose, you go with that. Next year maybe, yes, you can change it. The person shall never be eligible to exercise the option under this subsection except where such person ceases to have any income from business or profession, in which case option under 2 shall be available. So once I come back after exercising the option, maybe this year I opt out, next year I come back to the new regime. Again, I cannot go back to the old regime.
Person having income from business.
Yes, that is the. This one means again and again, anytime, in, out, keep doing. Otherwise. The form is the IE not required, now IEA only. Now there also I think everything, that acknowledgement number and all is I saw in one ATR. You could have checked this, that it is asking for acknowledgement number. So this problem of condemnation will not come out. By the time when you file the return itself, it will say you should have filed a form. This is good. This way you have, the system should work like this. Not the other way.
We should not allow the people to make a mistake.
That is, for that only the system should help. This was one question, sir. Maximum surcharge in the new regime. You see, old regime up to 50 nil, same, 50 to 1 crore, 10%, 1 crore to 2 crores, 15%, 2 crores to 5 crores, 25%, above 5 crores, 37 becomes 25. So maximum is 25 only under the surcharge. Rebate. This was also one question. This is only available for individuals. And in the old regime, 5 lakhs. And in the new regime, they have taken it up to 7 lakhs. It's available only to resident individual. There were certain clarifications being given that if at all the assessee intending to opt for concessional rate can intimate, this was in the new 1.0. If at all you wanted to go for the new regime, yes, you can intimate your employer. However, at the time of filing, return of income you can anyway change. So that is not final. Even that remains the same now also. It does not amount to exercise. Now, what were the amendments in the rules? They have amended Rule 2BB, 3 and 5. What is Rule 2BB? They have inserted a sub-rule 3. They say that notwithstanding anything contained in 1 and 2 above, an employee being an assessee who has exercised option under this shall be entitled to exemption only in respect of the allowances mentioned under subclauses A to C of sub-rule 1 and a serial number 11 of the table below sub-rule 2. This is nothing but that 1014. We have all the allowances listed out. In that allowance, they say that sub-rule 1, I will give you A to exemption only for A to C, and serial in that next table 11th item. These are the two things I will give. All others are removed. So all other allowances will go away. So what are those? For 10 subsection 14 subclause 1, prescribed allowances by whatever name called shall be the following. Namely, A is any allowance granted to meet the cost of travel on tour or on transfer. This they allow because A to C is allowed now. All others only gone. B, any allowance whether granted on tour or for the period of journey in connection with transfer to meet the ordinary daily charges incurred by an employee on account of absence from his notice. So transfer allowance given. Third one, any allowance granted to meet the expenditure incurred on conveyance in performance of duties of an office or employment of profit, provided that free conveyance is not provided. So conveyance. These three alone given. What is taken off? The next three taken off now. Any allowance granted to meet the expenditure incurred on a helper where such helper is engaged in the performance of the duties of an office. So for office work, if you have any helper, any allowance given, gone. Office work, no helper. Any allowance granted for encouraging the academic research and training pursuits in educational and research institutions. I think even if let someone take some benefit, so what? By mistake have they taken? Mostly what journals and all they will say that journal may not relate to educational reasons. That would be the only thing I could think of. Okay, something they are reading nowadays, reading habit is going so bad. I read that in US and all they read about 50,000 books. I was shocked. I don't know 5,000 or 50,000, but it was way ahead, and we were just less than 10% of it. We're not at all reading. And nowadays with systems and all, even I don't feel it. I want to have a book, a physical book. No, nowadays everything e-book. So that charm is lost. But okay, someone is getting some allowance to read or study. Even that you can't. You would have said that A, B, C and E. Helper at least okay, but why not E? So that shows the intention. I don't know who would have thought of this. I think no person would think of, because they say that any society where they do not recognize the importance of a teacher, that society will never flourish. Teaching relates to this is also teaching only for us, and all. We cannot have teacher all the time. We cannot. This is one thing. They are not respecting that. Where this here, hope is a little bit at stake. The F is any allowance granted to meet the expenditure incurred on the purchase or maintenance of uniform for wear during the performance of the duties of an officer. This again, very few companies have uniforms where they do not want to differentiate between the employees. For that reason, from top to bottom, they will have uniforms. Out of the table, compensatory allowance, everything, all allowance, this allowance alone they have kept. Transport allowance granted to an employee who is blind or deaf and dumb or orthopedically handicapped with disability of lower extremities, this and all, will of India 3,200 per month. Rule 3, they have brought a change. What did Rule 3 say? In that Rule 3, Sub-Rule 7, Subclause 3, it said that, I'll read subclause, because what it says is subclause was valuing something. Proviso told, no, we will give a exemption. That proviso now they are touching. I'll read the subclause 3. The value of free food and non-alcoholic beverages provided by the employer to an employee shall be the amount of expenditure incurred by such employer. The amount so determined shall be reduced by the amount, if any, paid or recovered from the employee for such benefit or amenity. So, if at all they give and we pay something, net only will be taxed as a perquisite or amenities. Now, in that they told, provided that nothing contained in this clause shall apply to a free food and non-alcoholic beverages provided by such employer during working hours at office or business premises or through paid vouchers, which are not transferable and usable only at eating joints, to the extent the value thereof, either case, does not exceed 50 rupees per meal or to snacks, etc., etc. This and all they were providing. They told that if at all it is during the office hours, some free food, etc. is given, that will be exempted. Now they say, provided further that the provisions of the first proviso in respect of free food and non-alcoholic beverage provided by the employer through paid vouchers shall not apply to an employee. The only thing there is the difference is free food provided by employer through paid voucher. So this is a little bit of a nicety. If it is through paid voucher, that alone they are taking off. If at all during office hours we have it there, that is still free. Rule 5 is, I'll just cut short, it says that depreciation at beyond 40% will not be given for subsection 1. If at all you take the 115 BAC deduction. Wherever it is 50, it will cut short, stop with 40%. That's 3212. There again we can have a look maybe, because when I looked at 3212, it was all relating to intangible assets, and intangible assets were 25%. So nowhere under 40, but there was a sub in the rule 5 there was a sub rule where it was saying for certain this thing that is 40% depreciation is allowed. A sub rule cannot overrule that. So in the table it was there only as 25%, and the Act says go by the table. Whether the sub rule which says 40% can overrule, there was a little bit of I was not convinced, but this is what it is. You can just have a read, sir. If anything, we can touch base. I will leave my number. I will be happy to receive any queries or comments. I will be very happy to. With this, I stop with 115 BAC. Anything? Any questions? Any points, remarks? We have 10 more minutes left. I will touch upon, because these are the two major things which we need to understand the niceties, because we need to apply them. And once we are clear, I think what I have done is going through the sections in depth. Other than that, now whatever material we go through, we will be able to answer them, or any FAQs we will be able to answer. So we need not have to worry. That is how I have taken it. This one again I will touch upon the long term and the short term capital gains, because these are all rates specific. These are given in, these are all that subject to. Nothing contained in this Act, but subject to the provisions within the chapter. If at all short-term and long-term capital gains are to be taxed at a particular rate, it is given here. 111A. 111A it says that capital gains arising from the transfer of a short-term capital asset, 3 types. One is equity share, equity oriented fund unit, or a business trust unit. If at all, generally we will be dealing with equity share. If at all a unit of equity share is being sold, any capital gains is arising which is short term, and there is a STT on it, it will be taxed at 15%. The question was there that this is the tax. Tax was there, I asked the surcharge. That's why a little bit of confusion is there. Like the tax is 15%. A resident individual or HUF can claim basic exemption limit. They alone can claim basic exemption limit, and no chapter 6A deduction will be allowed for this amount. The same thing will apply for 112A. These two are connected. Here it is a long term for the same asset. If it is an equity share, equity oriented fund, business trust unit, STT has been paid. Any amount exceeding 1 lakh. There is a basic limit of 1 lakh they allow. After 1 lakh only 10% tax. Short term is 15%, here it is 10%. For 10% also, more than 1 lakh of tax, that alone will be, shall be taxed at 10% exceeding the 1 lakh of amount. And however, STT need not be paid if at all it is undertaken under IFSC, that is one exception they are giving. The same thing, resident individual or HUF can claim basic exemption limit, no chapter A deduction, and rebate under 87. I don't know why this came, but that is how it was given, that 87 rebate is not. So for
Mutual
each,
fund has a problem.
Huh?
Mutual fund has a
Equity
problem.
oriented fund.
equity oriented fund. That is it. But I feel like they test us everywhere. Every section they will keep something. So we cannot apply the same thing. We have to always, in the school days, differentiate between this or that. Always there will be something or the other. So 111 and A and 112A, I thought, okay, almost at the end one, 87. But maybe the system may catch. I don't know. Then the other one is long-term capital gains, which is not under a share, equity unit, etc. So here what they say, resident individual, HUF, domestic company and other shall be taxed at 20%. So we saw this is 20%, and this 20% also exception they are giving. Non-resident and foreign company at 20%, except if it is a case of two things. If at all we purchase the capital asset in foreign currency, then do the computation also in foreign currency and then convert. That has to be done. And second one is no indexation benefit. If these two things are done, then it is 20%. Otherwise, it will come under the, for non-resident alone, this exception is being given. And long-term capital gains arising from transfer of listed securities are taxed at 10%. This option is again there. I don't know why, like, you try both the methods now, with the indexation, without indexation, 10% or 20%. That also is there. Chapter 6A deduction, etc. So this covers short-term and long-term capital gains, 111, 112 and 120. Other taxes I will just rush through, just to know like, okay, what is this, because there are a lot of sections and then only you don't know so many other huge provision. But I am trying to just, something stays in our mind for that refresher purpose I'm just saying it. 110 says that if at all any income on which no tax is, total income includes some income on which no tax is payable, then they are not removing that. They say that we will, in the tax we will give you a deduction. That is on an average basis. Average tax will be applied on that, and that deduction will be given not as an exemption or a deduction. This is the separate method of claiming. I think I am clear? If at all there is in the total income, we have an income which is not taxable. Actually what is simple thing, remove it or give some deduction, close it. No, they say for that you calculate the tax. I will give you a deduction in the tax as per the average rate I will apply, and that deduction I will give you in the tax, not in the income. So that is what is 110. This generally, I checked it for what it will apply. This is for the AOP, BOI shares, determinable, indeterminable, there and all, like where it is included here, but not taxable. Then in that case, this rate has to be applied. This is 115 BB is tax on winnings. Winnings on what all? Because here we have to be now careful, online gains are come. Online gains will not be here. There is a separate section. So for that reason, I will read the sections. Again, importance of sections. heading. Tax on winnings from lottery, crossword puzzles, races, including horse races, card games and other games of any sort or gambling or betting of any form or nature whatsoever. All will be taxed at 30%, the highest rate. This is okay. And here you have to exclude, when they say horse race, excludes income from activity of owning and maintaining the horse. Owning and maintaining as a business, if you do, that is a different thing. Here it is only as a race. If you get any money, that alone will come here. Online games, any winnings from assessment year 24-25, it is separately under 115 BBJ. That will not come here. So online games are not under this section. And I just thought of touching upon two case law, where they told that if this, you cannot take it as a business income. Just because you do this as a business income. In this Manju, they tried like, why I have to go here? I have to take it as a certain income, 22%, like this we can try now. So there will be very creative minds. So that earlier itself they have tried it. At that time what was told, that he was a lottery agent. And for them they have to necessarily buy the stock. Whatever is not sold off stock, it's their own money. Their own stock, and that will not remain as a stock, because now any if at all that any money comes, that will be like they can also go and collect the prize money. Had it been a stock, it seems there is a difference. I'll just take a minute. It was very interesting. I felt like, had it been the stock itself, it seems the agent has to deposit some money with the person who conducts the lottery. So there it will be, that amount will get adjusted. So that amount what was given will be returned back, if at all he wins as a stock. But if at all he wins it as a third party, we go and collect it. That is different. So here he actually collected it. They told that no, this is not your business. In that case, this will be in the winnings, and for that they gave the reasoning. The rate prescribed under 115 is applicable for the winnings. Now no one can do business of participation in lottery draw where price is only a chance. There is a chance that you cannot do it as a business. So this is just from the understanding of the principle. Maybe it will help in understanding any transaction which comes up in future that we may have to look into.
And here in this case, the person entered into a contract saying that if it is not sold, I will buy.
He had given some money and then bought it. It is now his own.
Okay.
Individual.
Unsold tickets.
Unsold tickets are his own, and then as a normal person, he was holding it.
Okay.
If won, then you go and then collect the price money. Like that. So it was not as a stock.
And suppose it is a stock, suppose he...
According to me, that did not come out clearly in the case law, but according to me, if that is so, it can become, because there they say the collection, you have to go to the agent and then collect it in a different way. That is different, and here as a collection as the money, price money is different.
Suppose the seller of the lottery, he purchased 2000 lottery, 1500.
I get your point, sir. I very well get your point. That I think then you can go through the Manju and we can discuss over it, sir.
Okay.
Yes. CIT versus Dr. MAM. There also, here it is a horse race. Bettings and winnings from betting and gambling income could not set off the winnings from betting and gambling income, as they would be taxed on a gross basis. They say that from business income you cannot. This also they tried it as a gambling income, also as a business income, which was not allowed. The principle, overall principle stays so, but there will be exception. Patent is just as a matter of pride. Like now, if at all any patent gets registered in India, then it is a 10% tax on the same. But they have kept the check that, because many companies what they will do, they will transfer the patent after doing everything. Just for registration alone will happen here. That means we are losing out because everything happens outside. Here they have put the condition that explanation developed. It says means at least 75% of the expenditure incurred for any invention in respect of which patent was granted should be done in India. If that is done, then it is yes, Indian patent, and for that I will give you a 10% taxation, no other deduction or allowance. This actually may be a hit because the expenses could be high. And for this there is a section 80 RRB, I think. There they give a 3 lakhs deduction, expenses can be claimed. So maybe if the expenses are too huge, we can still go to 80 RRB. And here if we go into it and do not avail it later, means for 5 years again you cannot take this. There is that check they have kept here. You cannot come in once and immediately go out. Carbon credit, as of now all the courts are in favor of this. You see, they say that it is a capital receipt, but it is still pending before the Honorable Supreme Court. So we never know nowadays. anything can change at the higher court. Whatever sails through here can get reversed there. So we cannot, it's always keeping fingers crossed. So to understand what is it, income from the transfer of carbon credits. Carbon credit is what, if at all an entity is doing something which is from husk they are producing electricity, etc. Then they are given additional certificates or so. That certificate, someone else is not doing so. They are also required to maintain that limit. This person, they will buy it from the other person, so that this person gets it as an incentive, and for that person he has to show it that, okay, though I did not use it as I used a fossil fuel or so, but to that extent I compensate this person, so he is benefited. This carbon credit, when it is sold, it is taken as a capital receipt, it is not taxable. No deduction in respect of expenditure. Here they say, so actually if you take it as a capital receipt, this should not apply. And what is the carbon credit they have? Then why so? There may be an exception also. I will just touch upon this here again. This point alone I will just touch upon. Carbon credit, what they have explained it as, in respect of 1 unit shall mean reduction of 1 ton of carbon dioxide emissions or emissions of its equivalent gases, which is validated by UN framework on climate change and which can be traded in market at its prevailing market price. The Subhash Kabini. What they held was, when the carbon credit is generated out of environmental concern, it is not having the character of trading activity. They told that, so it is a capital receipt, but in Chempla Sanmar, SLP is pending. All the high courts are in favor, most of them. But I found one decision which we can look into if at all we find something of this case coming up, which is in Sasha Industries Limited versus NFAC, the recent one. They have discussed the type of credits. They say there are 3 of them. What are the 3 incentives being given? They say carbon credit. In carbon credit, it's 2 types. One is the UN protocol and other is voluntary. The UN protocol alone is there in the section. The other one is not there. So what will happen to the other one? So that the UN credit one will get taxed at 10%. What will happen to the other one? That is there. So that one may be capital. That is how that point of view may be taken. There is another one called REC, Renewable Energy Certificate. The other one is ESCerts, Energy Saving Certificates. So already there are 3 in that. Only in carbon credit also only one portion has been dealt with, others have not been dealt with. But generally the courts have been taking it as in this is not a business activity for environmental reasons. They are doing it. So take it as a capital receipt and do not tax. And I have just shared the types, what are they? That was very interesting to read. That decision could be looked into for just reading purpose. Virtual digital assets. This was another fantastic one, but too much to absorb, I would say. So much of bitcoins, etc. was going in, but very interesting one. That is taxed at 30%, no deduction being given. They have been very strict. This virtual digital asset and online games and all are little on the strict asset. Taxation itself will show at 30%. And they say in the last line, transfer shall apply to media capital asset or not. Whatever it is, I'm going to tax you. And no set off of loss from transfer of media shall be allowed against income computed under any other provisions. Such loss shall not be allowed to be carried forward. So no set off, no expenditure, no set off, nothing. Straight away I want 30%. So still they are trying. And what is out of it? I think other things and all okay, but what is out of it? Gift cards, vouchers, mileage points, reward points, loyalty cards, subscriptions to websites or platforms or applications shall be excluded from the definition of. This may be helpful to us. So that I thought I will put. Online games, the same thing, notwithstanding anything, taxable at 30%. Online game is anything through the computer. This covers the overall thing, and my time also is come. I have just 115 JB, this and all you will be very well versed with. Just for completion's sake, 115 JB, now 15% is the MAT rate, which is now to be looked into. All others are add and less. In the examination, how we used to add, log it up, less, all again has to be, this and all has to go out. But yes, categorizing it is a challenge sometimes, especially with the Ind AS provisions. Ind AS provisions also, the transition, they say, the transition amount is 1/5. 1/5 of the transition amount will be given each year. For 5 years, the transition amount will be given as a benefit. Other than that, in Ind AS they have what will be reversing, what will not get reversed. I think that was one thing which was easier to understand, like in the sense we have to look at whether that will later on this transaction will get reversed, then don't touch it. If it is not going to reverse, we have to touch it. I think that is the perspective with which the Ind AS has been drafted, Ind AS provisions. This banking and all is now, everything are now into it, banking, electricity, etc. We have to look into the statement of profit and loss account. All the accounting standards, everything needs to be followed as per the Companies Act. Previous year is the different one, then adjust it. Taxes includes everything. Foreign company, if at all they don't have a P, that is excluded. This and all just for the provision's sake. Transition amount 1/5 allowed. We have to file a report 1 month before. Form 29B. This will not apply to 115 BA and BAB, which we saw in the beginning itself. BA we can wait and date, BAB not apply. And if it is an IFSC means instead of 15%, it is 9%. JA, the MAT credit is available. Tax credit can be taken. AMT, there are 3 deductions that alone we have to look into, the 10A, 35AD, 32A, 32 get ready. Then all chapter 6 except that ATP. And one point I forgot to mention, that 115B, the new cooperatives. New cooperatives, whoever gets the ATP benefit, will they go for it? Only the cooperatives who have that cooperative bank, that issue with that bank or a society, if at all they feel so, they may go. Otherwise, who will leave ATP and then come to this 15%, even if it is 15%? I see 9%. Credit will be available for 15 years. This is now dividend distribution tax charged at 20%, now applicable for the public sector and companies also. All needs to be. That is it I wanted to share with you. It's been really nice, educative journey for me to prepare for this, and you have been a very nice crowd. You have been very cooperative and very, I think, I did not feel like it is a monologue. So thank you very much for the nice evening. Thanks a lot for your patience. Yes. Just completed now, on time. On time for you.
I think I'm loud enough, so I'll thank you. Thank you, ma'am, for coming and sharing your knowledge and coming all the way from Chennai. Thank you so much. I hope you all had a good session. Thank you.
Oh, that is more important. If at all they are taking back something, I will be very happy. Tell you about it.
More memento from us.
Very nice. Thanks a lot.
Given by our friend.
Thank you very much.
Thank you.
You remember very much. Thank you, thanks a lot.
So we'll have a tea break and meet at 6:30. Okay. Welcome back to all of you, and the second session of the day is on the assessments from section 139 to 144. We have CA Siddharna Biradar to speak on the subject. I request CA Radhakrishna to hand over floral bouquet to him. So please. Siddharna, welcome to you. Please take your seat. Welcome to you. A quick intro of Siddharna Biradar. He is a member of the Institute of Chartered Accountants and is a graduate on business management from Gulbarga University. He is the practice head in a leading CA firm in Bangalore with post-qualification experience of over a decade. His area of expertise is DT advisory, litigation, transfer pricing matters and assessments. In a career of more than a decade, he has been conducting training sessions on various tax matters. He's been a speaker at Bangalore branch and Kalburgi branch. He has also written a few articles on the income tax matters. It's a pleasure to have you, Siddharna, here. Thank you for giving your time to us, and over to you.
Honorable Secretary, the Bengaluru branch of SISC, Kavita ma'am, and respected members. When I was called and asked to come here as a speaker of the day, I immediately agreed, and I thought that this is going to be an interesting session for me for more than one reason, obviously. First important reason is this is a tax season, and my topic is on filing the tax returns and the assessment. And also this is the month in which we are supposed to get the notices now for regular assessments for assessment year 23-24. I'm not sure whether any of you have got the notices for your clients, but in our case, so far there has not been any notices. So, as we all know, there has been dramatic changes in the recent past in the income tax law, both procedurally and technically. Income tax returns forms, the contents of the forms have been changed. The adjustments which are done under 143(1), intimation, have undergone a change. And the way the assessments are being conducted, particularly the regular assessments under 143, have undergone a sea of change. So now, when we come to the topic of the day, the filing of income tax returns under section 139 and the sorry for the interruption. So under section 139, if you see, there has been several changes, amendments over a period of time. Subsection 1 of section 139 has undergone a change. Timing and all, the time limits within which the tax returns has to be filed. Subsection 4, 5, belated return and respective return, respectively, there has been a changes again in as regards to the timing. Subsection 8A has been added to 139, which is an important aspect which was not there earlier. This is a new concept, something called as updated return. 143(1) there has been a changes. Before 143(1), if I say 139A, the application for PAN has been changed. 139AA has been added, linking of PAN and Aadhaar and nuisances around. 143(1), intimation, there has been changes. Several changes are there. And 143(2), 143(3) and 143(3) read with 144B, faceless assessment is complete overall of the way the assessments are being conducted. And there were some of the changes in 144C, dispute resolution and other things. So we'll discuss one by one, going into the topic. So general balance, as a common man, what do you understand by the return of income? Return of income is nothing but a declaration of income. It is a declaration stating that this is the income I have earned, this is my income from salary, house property, capital gains of business or profession, other sources income, dividend, interest, whatever it is there. After taking the deductions, exemptions which are permitted in the law, so finally I will arrive at the gross total income. And from the gross total income, certain deductions are allowed under chapter 6A, 80C, 80D, 80G, 80E. 80TT, 80TV, whatever. After taking all those deductions, I will arrive at the total income, that is a taxable income, and compute the tax liability depending upon the taxpayer. And the tax has to be discharged either by way of advance tax or by way of TDS, TCS, or by the payment of self-assessment tax under section 148. This is the broader picture of filing the income tax return. Now, who is supposed to file the income tax returns? Is there any specific deadline? Whether it is necessary for all the taxpayers to file the return of income mandatorily every year? For company, this is the basic things. Many of us would be aware of this. For company and partnership firm includes LLP as per the definition under section 2. Firm includes LLP, and for the company and firm it is always mandatory. And for other class of taxpayers, maybe individual, Hindu, undivided family and all, in case if the gross total income exceeds the basic exemption limit, we have to file the return of income. In addition to that, irrespective of whether there is income or not an income, there are certain class of taxpayers wherein section has mandated them to file the return of income. For example, somebody who has made a deposit of over 1 crore in a current account, irrespective of their income, they have to file the return of income. If somebody has spent an amount of more than 2 lakh rupees on a foreign trip, or somebody has paid electricity bill of more than 1 lakh rupees per annum, it is necessary for them to file the return of income. How does the department comes to know whether somebody has gone traveled outside India and whether he has spent 2 lakh rupees? And how does the income tax department know somebody has paid the electricity bill of more than 1 lakh? But this is a concept of self-assessment, self-declaration. If the assessee knows that he has traveled and spent more than 2 lakhs, he has to file. And there are also certain instances which are prescribed under Rule 12AB. In those cases also it is mandated to file the return of income. For example, somebody who is engaged in the business and his gross receipts or total receipts from the business is more than 60 lakhs. Or somebody who is engaged in the profession and the total gross receipt from the profession is more than 10 lakhs. Obviously they will be filing the return of income. And in case if there is an assessee or a taxpayer for whom the TDS is done for 25,000 rupees or more, 50,000 rupees or more, even they have to file the return of income. And in case if there is a deposit of more than 50 lakh rupees in any one or more savings bank account, they are supposed to file the return of income irrespective of the total income. And there is one more interesting scenario. Somebody who is a resident and ordinarily resident in terms of section 1, section 6 subsection 1. Somebody is a resident and ordinarily resident, and he is a beneficial owner of any asset which is located outside India. Beneficial owner in any asset, including the foreign in financial interest in any asset. Somebody is a beneficial owner, or somebody is a beneficiary in any foreign asset. They have to file the return of income. Beneficial owner means somebody who has funded but for the benefit of somebody else. Beneficiary means he has not funded but enjoying the benefits of the asset. Let me tell you a simple example. There is a person, individual, he was residing in a foreign country. Let us say he was residing in USA for say considerable amount of time, 10-15 years. And he got married, he was also working, but later on she became independent because she stopped working, became housewife and all. He has purchased the property outside India anyways. And it is customary in Indian family to make the spouse to be the co-owner of the property. He is the owner and he is funded, the property was purchased from his own sources of income, but wife is the co-owner. And he shifted back to India, the property is still there. It is given on rent. Wife does not have, she's in India, she is a housewife, does not have any income, maybe more than 50,000-60,000 rupees of some bank interest. Otherwise there is no income for her. Now whether she has to file the return of income, going by this definition. Because it says that beneficiary, if you are a beneficiary in foreign asset, you have to file the return. Some consultant advised him and he filed the return. And he has offered that 30,000-40,000 rupees of income and claimed that 2,000, 3,000, 4,000 rupees, whatever was the TDS, it was claimed as a income. And after 1 or 2 years, the property was sold. And corresponding income, obviously, he has offered to tax. He has paid the taxes and now it is mandatory to file the return of income for his wife. Property is not there, no property, no beneficiary. But still he thought that, okay, I have been doing it consistently, let me file the return of income this year also. He filed. And there is no property now, there is no disclosure of the property in the FA schedule of the ITR. He got the notice, that wife got the notice. Last year you filed the return, there was an asset. This year that asset has vanished somewhere. And there is no corresponding income which is offered to tax. What happened to that asset? Now we have to go, this was the faceless assessment, we have to make the presentation before the one telling that no, this property was in the name of his husband and he has filed the return of income, that income was offered to tax, this is tax returns. this is the tax paid challan and all those things. There may be other instances, for example, somebody who is working outside India, they may be having, say in US also, if you take an example, there is something called as 401k account, 401k account. This is equivalent to PF account in India. So most of the employees, when they shift to India, they will still have that account. And wife is also a nominee owner or part owner of that. Whether we have to file that because her name is also there in that account, whether we have to file return of income because she is the beneficiary or not, this is something which has to be examined on case-to-case basis. And just bringing it to your notice that wherever there are any of your clients who have visited outside India and came back from there, just see what class of assets they have outside India. It may be shares, it may be mutual funds, it may be a 401k account, or it may be any other asset. And just see if any of the family members, family members are also the part of that asset. Now, what is the time limit for filing the return of income? In case of the company, it is always 31st of October, or any other assessee who is required to get their books of accounts audited, either under the Income Tax Act or any other act. For them, it is 31st of October. If there is any assessee who has a transaction with associated enterprise and is required to file the report under 92E, 3 CEB, for them it is 31st of November of the following, of the assessment year. Once the assessee has filed the return of income, they can revise the return of income and file the belated return. So for company and any other assessee whose books of accounts are required to be audited 31st of October, TP cases 30th November, other cases it would be generally 31st July. Now 31st July would be the due date for most of the taxpayers, particularly salary class of taxpayers. There may be a case that there is an assessee who has incurred a loss from business, or it may be business, normal business, or it may be speculation business, or there may be a loss from capital loss on the sale of shares, mutual funds, or asset, any capital asset, or there may be a loss from owning, if he is engaged in owning or maintaining the race horses, or there may be a loss under section assessee who is engaged in, who is claiming the investment linked deductions under 35AD, under 72A and all. For them, they have to file the return of income within the time limit prescribed under subsection 1 of section 139. Original return has to be filed. If they file belatedly under subsection 4 of section 139, the losses is not allowed to be carried. The loss is not allowed to be carried forward. But this is not applicable to depreciation, unobserved depreciation, because it is governed by section 32, and it is not also applicable for house property. If somebody has the losses from house property, self-occupied property, that 2 lakh and all, even if the return of income is filed belatedly, they can still carry forward the losses. We would be having practical scenarios, and just these are all the basics we are discussing. We will go through some of the interesting scenarios also. So in case if the assessee fails to file the return of income within the time limit prescribed under subsection 1, they can file the return of income belatedly under subsection 4 before 3 months from the end of the relevant assessment year. For example, somebody who is a salary class of taxpayer 23-24, he has to file the return of income by 31st of July. If he miss to file the return of income by 31st of July, belatedly they can file before 31st of December, 3 months before the end of the assessment year, or before the completion. That before the completion does not have any relevance now, because this section has undergone changes. Earlier, the belated return, it was allowed to file the belated return 1 year from the end of the relevant assessment year. Now it has been brought down to before the relevant assessment year. Now it is 3 months before the relevant assessment year. Similar provisions are there in case if assessee has filed the return of income or belated return of income, and there are any errors or omissions, wrong statement in the return, they are allowed to revise the return. The revised return can be filed again 3 months before the end of the relevant assessment year or completion, assessment completion, whichever happens earlier. Now, some of the interesting questions. There is a company X Private Limited. Company has filed the return of income under 139(1), original return for financial year 21-22, claiming a loss of 2 crores. Next year, that is 22-23, also there is a loss. of around 60 lakhs. But 20 to 23 return was not filed on time. It was filed belatedly. The company has a PGVP income subsequently in the financial year 23-24. The company has income now of rupees 3 crores. 23-24, the company has 3 crore income. Previously, it has a loss of 2 crore for 21-22, 60 lakh for 22-23. 21-22 return was filed within time, 22-23 return was filed belatedly. Can the company set off the loss of both the years against this income of 3 crores? Any views, sir? For both the years you are telling me it's not possible. So 1 year set off is allowed. Loss of 1 year is allowed to be set off, and for 1 year is allowed. Both years is not allowed.
21-22 is allowed. 21-22 is allowed.
So company can set off because for financial year 21-21 or 21-22 return of income is filed within the time limit. It should be allowed. Subsequent year, if it is not filed, previous years without losses should not be. That should not. The purpose will be defeated otherwise. So for
It is not shown in the.
still it's allowed, even if it is not shown in the income tax return. But if that year's loss is that year's return is filed within the time limit, it is still permitted to be. While Limited had filed the return of income for financial year 22-23 on 30th September, and the same was processed by CPC, and intimation was also issued accepting the returned income. Now they want to revise the return. Is it possible? Revision should be possible because the law says income revised return has to be filed within 3 months from before the end of the assessment year or before the completion of the assessment. Intimation is not an assessment. Intimation is, although you can file an appeal before Commissioner Appeals under 246A, but it is not an assessment order. So it should be allowed. So this is interesting.
So even if you consider as assessment here also, assessment the rates up to December you can file.
No, the law says December or in this case, if assuming that the intimation is processed before 31st of December, maybe on 30th September.
For only it is okay. But assessing is Act is giving
Correct. So the Act says
December.
before 30th December or the completion whichever happens earlier. If we consider intimation as an assessment order, if that happens before 31st of December, then it should not be. So Mr. Z has filed the return of income for the financial year 22-23 under 139(1), and he has missed to report the capital loss on the sale of some mutual funds. Mr. A, let us assume that he is a salaried guy. He has filed the return of income within the time limit permitted under section 139(1), but he has missed to include that loss. He has some mutual funds. He has sold some mutual funds. There was a loss. He has missed it. Can he revise and claim that loss? Because if you see 139(3) says that if you want to carry forward the loss, capital loss and all, return of income has to be filed under. So he has filed the return under 149, but he has not.
This property or not possible? Not cannot.
No. Correct, sir. Any reason for not?
For loss, 139 is
139 he has filed, madam, but he has not included it. He has not claimed that loss in the return. I think there are contrary judgments to this issue because this is a controversial aspect. See, simple example, let us say there is an assessee who has filed the return of income showing a crore of rupees in the income tax return. Filed under section 139(1). The case is picked up for scrutiny. During the assessment, the assessing officer notices that there are certain disallowances. It may be 40A, 1A, 43B or capital versus revenue expenditure, whatever it is. Because of the additions in the assessment process, this return is converted into, this income is converted into loss. Possible. I have filed the return of income, shown 10 lakh rupees loss. Because of addition, 10 lakh rupees income I have shown. Because there was the addition of 12 lakhs, now I have 2 lakh loss. Can't I carry forward that loss? My income tax returns is, I have not shown in my income tax returns loss. It is my income, I have shown income only in the original return. But because of the additions in the assessment, it is converted into loss. I should be allowed to carry forward that loss. And I am not disputing the additions made by the officers for whatever reason.
Sir, if that is the case, I filed a return, assessment got completed, nothing, but I missed some loss to disclose, one business set of. Then in next year, can I claim?
No, you have to file the revised return and claim it, or there has to be an assessment.
Assessment, only these two processes.
Yes.
But in revised return, he can claim.
In revised return, he can claim it. See, in this case, there is a Pune High Court judgment which says that he can claim it, but there is a contrary judgment from Delhi High Court which says that it cannot be claimed. So there is no settled position for this. Both judgments are there. One says that it can be claimed, other says that no, unless and until it is there in the return of income filed under subsection 1, it cannot be claimed. So the other example what I told you, the assessment, if the loss is, income is converted into loss in the assessment, that should be converted. For that we have the jurisdictional High Court judgment in case of Srinivasa Builders, Karnataka High Court judgment, which clearly says that in case if your income is converted into loss during the assessment, that loss should be allowed to be carried forward. There are other judgments also. For example, in case if you have filed the return of income and claim 5 lakhs, that loss becomes 6 lakhs, 7 lakhs, increase in loss should be allowed. And Dhampur Sugar Mills in one of the landmark judgments, revised return can be filed anytime, revised return, it can be filed provided it is within the time limit. In case if you want to make changes in the return of income, it has to be done only by way of revising the return within the prescribed time limit. You cannot file a letter or something to the assessing officer telling the time is this. That is not allowed. So there are a couple of cases which says that if assessee has filed the return of income within the time limit, original return 139(1), and if he has not claimed the return, it is the duty of the assessing officer to allow him the losses if it comes to the notice of the AO during the course of the assessment.
Sir, if it comes that undisclosed, say for example by mistake certain expenses I did not show, so during the assessment he found it, because of that my profit turned into loss.
Correct.
If he comes under undisclosed purchases,
That is separate issue.
that is a separate
That is
issue.
separate aspect.
Then it can't come.
In case if there is a 68, 69A and all those things, all this 115B and all those things will follow. But law should be allowed to.
Sir, now this even today also this holds good, sir. Revised return can be filed any number of times.
Even now also it is there. There is no contrary judgment there. Sir.
Portal is allowed.
Yes, it will allow. So this is another important aspect. See, now I have told the time limit for filing the belated return has undergone changes over the years. Now, for example, let us see somebody a company which has a transaction with the related parties, transfer pricing, which is who is supposed to file the 3CV and all. For them, the due date of return for financial year 23-24 is 30th November 24. If there are any errors in the return, they will get only 1 month time to file the revised return because time limit is 31st of. Even in other cases, also for the companies, any companies, it is 2 months now. Earlier it was up to 31st of March, and before that it was next month, March was also there. Now the government thought that there is no sufficient amount of time. Somebody who may genuinely miss to file the return of income, it may be because of health issues or because of dispute in the family or for any other reasons. The assessee wants to come forward and disclose the income and pay the taxes, do the compliances voluntarily, but the law is not allowing. And somebody who has not filed the return of income and there are some TDS and other things in 26 A's notices will be issued under 148A and 148, and it will be taken up for reassessment. He will be made to pay the tax along with interest 234 ABC and all, and again penalty under 270A for understatement of income. And there will be prosecution proceedings also for not filing the return of income in some of the cases. So the tax authorities tell that one more opportunity should be given the taxpayers, and then because of that reason there was a birth of subsection 80 of section 139. This was introduced in finance via Finance Act 2022. So now when somebody has filed the return of income or has not filed the return of income, they have the option to update the return. They can do the updation till 2 years from the end of the relevant assessment year. Now the assessors are very smart. They will tell that, okay, I have the losses, I forgot to carry forward now. Let me file the belated return and carry forward. That is not allowed. So in case if there is any case where it results into a decrease of the tax liability or increases the losses and all, it is not allowed. In some of the cases, for example, 22-23, the assessee has filed the return of income. The scrutiny notice is issued now in the month of June, and he knows that there are certain transactions which is not there, is not disclosed. Now he tells that before it comes to the notice of the assessing office, because if it comes to the notice of the EO, then there may be additions for the 68, 69A, 60% tax penalty, 100%. So let me pay the tax and finish it off, file the updated return, not allowed. In case if any notices, assessments, reassessments, anything is pending under the income tax law, you cannot file the updated return. Updated return you can file only when there is a positive tax liability, where you have a tax liability but you have not paid. It may so happen that with filing the return of income you have the brought forward losses. You have adjusted the brought forward losses and paid the additional amount of tax in the updated return. As a result of that, the subsequent year losses are also getting affected. So for each of the years you have to update the return. I will show you with an example. So now assessee has not filed the return of income or has filed the return of income but missed to disclose some of the income. He can file the updated return, but there is a rider for this. In addition to tax, there has to be paid an additional tax under 140B. What is the amount of additional tax? Additional tax is 25% of the aggregate tax. What is aggregate tax? You have original tax plus interest plus surcharges plus interest to the defer ABC. 25% of that if you are filing the return of income before 12 months. After 12 months but before 24 months it is 50%.
Earlier penalty was 20% for belated return, updated return.
Earlier updated return was not there. The concept itself was not there earlier.
ATRU.
ATRU, same thing was there. Earlier means 2 years back. Since beginning it is same thing, 25% and 50%.
Okay, what happened when we filed one return, this additional amount did not get calculated. But return was accepted by paying some 100 rupees extra.
Okay.
But later notice came that it is a defective return.
Maybe the computation of the additional tax will be wrong.
It got accepted and it got uploaded and acknowledgement was also given.
Maybe it happens so many cases, so many times when we file the return of income without mentioning proper chala number and all those things, the still return of income will get accepted. After that, the defective notices are issued under 139 as a curative measure. But this is same since the introduction of this section. It is 25% or 50% depending upon the period involved. Some of the questions on this: can the return of income be filed if the original return is a loss?
Yes.
You can file it very well. I have already filed my return of income and now I want to file the updated return which results into decreasing the tax liability. This is not allowed. I have already filed the return of income, a refund of 50,000, now I want to claim a refund of 70. Increase in tax liability, tax refund, this is not allowed. So now whether this amount of 25% or 50%, does it include 234F? Also it does not include, it includes only tax, surcharges plus interest. It does not include the fee.
But I can file revised return if my refund is going to increase.
Revised return you can still file. Revised return is fine. This is
Only updated return?
you cannot file. Updated return is only where you have the additional tax liability.
If any TDS claim is
That you can
missed
claim.
out, if TDS is missed out, can what is to be done?
You can claim the TDS credit whatever is updated in updated 26, but still there has to be some tax liability after claiming the TDS.
No, if I don't want to file return of income, this TDS only is updated. I want to carry forward to next year.
No, that is not allowed. By way of updated return.
Ah.
That is same thing, claiming the refund.
Is there any other option?
Other option is filing an application under 119. Continuation of it.
But SAR is not filing a refund now, sir. Just to carry forward in the TDS amount.
That is also, see, how do we carry forward the so you are telling that
Income is not belonging to this year, it may be belonging to...
still if you try filing ITRU for updated return, there has to be some amount of tax liability. Otherwise, same thing. When you are
Some nominal amount, 100 rupees if I pay and then...
You can try it and do it, but I am not sure what will happen with that. Because as I will take one of the examples also, it is pretty, see, these are all the nascent, we don't have the precedence for this. And this is all we have to try and test.
Sir, while filing the updated return, we already filed the revised number of times. It is asking you acknowledgement number. Whether you already filed the return, mention the acknowledgement number. Which number? Last.
That is the latest.
Latest.
Because once you file the revised return, all other returns will be replaced.
Sir, based on the original return, one of my senior got a order, sir, assessment. That
Intimation or assessment?
Intimation. So, but by the time he get intimation, no, he filed revised return also. So we replied saying that the revised return has been filed. But he is not even considering that.
It happens so many times. Intimation is issued for original return, there is no intimation for the revised return.
Now in person they have to go and meet the
They have
officer.
to meet the
that's it.
officer and tell.
But that will not be processed with revised return.
No, it will show in the portal, madam, whether it is processed or not processed.
Process.
It's processed, sir.
It's process.
I have the genuine loss, genuine refund, whether it is possible, no, it is not possible again. Can I file updated return under for more than one time? This is also interesting. You cannot file a updated version of the updated return, that is not possible. So it is only one time. Revised return you can file any time.
And for assessment, they have 2021 or something.
Yes, ma'am. In case of any survey, search, other proceedings are initiated under the law, it is not allowed. And there is, in case of any information is there with the assessing officer under PMLA, money laundering or black money act and all those things, they are also not allowed. In case if there is information with the assessing officer under automatic exchange of information under section 1990 and all those things, still in that case you cannot file updated return. So this is interesting. When you file the return of income, what will happen to the original return? Whether this will replace, it should replace actually. See, financial year 22-23, I have filed the return of income. Okay. Assessment year 23-24. If the assessing officer wants to take it for regular assessment, scrutiny assessment, the notice has to be issued by 30th June, now 24. I have the time limit, I can file updated return also. Still now, once the notice is issued, I cannot update the return. That is blocked. But notice is not yet issued. I will file the return of income today in the morning, June 13. Evening I will get the notice for that original assessment. Now what will happen to my updated return? See, there has been consequential changes to section 153. 153 speaks about the time limit for completion of assessment. Once the case is picked up for assessment, for example, in case of regular assessment, scrutiny assessment, assessment has to be completed within 12 months from the end of the relevant assessment. Now, 153 says that in case if you file the updated return, it has to be processed within 12 months from the end of the financial year in which the return is filed. So now, if the assessing officer wants to take the assessment for updated return, will there be one more notice, or I am not sure what is going to happen to the original
What
return. If the-
happens, sir, when the notice was generated, the return was not quite updated one.
Yes.
So that is why system has taken that original return.
Maybe, madam.
If updated return was there, it will not update.
Thank you, madam. You should guide us, madam. I told you, madam is an assistant commissioner in Commonwealth and Interest Department. Sunita Kishore, madam. Thank you, madam. And now this is interesting. There is a person, salary employee, he has filed the return of income. Original return 139.1. And after filing the return of income, he notices that he has missed some capital gains income. Short-term capital gains is there, around 10 lakh rupees, he has missed it. And there is also a capital loss, long-term capital loss. That was also not reported. Now he wants to file the updated return. Because if you see under section 71, long-term capital loss is not allowed to be adjusted against short-term capital gains. So I cannot adjust the long-term capital loss. So what he wants to do is, I will pay the tax for that short-term capital gains in the updated return. I will carry forward that long-term capital loss. Is it allowed? See, in the revised return it should be allowed, but here it amounts to decrease in the tax liability either for this year or maybe for the next assessment year. So in my humble opinion, you can pay the tax on that short-term capital gain, but long-term capital loss I think you should not carry forward. In the updated return, you can do it in the revised return. There is an assessee who has a say PGBP income. He has not filed the return of income and now he wants to file the income for 22-23, 3 crores. And there is also brought for a loss of 5 crores. Can he adjust the 3 crores again that there is no tax liability, nothing, zero. I think it should not be allowed. In the similar, in this same example, if the brought forward loss is 2 crores, income is 3 crores, 2 crore he can adjust and 1 crore I think he can pay the taxes.
Sorry, this is adjusted. Okay, this is carry forward LTCL.
So as I told you, there in case of as a result of updated return, subsequent years losses are getting disturbed. You have to file the return of income for each of the updated return for each of the assessment year. I will show you the example. 1920, for example, 1920 there is a loss. Assessment year 1920 on the right hand side. There is a loss which is carried forward. 2021 there is 10 lakhs income. 10 lakhs that brought forward loss is adjusted. 10 lakhs again out of 20 brought forward loss, 10 is adjusted, 10 is carried forward. 21-22, 80 lakhs is the income that brought forward, 10 is adjusted and 70 tax is paid. So this example is clear. Now, the assessee notices that there is some 25 lakh of income for assessment year 2021. He has missed it. And he wants to file the updated return for this. Now what will happen here? If you see earlier, for 2021 there was an income of 10 lakhs, brought for a loss of 20 lakhs. Now he has 25 lakhs of additional income. So 10 lakhs earlier, 25 lakhs, 35 lakhs is the total income. Brought forward loss is 20 lakhs. Entire loss is adjusted here, and the income is 15 lakhs. Next year there is no loss. In the earlier example, like next year 80 lakhs, he has adjusted 10 lakhs and paid the tax on 70 lakhs. But as a result of this carry forward, for next year there is no loss to be carried forward because additional income, that loss is adjusted against the additional income. So next year also he has to update the return and pay the additional tax liability.
The 25%.
Yes.
It's like a double penalty.
So this is one thing. Another interesting aspect. When we file the return of income, income tax returns will be processed and intimations are issued. In the intimations there are adjustment or 4 or 5. Now 6 is not there.
Sir, sorry to interrupt. Other than this updated return, say in regular assessment, if the 25 lakhs by mistake the officer has found or some because of interpretation or something, they had issued a demand, then I will pay. Then the 10 lakhs, whatever I carry forward next year, in the regular year,
that is also same thing.
That is also same thing. I have to file a revised return if I had
or you
a
have to
timeline.
pay the tax liability and keep it. So in case if there is any arithmetical error, mistake numbers and all those things, adjustment will be made. In case if there is any incorrect claim which is apparent, and if there are any disallowances of the preceding financial, for example, if you file the return of income in the preceding financial year after the due date under 139(1) losses, that is not allowed to be carried forward and that will be adjusted in intimation. And in case if there is any discrepancy, differences between the income tax returns and the tax audit report, there will be an adjustment under 143(1). And there are certain instances which are contained under 80AC. Under section 80AC, you are not, if you want to claim exemption under 10A, for example, SEZ units, or any deductions under chapter 6A, series C, you have to file the return of income within the time limit. And in case if you have not filed the return of income any of the previous year, that loss will not be adjusted and there will be a corresponding adjustment in 143(1). There was one more, 6 was there. In case if there is any mismatch between 26As and return of income, even that was added earlier. There were a lot of agitation from the taxpayers and finally it was removed from April 2018. So if there is any mismatch, that will not be addressed in 143(1) now. In most of the cases, the adjustment under 143(1), I will tell you, it will be because of the difference between the tax return and the audit report. This is the case. And if you see the wordings which are contained under clause 4, it says that disallowance of expenses or increase in the income as indicated in the tax audit report. This is the wording which is used in the law. If this increase in income was not there earlier, it was only expenditure which was disallowed. Increase in income, this word was not there. This has been introduced via Finance Act 2021. I will tell you the reason for this. Earlier, in your cases also, there were a lot of notices and intimations under 143(1). Belated payment of PF and ESI. So that was not allowed. Actually, it should not be allowed under section 36(1)(5)(a). Employee's contribution, I am telling you. The moment the employer collects the employee's contribution, it is treated as an income under section 224. And to the extent you make the payment to the relevant fund within the time limit prescribed in PF or ESI Act, it should be allowed. So if you are not paying it to the relevant funds, 15th of PF, 15th of month or 20th ESI and all those things, that is considered as your income. Now the assessing office, the tax auditor will report under clause 20. All these dates, PF, ESI, due date, actual date. There is a table. There was a delay in most of the cases in PF and ESI remittances, which was the tax auditor has reported 15th is the due date, payment is made on 20th. Now it was picked up by the system because there was no income was not added back in the tax computation statement, relying on the judgments. We had so many judgments, several High Court judgments were there. Karnataka Judicial High Court judgment were there in case of Shabri Enterprises. Sun Microsystems case was there, and one more case was there. I don't remember the citation, but 3-4 cases were there. Now all those cases has been reversed after that Checkmate Services Supreme Court judgment, and income tax, the law has been amended now, section 36 plus 15A, and consequential amendments are also there to section 43B. So now when these additions were made, PF and ESI, there were a lot of petitions which were filed stating that this is not an expenditure indicated by the tax audit reporter, tax auditor in the report. He is telling only the dates there. He is not telling that this has to be disallowed. So it may be disallowed or it may be disallowed, that is other aspect, but it is not within the jurisdiction of section 143(1). You cannot make such adjustment in 143(1). Because of that reason, this or income as board has been added eventually.
Sir, employee contribution, you said that it will be income under 224.
Correct.
So in a regular practice, even the employer, if I did not pay, employer did not pay within the due date, then
that is an income.
Then it will be added as an income.
That is income, you have to pay the tax on that. See, for example,
disallowed. It is a disallowed.
No. So for example, you have collected say 10,000 rupees from the employee.
Yes.
The moment you collect, it is your income. Okay. And after collecting, you pay it within the time limit. Deduction is allowed under 36(1)(5)(a). 10,000 you have collected, and paid it within due date, that is nullified. But if you don't pay it, that remains your income.
So if it pays afterwards? like-
Yes. No, it is not a, but it is permanent. It is not like 43B, madam. When you pay it, you claim the reduction. No. It is permanent
Before
discharge.
filing the return,
Yes.
delay, only
Yes.
delay about
Only
it,
delay.
then it will be treated as.
No. It has to be paid within the time limit prescribed under PFISI. That is the controversy. Earlier, even if you paid before the filing return of income, delayed, then it was still allowed as per the judgments.
But
But
there are
now-
two court judgments, no sir. I remember one of the High Court allowed, one of the High Court.
But in
did not.
Karnataka, we were following the jurisdiction high court judgments. But all the judgments were reversed eventually in 2020, towards the end of 2022. Checkmate Services Private Limited. Interesting judgment, you can read it once. And the section is also now amended. 36,158 is amended. Clearly says that you cannot claim. So incorrect claim means anything which is inconsistent in the entry. For example, there is no SB interest but you have claimed DTA. And you have claimed the foreign tax credit but not filed Form 67. And there is an exemption limit but you have exceeded the exemption limit. For example, ATC 1.5 lakh is there, you have claimed 2 lakh rupees. In these cases, the adjustment will be made. So in most of the cases, before making the adjustment, the assessing officer has to send the notices. I mean 143, 1A intimation will be sent telling that this is I am proposing. And you are supposed to make a submission or reply to that. In most of the cases, whatever reply you submit, it is not taken into consideration, obviously because of the system. See, there may be difference in tax audit report and the income tax returns because of various reasons. Simple example I will tell you in my experience of it has happened. There is an expense which is debited to the profit and loss account for which the payment is made to the foreign vendor. When the payment is made to the foreign vendor, there is a TDS liability under section 195. The tax auditor is telling that you have not done the TDS under 195. Because this is in the nature of fees for technical services or royalty, you are supposed to do the TDS. As per his interpretation, it is an income on this period. But as per my interpretation, it is not an income which is charged to tax of the foreign vendor in India, and hence there should not be any corresponding tax liability under 195. So I have not done it. But here, the assessing officer, the tax auditor, he won't agree. He has not agreed. It is your interpretation, and my interpretation is you should have done the TDS. So this was reported in clause 21B of tax audit report. 41A dissonance will be there. 34, clause 34 of the 3CD. But I have not offered to tax. I will tell that in case of the matter comes, I will fight it out in the appellate forum, but I will not agree for this. There is a difference now. Obviously, there will be intimation. Whatever submission I submit, CPC won't allow it. There is another case, for example, ESOP expenses. There is a scheme of ESOP, Employee Stock Option Plan. And because of the restructuring of the company, the vested options of the employees, once the options are vested, can be exercised. Once exercised, that will be perquisite and all those things under 17(2). But there has been restructuring. The company has asked that your vested options, you surrender it, and in lieu of that, we will pay you some consideration. I agreed as an employee, I got that money. When I am surrendering the vested process, it is a right. I can apply for the shares. I can get the shares under the ESOP scheme. But my right I am extinguishing. I am surrendering my right. The surrendering of right is also a transfer within the meaning of section 2, subsection 47. So it is a capital receipt for me. It is a capital gain for me. But the tax auditor is telling no, because the company has paid it, because of the relation, employer-employee relationship, this is a salary. You have to do the TDS on it. The company has not done the TDS, assuming that it is capital gains. Now there is a difference of opinion between the tax auditor and the company. Now what will you do in case of this? Even if you go and meet the jurisdiction assessing officer will also be of the same view. Obviously, this is TDS is required to be done, you are not doing it. Because this is a controversial matter. The only option in case if you are taken any tax position, saying that I will not do the TDS, I will not allow it or disallow whatever it is, you file against that intimation, immediately file an appeal under 246A and fight it out separately. If you keep on, because it may not be within the jurisdiction of 154 for the assessing officer to rectify it. You cannot keep on filing the rectification applications. So there are some judgment which says that in case if there is a controversial, for example, debatable issue, controversial matters and all those things, you cannot finally, adjustment cannot be done on 143.1. And adjustment cannot be done under 143.1 because of the retrospective amendment in the law. You can issue 148A notice and do the reassessment, but you cannot issue 143.1 for that. 26 years adjustment cannot be done now under 143.1 adjustment. So 143.1 we have done, 143.2 regular assessment, scrutiny assessment. When the assessee files a return of income and the assessing officer is of the belief that the income has been understated or the expenses have been overstated for whatever reasons, the assessing officer has to issue the notice under subsection 2 of 143 and do the assessment thereon. When can the assessment notice should be issued? The notice should be issued within a period of 3 months from the end of the financial year in which the return of income is filed. 22-23, return of income is filed in October 23 for company, for example. For 22-23, return is filed during 23-24 within 3 months from the end of the financial year. That is before 30th June, they have to issue the notice and do the assessment accordingly. Now earlier, the way the assessments were conducted it was a different mode altogether. The notices were issued under 143.2. And in response to the notice, if you see the notice 143.2, it only says that your case has been picked up for scrutiny and you should furnish the documents on which you have relied upon for filing your income tax return. There is no list of documents in 143.2. When 143.2 notice is there, I will go and meet the madam and tell that okay, this is the notice I've got, these are the documents, basic documents like income tax returns, tax audit report, financial statements and other things. And if the officer wants any other information from me, they used to ask us there across the table, because there used to be a file and note sheet was to be prepared, and this information I want the details of debtors, creditors, 26 years reconciliation, stock details and other things. I used to write. Madam used to tell me when you want to come back. Madam, next week. Next week, if it is not possible for me, I used to go and meet off Madam. Madam, some more time, maybe another 1 week. All those things are gone now, because I don't know who is the officer, and the officer is also not aware who is the assessee. Because somewhere the tax administration felt that there has to be elimination of physical interface between the assessee and the officer. There should not be physical interaction. So this faceless assessment scheme was brought in 2019. There was a lot of hesitation, obviously, because this is not a effective mode of doing the assessments, and the government has not yet codified it. But there is something saying that blessings in disguise. In 2020 there was pandemic. Either way you cannot go to the department. So the tax authority felt that this is the right time to codify this. And in Finance Act 2021, this section was what, 144B. Now, going forward, the assessment will be done in a faceless manner. You need not go to the office. You do it sitting at your home or office or wherever. So now, how the assessments are being done? Earlier assessment, I know, assessing officer. Now there is an assessment unit, there is a verification unit, there is a technical unit, there is a review unit. All these units are there as a part of the National Faceless Assessment Centers. So what will happen? Assessment unit, National Faceless Assessment Center, is a custodian. So it will issue the notice through the, in case if my case is picked up for scrutiny, the National Faceless Assessment Center will issue the notice to me and also simultaneously appoint an assessment unit and tell that there is an assessee, you are supposed to do his assessment. Once I get the notice and all, I will file a return of income, whatever documents is going on. 142.1, again that notices and all, whatever information is required, assessing officer sends that information and I will give all those information. And in case during the course of the proceedings, if the assessment unit, the office assessment unit is in the sense there is an office of the assessing officer who is doing the assessment. And if the assessment unit feels that they need some verification, for example, lengthy bulky documents are there, it has to be verified, analysis should be done, there has to be summons should be issued, 133(6) and all those things. Some verifications are required to be done. So that matter will go to the verification unit. They want some technical support. There is a separate technical unit for that. All these are done through National Faceless Assessment Center. So the notices are issued, I will reply, it will go to the NFAC. Through NFAC it will go to the assessment unit and they will respond accordingly, I will respond.
We are interacting only with the National Faceless
Faceless Assessment Center, but the notices are issued by the assessment unit through National Faceless Assessment. If you see the notices under 143(1) or 142(1) for asking, it will be, there will be mentioned that assessment unit. And after doing all those things, submission and other things, either the officer may accept my returned income based on the submissions whatever happened, or there may be certain additions. Addition to variations to the returned income. In case if the assessing officer agrees, accept my return of income as such, then no order will be issued and place is closed. But in case of any variations are there, first those variations should be intimated to the review unit. The review unit will see whether what the officer is, assessment unit is trying to propose is right or wrong in the light of the law. And then the draft assessment order will be issued to the assessee before making final, telling that I am proposing to make these variations, additions. If you have any confront issues, please submit. Based on that, they will finish the assessment order. And there is also an option for the assessee to call for a video conferencing. We can opt for the video conferencing and there will be an interaction between the officers. Typically, it will happen only once.
The draft assessment order under 144C.
No, that is what
that is
different. They call it as draft assessment order, but it is nothing but
Same.
Now it is called IAD, sir. Income loss
IAD.
determination.
Okay.
Also,
IAD.
income loss determination. Last 2 days, sir.
So after all, is there any possibility to interact with personally?
We don't know.
No, no, sir.
See, I will tell you, sir.
Even in
Last
video,
year,
you cannot see.
Video conference.
video conferencing also, madam. Last year we have various video conferencing. In 2 video conferencing I have seen, the officer asked me to switch off the video.
Video. We will not show our video.
Officer will also not show the video, his face or her face.
We are supposed to be. We only.
In other cases, officer has also not shown his face. He has switched off his video.
She has to open his video.
He has asked us to close our video also. Don't show your face, I will not show my face,
We don't want to see you.
Otherwise, this is a faceless with face. So that won't be there. So the authority, same commissioner, additional commissioner, deputy commissioners, they are the part of assessment units, review unit, technical unit, and all those things. All communications will be done by the National Faceless Assessment Center. Electronic communication, any notices, it will be issued by the officers, digitally signed, and it will send, the notices will be there on the income tax portal. It will be sent to the registered email ID. If you have a mobile number which is registered, you will get a notification also stating that there is a notice. This is interesting. If you see the provisions of 143.2, 143.2 says that for doing an assessment, the notice should be served to the assessor, meaning that notice should reach the assessor within the time limit prescribed. Now, faceless assessment, most of the notices are done either the notices will be there in the income tax portal, or it is sent to the assessor through email. Let us assume that the assessing officer wants to, the case is picked up for scrutiny for assessment year 23-24. For that, the notices should be served. It should reach me by 30th, before 30th June 24. The assessing officer sent a mail on 30th to my email ID, and it is there on my portal also. I have seen it on 4th of July. Both notices I have seen, mail also I have checked it on that date, and the portal also I checked on the same day. Now, what is the date of service of the notice.
30th only.
30th or it is 4th. I will tell you, see, you cannot expect me to go to the income tax portal.
It's not the viewing, it is the transmission from the
Correct.
system to the recipient system.
So, I am saying there will be definitely controversy on this service of the notice so far because it has been only 3 or 4 years now.
Especially for 148 cases.
This is there. For that we have to see what do you mean by service of notice under income tax, because this is a digital mode of communication. So we have to see the relevant provisions of the Information Technology Act 2000 and see what is the date of service of notice, whether it is the date on which it is entered the system or on the date on which you have retrieved it from the system. Both possibilities are there. So this is one of the controversy. Last year, if I see, the notices were issued earlier, much 1st June, 2nd June, we started getting the notices. But this time maybe because of elections and other cases, there is a delay. But there may be a controversy on this aspect. Certainly.
As this one, ignorance of flies no excuse.
Correct.
We know that this notice will be coming before 3 months.
Correct. But how do assessee know? As a salaried, I don't know. We see, if madam can help us to understand, not even 1% of the cases are put up scrutiny, madam, if I'm not right.
It's not done with this one, sir, caste selection.
Caste selection. Caste
We don't
selection.
have any rule.
Correct.
But compulsory scrutiny selection, the guidelines are there.
Correct.
According to that, we have to put
But the overall selection of the cases, it should not be more than 1% also. How would I know as an assessee my case is picked up for scrutiny?
There are certain parameters.
In case if I know, I will keep on frequently do it. As a chartered accountant, I do it for my clients. But the client themselves, they may not do it. So there are several challenges we have faced it. One is jurisdictional issue. See, whenever we claim any expenses, we generally rely upon the jurisdictional high court or jurisdictional high court decision. But the assessing officer who is sitting, he may be sitting in Jharkhand. I will tell that these expenses has to be allowed as per jurisdictional high court judgment. No, my high court judgment is contrary judgment.
Sir, like that also it will be.
It will be there, it is there. See, actually it has to be my jurisdiction. My jurisdiction only. But there are instances where, for example, ESOP expenses is allowed as deduction based on back on judgment, Karnataka High Court judgment. It was not allowed. It was not taken. We have filed. Categorically we have mentioned that this is the Karnataka jurisdiction high court judgment. So communication also, as I told you, this is not an effective. Video conferencing option is there. Last time also, as I told, there were 2-3 instances wherein what I can speak, as the officer can hear because of the technical issues. But what he can speak, I cannot hear. I was telling and he was posting it in the chat box, his comments. This should happen, but there is a communication barrier also. Submission of books of accounts in case if the assessing officer wants books of accounts, how do we submit it on the portal? If you take this
Why it's the KB.
yes, so there is a size constraint.
Some size.
5 MB.
Yes, and there are standard templates 143.1. Most of the cases it used to come. Large quantum of information would be there. Data upload restrictions. In most of the cases, annexures we have bifurcated into 10 different annexure 1, 2, 3, 4 because of size constraint. So that is there, and there are certain judgments which were there. For example, following the principles of natural justice. If the assessment order was passed without there is a notice and without even allowing the assessee to submit the replay within the time limit, the assessment orders were passed.
Show cause notice come draft assessment order.
Yes.
Rated in the year, sir.
That is the name itself, the show cause come draft.
Come draft.
And there was no, we have the right to apply for the video conferencing, it was not granted. And in some of the cases, video conferencing was granted, but there was no option at all to go opt for video conferencing, and we have, the assessee has claimed it in the submission. They filed a letter telling that there is no option for video conferencing, please allow me. It was not honored.
This video conferencing is through Zoom or?
No, they have some WebEx.
No, that is that Divya.
Divya, sir.
Divya, sir. There,
WebEx is for IT.
sir, they are looking into that entire.
It is not Zoom, sir. They have a separate software. The objections which are filed by in case of the draft assessment order or the show cause notice is issued and the assessee has objected to that, but those are not taken into consideration. These are the instances. Same thing, the assessor was not able to file for video conferencing and all. So what should we do now for this? One option is we have to keep on visiting the income tax portal regularly and see whether there are any notices. There is one software, I'm not sure, Jump or some other software is there, which helps us to see whether any notices are issued. There are some software which are available in the market. We can take the help of that also. But we have to frequently keep on seeing.
Sir, what is the role of CPC? Actually, most of the cases of CPC, there is no question of interaction with them.
CPC unfortunately is not a public officer, they are not allowed to enter inside CPC. Unfortunately, the interaction has to happen either by way of there are some call center employees or by way of.
Okay, because the officer, concerned officer, you say that the post is with CPC.
They tell that now there is an option to get the PAN transfer from CPC to the judicial assessing officer. Rights. Rights of that assessee that can be transferred to the judicial assessing officer and then you can go in with the officer.
Is it
What
mail?
is this outlet?
No, it is there on the portal.
You can ask that.
Yes, there is an option.
Transfer the case to
Transfer the PAN. PAN from CPC to
Only
the
for
judicial.
rectification, sir.
Only for rectification.
Not for assessment.
Most of the cases, they say that the cases with CPC, you can't do.
Yeah, but then the AO can ask mail and next time it will come. We can rectify.
So you can, portal, you can log in and apply that.
That option is there.
That's the
You
same.
you have to give a manual letter to the AO, sir.
Let's-
Think also we are giving letter, but it's not happening in. They say that no, sir, CPC.
Yeah, CPC, they are saying CPC is not transferred. That is the problem. They say,
It
transfer
happens.
we will do.
It happens only.
Where do we go?
There are, so madam, I will tell you the practical scenario. This is also our grievance, madam, to you, we can address this. See, when we have filed a return of income, there is a refund. Startups, we do a lot of, engage with a lot of startups and all. Obviously, in startups, initially there will be losses. And there is a refund. We have filed the return of income and the tax return is accepted as such. 143(1) notice is there, refund is also there. In the intimation, there is a refund. Now there is one more section which has been introduced 2-3 years back, 241A. 241A which says that CPC cannot release the refund directly. Correct me if I'm wrong. In some of the cases, the judicial assessing officer has the right to hold the refund in case if he feels that there will be assessment or any other proceeding which is going on. So the CPC will not issue the refund, they will want the approval from the judicial assessing officer. But that approval is taking time. CPC is telling that no, we have not got the approval from the AO. When we go and meet the officer, AO, because they have other things also to take. When we have met in the month of January, February, and all, they were busy in doing the assessments and other things, and followed by the elections. So eventually, the intimation was issued in November 23. Refund is there in that. We got the refund in April or May this year. There is a lag of 6-7 months. We got the refund. The amount is as per intimation, including interest under 244A. Intimation 244A interest was calculated till November. I have got the refund in the month of May. But 5-6 months there is a delay. I am entitled to interest 244A. That is not happening. I met the officers sincerely told me that, sir, this is even we are not allowed to do any. If you want, so I told what is the legal recourse for this? Should we file an appeal? There is no order, nothing is there. What should we do for this? Because as an assessee, I am entitled for that extra refund. But it is not, because of this reason, there is some coordination, there has to be some coordination between the judicial authorities and the CPC. But it takes time because of their internal priorities.
Because lot of demand
Yes,
cases.
sir.
Every return is processed, so the demand cases are more.
Yeah. And when the assessments are done by this national faceless assessment and all, if there is a demand, the judicial officer has to recover that.
Yeah.
See, assessment, faceless assessment, the case is the assessment may be done by some officer who is sitting in Orissa. He has done the assessment, he has raised the demand. Once the assessment is done, now he is not in the PAN is with madam. He has to collect that demand what he has raised. And if I want to apply for condonation, so stay application and all, still I have to go to madam. And if there are any errors, omissions, it happens so many times. So the return, for example, there is a charitable trust, the income is accepted as such. There are no additions and all those things. But in the tax computation statement, which is attached to the assessment order, section 11 exemption is not given. There is an error which is apparent on record. So madam has to sit and do that rectification now. So all this work is coming to the judicial assessing officer. As a result of that, there is some lag between A1. Otherwise, but the only thing what I can, you should keep on pursuing the matters. You should keep on pursuing the matters. And finally, on some day, you will get.
Sir, I would like to just bring to your attention.
Yes, sir.
About CPC's functioning.
Yes, sir.
This is a recent case, assessment year 23-24. The SSC has filed its return company and eligible for a refund of 1.5 crores.
Yes.
Earlier to filing the return of assessment year 23-24, they had
Demand.
various, they had eligible for a refund
Okay.
based on the return file. And earlier to filing, they had received CPC notices for last 5 years,
Demand.
saying these years
Yes.
demands are there.
Yes.
The SSC has, all the demands have been properly addressed, there were no demands.
Correct.
Filed the reply to the CPC, no
So-
action from the CPC. Then this 143(1) of intimation
Correct.
for
Adjusting that
demand. It has wholesale adjusted. The tax demand was only 40 lakhs. So this is the most interesting thing. Tax demand for all the 5 years was 40 lakhs. The balance 1 crore 10 lakhs has been blindly adjusted against 220 interest and squared up the refund. I'm saying thank you, the story is over. Now what do I do, sir?
Madam.
What do I do, madam?
Addressing this issue, sir.
No, but this is daylight robbery. This is daylight robbery because in the guise of CPC has become a ghost. Oh, CPC. What is CPC? They are just making food of the SSCs.
Sir, take the order to the assistant.
Nowadays, we are becoming so much because of that, sir. They keep every month they
No, but this is
demand
not fair.
verification.
This is not fair.
We have to see each demand. Every demand we have to see.
Very small amount also.
And
No, it's
big
not
demands,
small.
whether assessee is quite a pay or is paid
So since we are talking of assessment, this is what is happening.
Whether recoverable or not recoverable, we have to make in the portal that will go to CPC. Based on that, they will act. So each and every entry we have to see now. Demands, sir.
Before issuing a demand, it will come to you. After issuing.
I sorry to say, I strongly feel the caliber of the people in the CPC are not at a proper level of education.
They are from the same process, that is the software is being there. They are outsourced entirely.
That's
Not
not
also,
problem.
there is no qualified people. If they go to the assistant officer, go to an inspector. Inspector ke niche aate, they are all outsourced people.
Yes.
They don't
They are
know
all
anything. They don't know anything. Even in talk also.
Nothing.
And some.
There is no technical.
Exactly.
This is a live case which I have faced in the last 3 months.
They can hire manpower, more
Yes.
manpower. They should do that because not even 10% of the revenue they are spending for the administration.
Sir, from chartered accountants community and the industry community, we have to make representation to the ministry, and we should ask them to make CPC as a public office. We should be allowed to enter inside that.
Sir, and that in the cases where we made a pre-deposits, they are not even giving hearings, sir. We filed a early hearing petition, nothing.
Sir, that is okay. In the sub case, now at least somewhere you have to file the grievance. Where to go and where to approach which officer.
I think they are said,
Sir,
no,
Look,
it's
city
not
grants,
demand,
In
they
this
have
case,
addressed.
at least we knew the jurisdictional officer, we made our representation, jurisdictional officer understood the facts
Exactly.
and then decided to take action. And today, that refund of 1 crore 37 lakhs and orders year-wise has been given.
No.
It took 3 months to work on that.
CPC is big boss, sir. One way.
No, but actually before they said no, if they have addressed the demand or file reply, they are not entitled to address it.
But that is not happening, madam. That is the rectification of demand is not happening at CPC level.
Not
Whatever resolution CPC is
There is a case which is filed online.
Grievances and all that is not
Not being acted on.
Both the response should
Grievance.
go to them, then only otherwise they are just, it's a time limit they are having 30 days.
No, but we get this one saying your reply has been filed. So then that should be sufficient, no? Then they cannot, unless they say that, it is not accepted, they cannot actually address it.
There is no response from AO or response from the assessee. They are seeing both together and then taking a call.
No, but this was a shocking, 222 interest balance. Just this case and then they had a wonderful case.
They had a target, I think so. They had a target, I think so.
For March, after March was over, they released.
Now I have got the assessment order. Now it has to go to the additional commissioner. Additional commissioner has to upload it. Then it will go back to CPC. I have to wait for 1 month. Then I will write to CP Gram. I am not getting refund. All this is circus.
Some companies who are facing cash funds, cash funds,
No, not cash crunch.
I mean,
This is all, the government is trying to, cheat people. That's all I can say. In the guise of putting CPC and this and all that, you are just hoodwinking us. When I get my refund, I should get my refund immediately.
So that also happens in some cases.
So refunds are issued, sir. In some cases we have got it in 24.
At my team, they are holding.
We can
My team, they are holding.
I we are going to try to pay the fees on. 125 is not a high fee.
So, we are also fed up.
Sorry to disturb you, sir.
No problem, sir. No problem. So another important thing is ensure that there has been you give a proper and detailed reply because as I told you, there is no physical interaction. Whatever contention you have to do, you have to draft it properly and present it before the officer. And another important aspect is whenever you file the reply to the notices, file it on the portal. It may happen that there is a bulky 142.1, there are so many line items and so many documents, details are asked. Our response letter itself will be 10-13 pages. Along with that, there are annexures. For example, 26 years request is there, creditors, details are there, investor details are there, some agreements, other things, all those things we will attach. We will file it in the portal. We should be very mindful on checking all those annexures and all. By mistake, if some paper belonging to some other SS, if it goes, we don't know where it is going. Earlier we have the option of retracting it, taking it, but now we don't even know. So we have to check properly, and the POA should be there. When we have the video conferencing, the officer will ask whether you have particularly the chartered accountants are representing the SSC, they will ask for the POA. We should have a valid power of authorization in our favor. And you should always opt for the video conferencing to make the presentation in a better perspective. And ensure that all the documents are properly filed on the portal. And there are internal SOPs also which are issued to the assessment units. Standard set of processes are there. For example, if the information is already there with the officer, we should not ask that information again to the assessee. For example, tax returns is there already, tax audit report is there, financial statements are also there as a part of the tax audit report. And whenever the adjournment is asked, at least 7 days adjournment has to be allowed to them. So there are some standard set of operating procedures which are given to the officer. But in some of the cases, I have seen 140 to 1 notices, exorbitant notices, 2-3 pages, 5 pages notices. One of the cases, I remember it is of the company, and they have purchased goods. Software company, what they will purchase? More machines, computer machines, laptops, network equipments and other things. So they have asked for the details, invoices of all those things. Obviously, assessing officer has to see whether it is a big company. I don't want to take the name. And they have asked for invoices, all invoices. They have 60 crores additions. Machines are there, lakhs, 2,500 mouse is also there. All invoice copies. And mode of transportation, how we have got it there. Mode of transportation. GSTN number and the GSTN registration certificate of each vendor who has supplied you the goods. Motor vehicle number which has transported the goods. All those things are there. We don't even know whether why it is relevant or why it is not.
Actually, why such things are coming, when the AO makes a questionnaire like that on that, you should verify the assessment's return from 2-3 years. We can make out a bogus purchase case very fast
Okay.
from comparing the return. If it is a bogus purchase, this questionnaire should be issued, but not in a general case.
But in most of the two cases we have
It's an
issued.
established company.
This is an
We have
established.
to identify it from the return and their way they are.
This is a reputed MNC.
Of mind while making the
Very much.
question.
We can identify a bogus return case very fast.
So there are some cases, there will be some cases, but this is a big MNC.
Big case.
Sir, I tell you, all the North Indian cases, maximum are this
Are bogus.
purchase. They don't have any turnover in the previous year, but here they have closed a huge chunk. And the bank accounts also they will produce all transactions in the bank. They claim that the transactions are in the bank
Through the bank.
or bank. But when you ask for the invoice also they give you this. The 3,000, 6,000 invoices they upload. They don't have any problem. And all invoices. And I have done assessment in cases of all this North Indian
Yes, ma'am.
cases,
Yes.
firms, individuals.
Especially from Punjab.
Punjab, everywhere it is.
Steel mills.
Fabric, rice. They are saying they are doing rice, sir, with only five vendors and 5 customers only they have. They are interlinked, simply bogus creating, and all the bank accounts it is routing of fund.
Maybe, but that may be one of the objective. Thanks for enlightening.
Some they have to add 25%. That the GST and registration, they are all doing. That is, they will also register, but they become inactive. Only for purpose of transaction they register. Not that they will. Very interesting, sir. That aspect is.
So after 143.1 we have base judgment assessment in case if the assessing officer issues the notice and you are not responding to the notice. Show cause notice, no response to the notice, then obviously the AO has to do the assessment to the best of their judgments. And in that also the care should be taken depending upon the judicial precedent which is available on the subject matter. The assessment has to be done considering the information which is available with the officer. It may be bank statements, it may be previous financial statements, or it may be tax returns, tax audit reports and all. In some of the cases, the assessee knowingly or unknowingly they have not responded to the notices. But the officer has asked for the bank statement from the bank account number and all those things were there. And in the bank statement there were some entries of 2-3 crores. Those 2-3 crores are taken and added as an income under section 69A, unexplained money. And in some of the cases the officer has asked for the details. For example, there is administrative expenses or professional fees, miscellaneous expenditure. They have asked for the data, assessor has not responded. 20% of that is disallowed. Some ad hoc additions are made. So these things, there are some judgment which says that you should take into consideration the materials which is available and then do the best judgment assessment. Best judgment assessment may be either compulsory or it may be discretionary. Compulsory it will happen only when the assessor is not responding. What to do? The officer has to do complete the assessment now when the case is taken up for assessment.
We try to get maximum information from banks.
Banks.
Then only take.
And in most of the cases, the difference between opening and closing sundry creditors debtors it is added, as I explained.
So in case of this case only, after all precautionary measures they taken, 144 judgment also issued. Assessee will become insolvent. Where they will collect money?
There is liquidation process. Official liquidator will be there. The notices will be issued to the liquidator.
Good old days, GC used to be one criteria. GP
But
analysis.
in case not traceable, assessee is not traceable, that is
If any information is available of the assessee, first the demand is raised and the notices are issued. If it is not possible for the assessing officer to recover, it will be sent to the recovery unit and they will recover it. First set of recoveries are attached to the bank statement, the bank accounts, and take away whatever is there. Then the notices will be sent to the debtors. Book dates, whatever is there, they will send the notice. Whatever amount you have to pay them, pay to us. And then the movable and other removable assets will come. And then in case of a company, there is a possibility of invoking 179 also, if I'm not wrong. Directors will be held in case of fraud cases and all. Even directors, this lifting of a corporate bill and all, directors will be held responsible. The tax department can reach the directors also and tell that why the tax should not be recovered from them. This is a process. And in some cases, even if you file a return of income, all the submissions are made, still the officer can do the assessment under 144 by judgment. In case if they are not satisfied with the books of accounts, the completeness, correctness of the books of accounts, there is no inconsistency in accounting policies and all. If you see provisions of 145 subsection 3, it says that the assessing officer can reject the books of accounts and do the best judgment assessment, even if the assessor has responded to the notices and all. So that is also possible.
To give the reason, no?
He has to give the reasons for it.
Basis of rejection.
Basis of rejection.
When the 144C will be.
144C, what I mean, that is for the dispute resolution panel.
Transfer pricing cases.
Transfer pricing cases.
No, regular assessment, the draft order is for 144C.
So their option is given to the assessee to go to the dispute resolution panel.
Then subsequently the A1 can pass 143.3, I think.
No, yes, depending upon if the assessee may go to the dispute resolution panel, I will cover it, sir. The next section is 144C.
Can I ask for regional language in the case of RIA conference? Local language.
So official language only English we are doing it. For local language, I don't think we can do it.
What's the hearing?
In video conferencing.
Regional language.
No, English. But if a document is given in Kannada or any other language, technical unit will give it to the translators, a separate appointed. They will translate the document. But hearing,
Communication should be there in English because we don't know what is the region of the assessing officer. So 142.1 is again the notices which are issued in case if you not file the return of income, officer can issue the notice. 142.2a subsection 2a, this is for special audit in case if the assessing officer feels the volume of the data and in case of correctness, in case if there is any transactions are there, some specialized transactions and all, the assessing officer can ask the assessee to get the books of accounts again audited. Special audit. Now there has been amendment to the section, this section in last year 23 budget, and now the assessing officer can ask for special audit for valuation of inventories also. It was not there earlier. So in most of the cases, particularly this happens with the trading or manufacturing assessees. The closing balance will be the way the assessing want, they may either increase it or decrease it. But in case if it comes to the notice of the AO that the valuation of stock is not correct, so they can refer this matter to, that has to be done by the cost accountant. So this section has been amended now to include that valuation for inventory is also covered now. 144C, sir was asking, this is for the dispute resolution panel. In case if the assessing officer, whenever the assessments are done either under section 143.3 or reassessment under 147, any assessment which are being done. And in case if the assessment is done for the specified assessee, who is the specified assessee? Specified assessee means a non-resident. If the assessee is a non-resident one, or he may be an assessee who has a transaction with the related party, transfer pricing cases. If the matter is picked up for scrutiny, for example a company, and during the course of the proceeding the assessing officer notices that there are transactions with a related party as defined under 92A, buying or selling of goods, and he feels that this is a transfer pricing matter, and when the law does not tell that you don't have the transaction with the related parties. Only thing is when you have the transaction with the related parties, the transaction should be at arm's length, meaning your pricing should not be influenced by your relationship. So for that arm's length pricing determination and all, that is a separate topic as such. The matter will be referred by the assessing officer to the transfer pricing officer, TPO. The proceedings will be done. After TPO, after doing all this proceedings, there is separate proceeding notices are issued to the assessee. He will go and represent the cases. taking into consideration our benchmarking analysis, the assessing officer may have the separate set of the companies for comparables and all. Finally, he will reject our documentation, the margin what we have kept, and he will arrive at the different margin and issue the send that report to the AO. Now the AO has a transfer pricing report, ALP report from the transfer pricing officer. In this case, where the matter is referred to the TPO, or in case of a non-resident. In these two cases, the assessing officer cannot directly pass the assessment order. He cannot pass the assessment order. He has to send a draft assessment order to the assessing and tell them that you have an option to file an objection before dispute resolution panel. That is a separate panel consisting of 3 commissioners. You have an option, either you go there, because there has to be a mechanism for resolving. This is to avoid the litigation, unwanted, because in both the cases it is a non-resident or transfer pricing. Non-residents are there, at least reputation of Indian tax administration is at stake. So the tax authorities feel that you should be given an option to resolve this matter before it goes to the appellate authorities, and hence you can go to the DRP. When the draft assessment, for example, I am an assessee, I may be a non-resident or a resident having a transaction with my related parties. I will get a draft assessment order from the assessing officer. Now I have the option either to go to the DRP or agree to the draft assessment order. I have an option to file this. I may tell that no, I am filing an objection before DRP. I will go to the DRP and resolve this matter. When I opt for this, till the matter is heard by dispute resolution panel, the officer cannot pass the final assessment order. Or it may happen that I don't want to go to DRP. I will tell that I am not interested in DRP, pass the order. The assessing officer will pass the order accordingly, final order. Now I have the choice either to go to the DRP, or I will tell the assessing officer I don't want to go to DRP, pass the order. Assessing officer will pass the order and raise the demand.
So final order under section?
Say 143.3 or 144, whatever, 147. So he will, against that order I can file CAT appeals.
92 CA order, sir?
This is 92 CA order is transfer pricing.
That's what
She is part of DRP. And nothing to receive from DRP.
DRP will have a separate proceedings. They,
People, simultaneously you can pass the 143 order.
no, he has to wait for the report from the
He has passed the order.
No.
Because assessee accepted.
Because, see, sir, the problem is happening, this is happening in our cases also. When the assessment is done now faceless, and during the course of the assessment proceedings, the TP matter is there, the officer, whoever is that faceless assessment unit. So, NRI case, maybe that assessment officer, assessment unit, he feels that this matter has to go to the DRP. So, he has issued that. When you have to communicate to the officer who has issued the draft assessment order, either it may be faceless or it may be manual. In some of the cases, when the draft order is coming on the portal, but the acceptance is provided, the letter is provided to the jurisdictional assessing officer. That officer is not aware that you are going for the DRP. So he is passing the order. This is happening, it has happened in our case also.
No, see, now it is key. For filing DRP thing, they are not made available the window for the filing DRP.
DRP is manual process, sir. You have to file an application with the officer telling that I am going for DRP. DRP is a manual process. DRP is not at codified, this is not faceless. It is still a manual process. You have to file a manual application before the DRP, jurisdictional DRP. They will issue separate notices. You have to go there and represent the case physically. It was supposed to be done. They told that we will do this also faceless by 31st March 2024. It is not yet done. DRP and TPO both are still manual.
What is the passes the 143 order? What is the tentative point? If the draft order is passed.
30 days. And within 30 days, when the draft assessment order is passed, within 30 days you have to communicate either accepting the draft assessment order or going to the DRP. In case if you accept that I am not going to the DRP or you don't respond, within 30 days, after 30 days you will pass the assessment order, 143. That is a time limit.
Then in the note here, some in the assessment, no, they issued an order under 92. I mean draft assessment order. It is only purely related to TP related. So now subsequent to that, assessment order will be issued under 92 CA or what?
No, 92 CA is separate transfer pricing office order that will be sent to the AO. Taking into consideration, the officer will issue the draft assessment order and give you an opportunity to go for DRP. If you don't want to go to DRP or you don't respond, he will finalize the order and issue the final order.
Okay, if we go for DRP, then we have to wait for submission.
Yes, EO will wait for 9 months,
9
maximum 9 months. Considering the only option of going to the DRP is, see, in case if you don't go to DRP, whenever this draft assessment order is there, you can go to the DRP, or you cannot go to the DRP and ask the officer to pass the final order, and against that you can go to the CAT appeals. So in either case, you have the option either to go to the DRP or to the Commissioner Appeals.
Commissioner Appeals.
And if you go to the Commissioner Appeals, you have to pay the 20% demand.
Yes.
As per the CBDT internal office memorandum. So most of the cases, what happens is instead of going to CAT, let us go to DRP. At least there is no demand because it is still a draft assessment order.
Yes.
If DRP case is not in our favor, we can file directly appeal before ITAT. So dispute resolution panel we have covered. 139.9 in case of defective return, for example, if there is a computation statement and tax paid challan and other things are not there, the income tax return may be considered as defective. You will be given an option to rectify it within 15 days. If you don't rectify it, it is deemed that you will not file the return of income, and all the consequences will follow accordingly. 140 is the section, it says who has to verify or sign the income tax returns, individual, karta of the family, HUF. In case of company, it has to be a director, managing director. If managing director is not there or is not available for some reason, any of the director can sign, verify. Partnership firm, managing partner, if there is no managing partner, any other partner can. This is about only verification. 139 PAN, this is simple, but there is one important aspect here. Who has to apply for the PAN? This is given in the related rules also. It is in most of the cases, in our case it has happened, foreign companies are there. Subsidiaries of foreign companies. Foreign companies, subsidiaries there in India. Invariably, in those cases, there is an Indian director because the company law, there has to be one Indian director. One Indian director, one foreign director will be there. That foreign director does not have the PAN. Obviously, he is a non-resident. He does not have any transactions, neither any income in India. But if you read the provisions of 139 collectively, it indicates that the foreign director should apply for PAN in India. So in case if you have any such instances wherein there is a company and foreign individual is a director, ensure that he has a PAN. PAN Aadhaar linking, we know. Aadhaar, PAN, there has to be a marriage between both of them, it has to be linked. If you don't link, the consequences as if a PAN is invalid. 206 AA and all those things. Recently 31st May date was extended, and refunds are held up, madam, in case this PAN Aadhaar linking is not done, refund are held. And in non-residents are there who are Indian citizens but residing outside India.
That they have to wait, write a mail, sir, they only update the PAN, edit that.
That is possible, madam?
Yeah. For them it is separate, edit the PAN.
So this was PAN Aadhaar linking and all, and that's it. We have covered section 139 and 134, 144B and 144C. In case if you have any other clarifications, if you have any other things to discuss, you can enlighten me.
So after submitting all the documents, also we are not able to satisfy the officers, what to do?
Wait for the demand.
The officer will finalize the assessment.
They are adding and leaving. But we should be very judicious, sir, to do the order. I will not, I am not personally, we have to see what.
Only option is
Not
to
add.
take it to the higher authorities. appellate authorities will find it out. Somewhere at some level, if you have the genuine case, we will get
Sir,
it.
what we can do, sir, this early hearing petition, I mean, early hearing application. Even CBDT member also can not able to answer, sir, this question.
Nobody is. CIT appeals, we have, recently we had an option to meet the members of the attendant. It was told that there are only some 2 months or 2.5 months cases now with the attendant. All the cases were disposed because appeal matters are stuck in CIT.
What they do, sir, they're sending it to AO only. Do again. All the set again going.
And now there is a
We have made a certain pre-deposit and we are waiting for a commissioner appeals. Cases, no? We filed a AO also.
sir.
TCA is right in the first.
So now there is an additional charge given to the joint commissioners for hearing the appeal matters. In spite of that, there are most of the cases which are stuck with CIT. ITET cases are coming to end maybe another 2-3 months. And we are filing for early hearing, out of turn hearing and all, but nothing is on it as such. Thank you, sir. Thank you so much for your patience. Thank you, sir.
Thank you for the wonderful session. On behalf of ICA Bangalore Branch Managing Committee members, ICA Chandra Prakash, thank you for the wonderful session. I invite our Chairman, C. Pramodar Hegde, to present a memento to the Speaker as a token of appreciation. Thank you members for the active participation. We'll meet for tomorrow's session. Thank you.
Good evening everyone and welcome to today's session on Revisit Income Tax Act, which is on liability in special cases, which is trust, legal representatives and legal heads. So we have Dr. C.A. Palgun Kumar from Tirupati to address us on this matter. I request our Chairman Pramod to escort the speaker to the dais and greet him. So welcome to you and thank you for coming all the way from Tirupati for us. It's an honor to introduce Dr. C.A. Palgun Kumar to all of you. He is MA, MCom, MBA, BL, DISA, PhD and a member of Company Secretary, also apart from being the member of Institute of Chartered Accountants. He is qualified as Independent Director also. He was appointed as a member of studies, Board of Studies of SV University and SP Mahila University for the year 12 and 14. He presented more than 500 technical papers in income tax in the past various CPE seminars in all the 4 states of South India. On GST, he has delivered more than 50 lectures across South India. Most of his video lectures are viewed in YouTube. He got his doctorate in accounting and auditing standards for non-profit organizations from Sri Venkateswara University, Tirupati. He is serving as a trustee and executive member of several charitable institutions at Tirupati. He was a member of Southern India Regional Council and he was the chairman of SIRC in the year 2016-2017. He is appointed by CBDT as a member of AP State Regional Direct Taxes Advisory Committee for 23-24 and 24-25. He is practicing as managing partner for 45 years in E. Palgun Kumar and Co. Tirupati. So it's a pleasure to have you here. Thank you for being here, sir. So over to you, please.
When he comes, great inform. So, what all the tips I am giving our staff? Om Namo Venkatesaya. Esteemed Chairman, Chairman Pramod Parakde, Secretary Kavita Ramesh, executive members of illustrious Bangalore branch, and attendees. As we all know, in India, for more than 150 years, the Income Tax Act is prevailing. If you have changed the size and shape over the years, the present 1961 Income Tax Act has replaced the earlier 1922 Act. The primary purpose of this Act, as we all know, right from the days of Chanakya, collecting the tax on income. Now, for collecting the tax, levy is first part. Second, computing, collating and computing is the second part. Third part is determination and collection of tax. So, the Income Tax Act primarily is having the charging sections, the general charging section 4, scope of total income section 5, based on the residence section 6. Then section 9, the deemed income is there. Section 10, exemptions, and a special exemption chapter 11, 12, 13, which has become much complicated nowadays. Then all the 5 heads of income. The income will be computed under the 5 heads. The total income, gross total income, with the deductions under section 80, we have total income. On this total income, tax will be levied, calculated. 2 types, partly the Finance Act levied tax, partly the rates fixed in the Income Tax Act itself. Then collection. When we come to collection, as we see the reality now, almost 90% of the direct tax is by way of advance tax and TDS. The remaining only due to assessments and then collection. Now, leaving apart the TDS chapter, which is a code by itself. Section 11, 12, 13 exemption is also a code by itself, nothing to do with 5 heads. Similarly, TDS also is nothing to do with these heads of income. TDS chapter itself is a code by itself. One need not be an assessee. Even then TDS he has to comply. So like that, the TDS itself is a code by itself. Then who are liable for a tax above the threshold of say 10,000 rupees? They should pay advance tax. Now, the question comes, whoever is liable as per the Income Tax Act should voluntarily comply these provisions of the income tax. That means they cannot expect a notice from the Income Tax Department. They cannot expect a message from the Income Tax Department. They have to ascertain their own liability. They should comply the law. If at all they have to pay, they should pay. So this everything is warranted. No question of expecting any communication from the department. Now, is it possible? Generally, it is not 100% possible. For a businessman, he knows that he is liable to pay income tax. He will consult a tax practitioner. Whereas others, a normal person, a housewife, let us say, she gives her land for a joint development. So before giving the land for joint development, she should consult, is there any income tax liability? Is there any GST liability? When? How? Unless she consults, she may not be able to know. Unless she knows, she may not be able to comply the law. So like that there are several circumstances. Leave alone the persons who earn the income, who get the income, direct income or indirect income. Now, Income Tax Act has conceived other situations where it is somebody's income, still you are liable to comply the law. That chapter is the chapter given to me for deliberation for these 2 hours. Around 1.5 hours I will deliberate and I will ask you to have interaction. So this chapter itself is not your income, it is somebody's income. But you have to comply the law. Your income itself, knowing and complying is such a difficult thing, or say it needs a professional advice, then it is somebody's income, but you have to discharge the liability. So this is a separate chapter in the Income Tax Act. This chapter is given to me. So, what for this chapter is there? Because practically sometimes the department cannot collect the tax from the same person who earns the income. Situations may happen, different types of situations. All those different types of situations we are going to deal today in the brief time given to me. It's a very vast subject, but even then one has to know this, because for practitioners, you are a practitioner, 95%, 99% of the cases, those whose income is there, they will come to the practitioner, they will file the returns. 90%, 99%. Others' income, please, I want to file. Such cases will be 1, 2, 3, maximum 4%. Maybe once in 10 years, once in 15 years only you will get the cases. Day to day you will not get. Day to day, whose income? That fellow will come. Where it is a limited company, where it is a partnership firm, where it is an individual, you will file the returns or say comply the income tax law. Whereas for others' income situations. So the first section here is section 159. 159. This first section in this chapter is known as a legal representative. In the society, we hear the common word legal hair. What is the common word legal hair communicates? Can you please tell me, sir? What do you mean by legal hair? Generally we use this word now. What do you mean by legal hair?
Children.
Pardon?
Children.
Natural. So there is a common meaning that if a person dies, his children, not only children, if he is survived by his wife also is legal hair. So we come across with this general meaning the legal hair. But the Income Tax Act has not used the word legal hair. It used the word legal representative. What is the difference? We should know. So, the legal representative means a person who represents the estate of the deceased is the legal representative. So we should be very, very careful in understanding this word. I will give you 4 or 5 examples also, how critical it is to understand. I repeat, section 159, legal representative means, legal representative is the person who represents the estate of the deceased, is a legal representative. He is liable in the like manner to the same extent as the deceased has not died, has he been surviving. Whatever is the liability of the erstwhile person, is the liability of the legal representative. So, here, the legal representative has to, or say, we will envisage 4 conditions, 4 situations. Number 1, on the deceased, already income tax assessment proceedings are there. That means a scrutiny assessment is going on. Legal representative died. The person, the assessee died. Assessee died. Then the income tax department need not start afresh. Already reopening 148 notice is given. Already 263 revision notice is given. Already some tax dues are there, recovery proceedings are there. So already something is going on. At that stage, if a person dies, that is the first situation. In that situation, the legal representative liability is to continue those proceedings. So he has to continue those proceedings. It is his duty. So this is the first situation, that the legal representative shall continue the proceedings already initiated under the Income Tax Act. This is the first situation. Second, the person who died was not an assessee, was not touched upon. There can be a situation, nowadays the Income Tax Department is having risk management system. See, 360 degrees of insight of a person. So 4 years back, 5 years back, he sold for 1 crore rupees a site in Bangalore. So he sold the site. He was never an income tax assessee, and he died. Now the department, due to this technology, has found, oh, a person with a PAN number died, he never filed the return during his lifetime. Even the department is not aware he died. Because 5 years back, 4 years back, he registered the document, and now only department, based on that PAN number, wants to proceed. Second situation. So even in this situation, how to proceed, what are the limitations, what the law says, all these things after some time I will take. But I am trying to tell you the ground reality, this section to whom it will apply, in how many different circumstances the section will apply. The first example I said, on whom he is already assessed for several years, suddenly he died. So his assessment, some assessments would have been under scrutiny, some assessments would have been reopened, something commissioner has reopened, revision. So at the time when he died, first situation, his legal representatives have to continue the proceedings. Second situation, never he was an assessee. Never he was an assessee. But now the department wants to issue a notice and then recover the tax. By the time the department gives the notice, already first notice it gives saying that 5 years back you sold the property, you are not paid any capital gains tax. Please, 5 years back in our bank account 1 crore rupees cash deposited, withdrawn. We want to say that it is an unexplained source. Come on, it is income escape. 148 capital A small b notice. So what the department will do first instance, in the portal that the PAN number will have some address, to the address a notice will be given. Then the persons who are there in the door number, by chance if some family members are still surviving and are there, then they will try to address this problem. This section covers all such things. Third, already assessments over. In the first appeal stage, the assessee appealed, first appeal, then he died. Or first appeal he could not succeed, second appeal he filed to tribunal, then he died. Then, or first appeal he succeeded. Department filed a case against him in the second appeal. After department filing the second appeal in the tribunal, this fellow died. How the department can proceed further? How to complete the case and how to recover the tax? This section addresses such situations. Third situation I have given. Last situation. Already department assessed the income, determined the tax, and it is about to recover the tax. No disputes in the appeals. It is about to recover the tax. At that time he died. Normally, as we all know, here some senior members are there. Normally, as we all know, ownership of a property for a second will not be with the owner. I am making a statement. Ownership of a property will not be in vacuum even for a second. Even if the owner dies, owner of the property dies, the next second automatically somebody will be the owner. Who is the owner? That is the second thing. Ownership is always attached to the property. But the liability, the income tax liability automatically shifting. That shifting of liability enabling provision is this 159. The shifting of the liability is enabled by this 159. So 159(1), legal representative is that person who represents the estate of the deceased. So, if a person, and it says, such a legal representative is liable for the tax interest penalty as if the deceased is liable, the legal representative is also liable. This is the enabling provision, section 159(1). Then, the department, how it comes to know of it. For example, my father was never an income tax assessor. As I gave the example, my father in Bangalore city, 5 years back, sold 1 crore rupees worth house site, the only house site. He died. When he sold that 1 crore rupees, he gifted to all the children. And then, say myself, I was taking care of my father because of his old age. And after selling 3 years, he died. Now the department issued a notice. In the name of my father. How it has come to know? To the sub-registrar office, the information will go to the income tax portal. Is this pawn number assessed? No. Then they will issue a notice. Now, in the same address, I am there. Say for example, my father was not the owner of the house. I am the owner of the house. But father was living, so pawn number while giving my address only is given. So I received the notice, let us say. Nowadays, electronic notice, 90% deceased's electronic notices will not get responded. 90% practical. For a person who died, they gave, keep quiet, let them do what they want. Now, common man thinking, he is no more, why should I worry? So that is common man's thinking. Now, the definition what we have seen, the legal representative, what it says? Legal representative is a person who represents the estate of the deceased. When my father died, what do you mean by estate? Estate is not defined in the Income Tax Act. There was a Estate Duty Act which was abolished in 1985. Estate Duty Act. So estate is not defined. Then you should go to the normal meaning. Estate means the property whether movable, immovable, left by the deceased is otherwise known as estate. At the time of my death, my father left nothing. He sold for 1 crore 5 years back. He distributed it to his children, gifted. On the day of his death, except a watch like this or 4 pairs of clothes, nothing is there of his own. What estate he has left? As a son, I told you, by definition of legal heir, I am his legal heir. By definition of legal representative, I am not his legal representative. Because my father left no estate. So department cannot proceed against me unless the department inquires, finds any property left over by him, bank balance or some immovable property. Nothing. If nothing is there, department cannot proceed against me. I am trying to still give already decided cases some complications. For example, my father had 5 sons. My father sold 5 years back 5 crores worth of house site. My father sold 5 crores worth of house site. And I am the last son. For all my elder brothers, 4 brothers, he gifted 1 crore, 1 crore, 1 crore, 1 crore. The money he got as sale proceeds. So, the last 1 crore, he said, you are my last son. You are taking care of me. This 1 crore I want to give to you. I said, it is not fair now itself to take 1 crore from you. You have this 1 crore in your name. You have this 1 crore in your name. You give nomination to me. And write a will also to be on safer side. In that will my father wrote, I earned something, I retired as a person, I got only 1 site, that site recently I sold for 5 crores. I gifted to my first 4 sons of 1 crore each. The last 1 crore I kept in my name in the bank as FD. Through this will I am saying, after my death, this 1 crore shall go to my last son only. Nobody else has any right. I am writing this will. He registered this also. He died. Now the department, after his death, has come to know that he sold for 5 crores. He never filed any income tax return. He never paid any income tax. Now the department issues a notice in his name. I will promptly, as a good citizen, say, you issued a notice in the name of my father. My father died. This is the proof, death certificate. So, I am bringing this to your information. Then what the department should do? As a normal person, what you do? I think some department officers are there. What you will do normally?
Legal help will be taken on record.
The department officer will send his inspector, try to inquire. Deceased in this door number, with the local municipal authorities, with the local authorities. If he has tried, who are his legal heirs? Right. 5 children, 1 in Delhi, 1 in Bombay. The only unfortunate fellow, 5th fellow, myself is there in the same door number. All the 5, they will collect. After collecting, what they should do, madam? Department should do.
Take them on record and start proceedings.
So all the 5 legal heirs they will take. Normally what happens, she is saying 100%. Normally all the 5 sons names they will take and issue the notice to all the 5 sons. Now you should tell me, My father died. Before his death, he sold the 5 crores of his property. Long-term capital gains, 1 rupee is not paid. He is not aware of, let us say, for his knowledge, he was not aware of the income tax. Nobody asked, nobody. He sold. He gave the first 4 crores for 4 sons each. And only left the will, last 1 crore to me. Now department gave to all the 5 persons. It is the duty of the department. It is the duty of the department. Please be reminded under this section. Department shall give the notice to all the legal representatives, not the legal heirs. I made the distinction clear. Legal heirs means physically the lineal descendants normally along with spouse are the legal heirs. The word legal heirs differs from caste to caste, or say religion to religion. This you can put here. This speaker, can it come down? Huh? Sure. Please. You know what that is. Okay? That's it. So, the department gave to all the 5 sons, but actually as legal heirs, I told you, the Income Tax Act has not used the word legal heir. It gave the word legal representative. The definition of legal representative is there in section 229 definitions of the Income Tax Act. The definition 229 refers to section 211 of the Civil Procedure Code. So the Civil Procedure Code 211 defines, that definition is only borrowed here. That is the person who represents the estate of the deceased. Now you tell me, I gave the practical situation, you tell me, the first 4 sons, are they representing the estate of the deceased?
No.
No. No. Anybody else? Only 2 are saying no. First 4 sons, are they representing the estate of the deceased? No. So they will go to a proper consultant, they will say, sir, no doubt we are the children, sons of deceased father. But we have not inherited anything. We have not got any estate of the deceased. So, your notice is invalid. We will not pay anything. Actually, they all shared 1/5. But they will say, legal representative. No, we are not liable. They didn't say share or give nothing. Hariya, your father registered a will. When we ask the 5th son says, all the 5 equally got the money. Why you only ask me the total tax? You ask all the others also, they too shared. Through bank only, my father transferred, they are all elsewhere. They have no gratitude. They shared the money. All these halakulla words, law, what it says. The tax of the deceased shall be discharged by the legal representative who represents the deceased. So the 5th person. So it is the only 5th son shall bear all the 5 crores property, capital gains tax with interest will be more than that 1 crore. It will become 2 crores. The 2 crores, this 5th son only has to bear as per the Income Tax Act. Number of court cases, decided cases I studied and I am telling you. I dealt myself practically. I represented before the tribunals and argued and got the decisions also. So the law is like that. Now, this 159 applies only to a physical person's death, and you may be aware that death of a natural person in India transfer the property of the deceased as per his personal law. For example, if the deceased is a Hindu, if he dies intestate, the Hindu Succession Act 1956 will apply. If the died person is a male, Section 8 of the Hindu Succession Act will apply. If the died person is a female, Section 14 of the Hindu Succession Act will apply. How the estate of the deceased will pass on to legal heirs is there in the Hindu Succession Act. If the person died is intestate without writing a will. If the person, though he is a Hindu, writes a will and dies, then as per the will the property will go. Succession Act will not prevail. First will prevail. The will is decided as per the Indian Succession Act 1925. The will prevail. Will provisions will apply as per the Indian Succession Act 1925. Now, the 159(6) says his liability, the legal representative liability, is restricted to the estate he got. I am giving you the examples. For example, the illustration I gave, my father sold for 5 crores the property, left the will for only 1 crore which he was having. By will I got that 1 crore. The interest month to month he is withdrawing and using for his expenses. So my liability is restricted to that 1 crore, though the income tax liability may be, tax, interest, penalty put together may be 2 crores. But my liability, I may be worth 10 crores. That is a different matter. I may be worth 10 crores, not my capacity. My liability shall be restricted to the estate I inherited. My liability shall be restricted to the estate I inherited. That is possible. There is one more clause in between, 159(4). 159(1) says the total liability of the deceased shall be bound by the legal liability. It includes the word tax, interest, penalty. Whereas 159(4) says the tax liability shall be restricted to the tax only, not even the interest and penalty. And the last word is whether the legal representative is liable for prosecution. If the deceased has done something which is 276 capital C, prosecution liable. Whether the legal representative is also liable for prosecution? No. Prosecution is a personal affair. So deceased died, there ends the matter. So the penalties also normally need not be faced. Because in which circumstances what they have done, the penalty person should defend. Here is no more. Though the act says his liability, the representative is liable. So 159(4) restricts the liability to the tax portion only. And this 159(6) further restricts to the estate he got. Further limiting down. I got 5 crores. My father's liability is only 2 crores. I have to pay the 2 crores. But whereas I got, now the question comes. By chance, there are 2-3 legal representatives. The first legal representative only is financially sound. So the first legal representative meets the total liability. Whereas deceased's estate was shared by all the 3 equally. If the deceased has died intestate, that means without writing a will, normally the 3 sons are there, let us say. So deceased property equally will go to all the 3 sons, no? So this is as far as the Hindus are concerned. So this is a, for your information, if a Muslim dies, his children, sons will get double the share of the daughters. That is the Muslim Shariat law. If a Christian dies, wife will get 1/3, children all will get 2/3. It is a personal law. So how a deceased's property will go to their legal heirs is a personal law. So generally I give quotation of Hindu Succession Act quotations. So a Hindu died, he has no wife, let us say. His 3 sons will share equally. That happened. He died 5 years back. Sons shared 3 years back. Now the department issues notice to all the 3. The other 2 say, we have no properties. Now we cannot pay even rupee. Department cannot recover. But it can recover from the first son, though he shared 1/3, the total tax liability. Then what is the position of that 3rd son? 3rd son under civil law must file case against his 2 brothers. Arey, your tax liability also I have paid. Department recovered. You pay 1/3, you pay 1/3. So decree, after decree 12 years, by chance if they earn something in the future, then the decree can be executed. This is how they recover. Leave over. So this is the, in nutshell, I told you what this one section 159, very very important section, first section in this chapter.
So that in the illustration is told that 1 crore last person. If it is amount utilized for the purpose of hospital expenditure of deceased, that being the case what?
If you see, to the extent the estate is represented, inherited by that son. So on the day of death, whatever is his estate, you say for the deceased health expense itself he has spent. That means he can recover from his estate. After his death, had he recovered, to an extent his estate will come down. The remaining estate only is liable. That's how we have to interpret. Okay. So.
But the tax will be done on the entire that 1 crore, sir.
Yes.
Liability.
Restricted, maximum. So the legal representative, I am continuing. Any person cannot die on the first day of the assessment year or say first day of the previous year and the last day of the previous year. Not possible, no? Normally people die in the middle of the year. They cannot die on the first day for income tax computation sake, they cannot die. So a person died in the middle of the year, someday. Now the legal representative's liability, up to which date? Up to the date of the surviving. You please understand. The legal representative shall file the return of the deceased. I will give 2 examples. A person died on June 14th. My father, I should not give some other example because this class is to kill so many people so many times. So my father died on June 14th. He was having taxable income. He was filing the returns. 23-24 estimate year return is filed. But 24-25 he could not file. Why? Up to July he thought time is there. Now June 14th. He credit the packet. Now as his son, what is my duty? I must file his return. If self-assessment tax is due, I have to pay. So for 24-25 estimate year I should file the return by July 31st, number 1. Number 2, for 25-26 assessment year also, he lived from April 1st to June 14th. That much income also is his income. That much income also his income. If it is liable for tax, legal representative shall file the return and discharge. Now after this date, from June 14th, June 15th, June 15th onwards, it is my income. My father's estate will mix with my property. If I am the only son, let us say 3-4 people are there. Those situations are dealt in 160, 161, 162, 168 in this chapter. The Income Tax Act has dealt with this. What is this? For example, my father had 3 sons, 2 daughters. 2 daughters already got married, they are having children. 3 sons, 2 daughters. Now, my father left so many properties. Normally, when properties are more, what the old people will do? They will write a will. My property 1 shall go to my elder son after my death. My property 2 shall go to my second son. My property 3 shall be sold by my brother-in-law, whom I am now appointing to sell the property 3 and then realize the money and from that money he should pay to my daughters 50%. Then property 4 shall go to my third son. So like that a will be written, no? Normally when properties are more. Then the will, again 2-3 possibilities. Though we are 3 plus 2, 3 sons, 2 daughters, after his death seeing the will, he will keep the will secret. You all know about the will. The Registration Act gives 2 options. A will can be registered by the person who is the executor, open document. Possibility 1. Possibility 2. The will can be put in a sealed cover. Will can be deposited with the sub-registrar. The will be opened and registered only after somebody producing the death certificate of the executor. So my father, as an intelligent person, put this in a sealed cover, deposited the sub-registrar. So the sub-registrar shall open this and register this only on production of death certificate in presence of 2 witnesses. Then 2 daughters, my sisters. My brother, when my father has no brain, got this will executed. This will is invalid under coercion, under duress. So this will is invalid. File a case. Let the brothers come. Normal in the society. Now the Income Tax Act shall keep quiet till this dispute is settled. Why I give this example? The income tax sections deal with all these situations. So, the deceased died. But deceased property, possibility A, some executor, the person whose name is mentioned in the will, is managing the assets and discharging the liabilities. Normally, not only assets, some liabilities also will be there, no? Then, in my will I will write, you sell some property, whatever the liabilities are there, you discharge the liabilities, the remaining money you distribute to my legal heirs. That's how we write the will. So it is the duty of the executor to file the returns of the deceased, not only up to the date of death of the deceased, but after the death of the deceased also, till the assets are distributed properly as per the will. It is the duty of the executor. So, before the executor as per law has to take possession of the assets within 6 months from the date of the death. Within 6 months the executor is not taking the possession of the assets and trying to put into operation the terms of the will, then executor is no longer valid. Then, as I told you, the sisters have gone to court. Court will appoint administrators. The person whom the court appoints is otherwise known as administrator. It is the duty of the administrator to file the returns. The executor or the administrator should take a fresh PAN number as per the terms of the sections. They should take a fresh PAN number as a representative SSC and shall file the returns for the income. Because the executor, when he comes to the possession of the property, the tenants have to pay the rent. Arey, you are paying to me as executor. My PAN number is this. In this PAN number, get the TDS. They have to comply. Then executor has to file the returns. So, if the will nominated persons are there, they are executors. If the court appointed persons come to know of this property, take the possession, then they are known as administrators. These sections deal with, this chapter deals with not only the legal representative. Next section with the representative SSC, which we are going to see. So the representative SSC is section 160. The executors' duties and liabilities are there in 168. In 169, rights of the executor are also there in 169. So the, for example, as I told you, the SSC filed the appeal and then died. Then he gave the wakalat to a chartered accountant. Though the deceased gave wakalat and the appeal has come for first hearing, then the SSC died. Then what the chartered accountant has to do? He cannot continue the proceedings. His wakalat comes to an end. The moment the person dies, his power of attorney becomes 0. Then his legal representative should file fresh form 35 if it is first appeal. File fresh form 36 if it is the second appeal in tribunal. Legal representative should file. Legal representative should give the wakalat. Then only the proceedings can continue. And I have to say, without these legal proceedings, by chance the income tax officer assesses in the name of the deceased, that assessment is null and void. Appeals commissioner disposes the appeal, that appeal order is null and void. On the name of the deceased, appeal filed by the deceased, but appeal when it is decided order has come, is no more, then that order is invalid. Similarly the tribunal order also. So these practical things also please keep in mind. And then the notice to the deceased is invalid in all circumstances. Notice in the name of the deceased is invalid. Then how the officer to continue these proceedings shall give the notice? The officer shall give the notice to the legal representative. First line should be the legal representative name, PAN number shall be the legal representative name, but below that representing as LR of the deceased X, Mr. X, then only that notice is valid. Normally officers do ulta. Deceased's name first, represented by LR, surviving person's name, second name. Notice also should be proper. Notice should be given to the surviving person who is the legal representative, representing the deceased. That's how it should be given. Unless the notice is proper, total assessment is invalid. There are several decisions, assessments after completion of the assessments, because the legal heirs will not properly communicate. As they are giving the response, produce the books, deceased's books, somebody will produce. Officer taking the books of accounts, he will pass the order. In the appeal also, they will forget to tell. So, the chartered accountant, when the deceased's children are communicating with you, you think the deceased is surviving, and you represent the case. Case is heard, order is passed, but invalid. Because after the death, the order is passed. Department will say, no, it is invalid. So, one should be very careful in all these things. So, I have given you the latest case also, 2023 decided cases, wherein during the assessment stage or during the appeal stage, if notices are given to the deceased, the department cannot say, my notice is invalid, I have given to the deceased. You as his son represented before me, no? Department cannot take shelter under 292B or 292BB. That notice is valid. What the section 292B, BB, what they say? For even a defective notice, if somebody gives response, the defect is rectified. That plea cannot be taken in the case of the deceased. This is the importance of this section. So, these are the later number of hundreds of decisions are there. I gave only 2 decisions for your reference. So, this is this thing. Then, liability of the representative assessee. Who is the representative assessee? Section 160. Who is the representative assessee? First I gave you 159. Legal representative LR. Now I am putting the second situation. Representative assessee. This is not equal to 159. 159, a natural person if he dies, who has to represent, that is the legal representative 159. Whereas 160 deals with representative assessee. In several situations, the assessee who gets the income, he cannot be proceeded. He cannot come before the department. For example, non-resident. We are having in the TDS sections one section 195. What is that 195? If any person, Indian resident, dealing with a non-resident, making any payment, he must deduct the tax as per 195. You please see. If any Indian resident dealing with any non-resident making any payment, that payment must be subject to TDS under section 190. Normally as practitioners, you will come across a house site in Bangalore owned by a software engineer. Software engineer's father, sir, software engineer's wife, sir, we want to sell this house property, brokers. Anybody is buying. What the buyer should think of first when entering the agreement itself? The seller is he in India. And he will come and go, sir, for registration. Cannot come and go. He will be a non-resident, even if he comes for 20 days, 30 days and then goes after registration also. Because the buyer should be aware, he is dealing with a non-resident. You should deduct even if it is long-term capital gains in the hands of the non-resident. 23.2% TD is unallowed 195. So, the Indian resident who is buying shall deduct that 195 TDS. That Indian resident is otherwise known as agent, representative associate of that non-resident under section 160. Under section 160. So, the representative associate refers to different situations. A minor is there. Normally, under Minor Guardianship Act in India, up to the age of 5, for any minor child, mother is the natural guardian. After 5 years, depending upon the situation, either of the parents can be guardians. So, during minor's income normally get clubbed with the parents, whoever is the highest. For example, both the parents are not there. That boy has become an orphan but got lot of property, lot of income. Then normally father's side grandparents or uncle, they will become the guardians. If nobody is taken care of, somebody else can file a case in the court, court will appoint a guardian. So that guardian is liable to file the income tax return, discharge the duty of this minor income tax liability. Similarly, court appointed receiver, I have already told you, court appoints receivers in another circumstance also. If I as a natural person, my liabilities are more or my assets are less. My liabilities are more, my assets are less. Then what I will do? I will file an insolvency petition in the court. Court, what it will do? Court will appoint an official receiver. That official receiver will take possession of my assets, realize the assets, gross receipt minus realization expenses, whatever is the net money, that money maybe 50 paisa for 1 rupee, my creditors, my loans, he will try to distribute. So during that period, my asset, if the official receiver is selling, official receiver shall pay the capital gains tax, file the return. So these are all the situations covered under section 160. So under section 160, representative associates shall discharge the liability in the same like manner and to the same extent as if the original person was liable for all the provisions under the 5 heads of income. This income shall be computed. Another situation, trust. As we all know, in India, broadly, trusts are 2 types. Public trust, private trust. Public trust means the beneficiaries of the trust, the benefits of the trust are enjoyed by unknown, unidentified, unknown is not correct, unidentified persons. So, public at large, if the benefits are enjoying, the trust is known as public trust. Identified people are enjoying, then it is a private trust. So, trusts are 2 types, public trust, private trust. The trustees are the representative associates. Trustees shall discharge their duty. Here it is written. Normally, as I told you, section 11, 12, 13, religious and charitable institutions exemption, the separate code by itself, I told you, chapter 3 of the Income Tax Act. But there also, trust is liable, they say. Trust, how it can discharge its duty? Through trustees only. Trustee shall file the return. Trustee is representing the trust. So these trustees are representative associates. Their duties, their liabilities are mentioned in this section 160.
All trustees are equally liable?
Yes, all trustees mean trustees who are in possession of the property of the trust. Trustees who are dealing with the money of the trust are liable. There may be some sleeping trustees who are not dealing with the money of the trust. Then we cannot hold them responsible. So actually, if you designate a managing trustee, or if you say some trustee is having the check power, that person is primarily liable. So who is dealing with the money, who is dealing with the property, that person is liable. We cannot make all the people equally liable. Similarly, liability of the representative. So duty of the representative, see section 160 we have seen. Next 161 we are seeing liability of the representative assessor. So liability of the representative assessor in the like manner and to the same extent as we have seen in the section 159, he is liable as if the original person whom he is representing. To that extent the liability has to be discharged. And then 161 1A exception. Actually, the trust can private trust, let us say. I am aged person, but I got at my later age only one son. My wife died, let us say. Now I know my days are nearing. Then I will write a will saying that I am leaving behind my minor son who is 10 years old. I am appointing you, Mr. So and so. Say, let us say my brother-in-law. You, brother-in-law, you be the guardian of this son in case I die. As a guardian, you take possession of my properties. You take monthly 10,000 rupees for your expenses. The remaining income you accumulate. Meet the minor son's education expenses, necessary expenses. Only after he becoming major, completing 18 years, only after he getting suitably married as per your liking and his liking together, after his marriage also, when he gets a first child, then you hand over this property to him to be dealt by him as he likes. What I have written the will? I have written the will in such a way that my brother-in-law is a trustee. What do you mean by trustee? He cannot be the owner of the property. He is only safeguarding the property. He is discharging his duty like this. He as a trustee also, private trustee, liable to file the return, pay the tax. This is there in this section. So the Income Tax Act has envisaged that private trustees also are liable. Now there are 3-4 possibilities. I have 3 children. All the 3 are spastic. Though they are majors, they are not having sound mind. Then what I have to do? I appoint 2-3 trustees, 2-3 people, because there is no guarantee that only one person for their life. 2-3 trustees. Then, if 3 trustees are there, what will happen? Possibility 1, possibility 2. In the first example I gave, I am having only one son and total property shall go to him. Then the trustee shall take a new PAN number and trustee shall file return on behalf of this minor, who even after he becoming major, because he is not having any in his capacity. Unless he gets married, unless he gets a child, begets a child, he will not become the owner of the property. So my brother-in-law will continue to be the trustee. So as a trustee, as an individual capacity, taking a new PAN number, shall file the returns and discharge the income tax liability. Now if appoint 2-3 trustees, number 1. Number 2, these 2-3 trustees also at 2-3 different stages. That means after some time some property you give to somebody. So like that, permutations, combinations are all possible. All these situations are taken care of in the Income Tax Act. They say that so long as the property is in the possession of the control of the trustee, trustee is responsible. By chance the trustee or the executor, say in the other example of an individual dying, the property is given to one of the legatees. From the day the property is given to legatee, legatee is individually responsible for that income to file the return. To the extent it is there in the hands of the executor or the trustee, trustee is responsible. So like this, different things are given. Say for example, in the case of a insolvent person also, the official receiver appointed by the court is a artificial juridical person. Capacity, in which capacity? So the board also in 2019 has given the circular. So the 162 rights of the representatives. Sometimes the rights of the representatives are, he pays the money, he must recover it from the property which he is representing. By chance that situation is not lucid, then you should approach the assessing officer to issue a certificate. The assessing officer will say, yes, for this year, this much tax you recover and pay to me. So the assessing officer shall issue a certificate, and as per the assessing officer certificate, the representative assessee shall recover the tax and pay to government. Then, 163. Who may be regarded as agent? I told you, for a non-resident, if a non-resident is abroad and he is having an employee here. For example, nowadays in Bangalore city, several NRIs own 3 flats, 4 flats. The 4 flats rent is collected by one employee, let us say. There may be residential rents, there may be commercial rents. So the person who collects the rents is an employee. He is the representative assessee. He should file the return, discharge the tax liability. On account of a business connection, whoever is having a business connection, through whom income is received. So NRI is having the income through only one tenant. Let us say one NRI is having a big complex here. This big shopping complex is taken by a limited company. Then that limited company, which is paying rent to that NRI, shall act as agent, shall file his return. Department can issue a notice to him, because through you only he is getting the income. You file the return, you pay the tax. Sir, my liability is only to deduct TDS. No, apart from TDS, the extra tax also you are liable. So this section enables. This is section 163. So who is acted? A trustee also. Already I gave the examples. Who acquires non-residents property? These examples also I have given. So on 95, they are all the representative assessees who acts as agents, and they are supposed to view all these things. Then a broker's broker. This is an explanation given in this section itself. Below this section 163, this representative assessee's agent's liability shall be to the broker only, not to the broker's broker. In the sense, as a non-resident, I purchase and sell the shares in India. I got RBI permission. I sent to my non-resident account some money. I appointed somebody to operate my non-resident account. So that money, through a broker, I have given all these things. That broker appoints some sub-brokers. But even then, sub-brokers are not liable, only broker is liable. This section gives this explanation. Then 164 to 167. Earlier I told you, in India, trusts are 2 types. Private trust, public trust. So private trusts, normally private trusts are again classified into 2. Discretionary trust, definite trust. These sections deal with these words, 164 to 167 deal with these words, definite trust, discretionary trust. What is meant by discretionary trust? The trustee's power is to pass on the benefits of the trust to the desired identified beneficiaries as they like. Trustee's discretion is there to distribute the income of the trust, property of the trust to the beneficiaries as they like. The trust is known as discretionary trust. Discretionary trust income is always liable at MMR, maximum margin. Maximum margin rate is defined as the highest rate of individual is defined as maximum. So, first thing, private trust, discretionary trust, tax liability, the trustee shall discharge at the rate of MMR. This is there in 164, number 2. If the private trust is a definite trust, not discretionary trust, I wrote a will, I have 3 children, they are minors, or say even if they become major, you as a trustee always see my trust property, my trust accumulated income. You should give always one third to my 3 sons. Maybe after 5 years, maybe after 7 years. Then it is a definite trust. If it is a definite trust, through my will it has come into existence. The trustee, maybe one person, should take 3 PAN numbers. On behalf of the first son, 1 PAN number. On behalf of the second son, 2nd PAN number. On behalf of the third son, 3 PAN numbers. So for all the 3, as if their individual return he is filing on each one's behalf, separate individual returns he should file, because it is a definite trust. This is the law. If it is a
if those 3 are majors,
even then the property has not gone to them. As per the trustee deed, trustee is holding the property. Trustee is de facto owner of the property. De facto possession is there. Until, as per the terms of the trustee deed, the properties go to those persons' hands. Till that day, trustee is responsible. This is the answer. So, the private trust, discretionary trust, definite trust I have explained. Now come to the public trust. Public trust means, as I have already given you, the benefits will go to public at large, not identified person. No particular person is the beneficiary of this trust. So then it is a public trust. If it is a public trust, there is a board circular number 320 dated 11/1/82. Normally public trust rate is normal rate, slab rates, basically with, and then this is the normal. But from 22-23 Assessment Year, they specifically changed this. Earlier also this 164(2) and 164(b), capital B, another section, next slide we are going to see, is there. What are they saying? If the public trust violates certain conditions, if the public trusts are dealt with section 11, 12, 13, read with 1023C. So if these 2 situations, if some violations have taken place, the present taxation of charitable trustees, 3 types of violations: mild violation, normal violation, serious violation. If it is a normal income without violation, still this board circular will apply. Circular number 320, normal slab rates only, even for the 11, 12, 13, from AB registered trust. Normal income at normal rates. Number 1. Mild violation. There is a mild violation means now instead of this 164, they are having section 1310 read with section 115 BBI, a new section from 22-23 Assessment Year is introduced, whereby 30% slab rate is fixed. It is known as specified income. Section 115 BBA. 115 is a rate section. So for these trusts, instead of this 164, that 115 BBA, for violations like 13(1)(c) or 13(1)(d), payments to related parties, income from unspecified investments, unapproved investments, 11(5) investments shall be there. If some other investments are there, then this comes to this. Okay? So, what is the status of the public trust? Public trust status is an AOP, normally within brackets trust, if it is a society. If it is a trust T is the status. Okay? So, these are the decisions about this thing also. Then, in the case of an AOP and BOI, now we are going to AOP and BOI. What is the meaning of AOP and BOI? I told you this private trust also. Private trusts include Provident Fund Trust, Gratuity Trust. They are all private trusts only. They are not public trusts. Gratuity Trust, this Provident Fund Trust are also private trusts. They cannot be registered under Section 12AB and they cannot claim Section 11 exemption or 1023 exemption. Okay, then what is meant by AOP and BY? Normally these two words here in Section 231, the definition of person. In definition of Section 231, you will hear the word AOP, Association of Persons. Then the word is BOI, Body of Individuals. Can anybody tell me? Only instead of a monologue, I want somebody to. What do you understand by Association of Persons or Body of Individuals so far? Anybody, sir? What is your understanding, right or wrong? Tell us, fellow.
Group of people combine together and do some specific activities and not for the purpose of profit making.
So you group of people, you join together, you collect some money, open a bank account and then distribute to the flood victims of Bangalore.
Yes.
Is it an AOP or not?
Yes, sir.
He is right. What he said is not for profit. It can be for profit, it need not be for profit. Small amendment. It can be for profit, it need not be for profit. That is AOP.
AOP can have a trust can also be a part of AOP.
That's what he said. Some people to do charity have come together. You are calling it as trust, but basically AOP within brackets trust. That is what you said and what you are saying is also one. Then
Body of individuals cannot be other person. Only
They can
individuals.
be individuals, natural persons.
Natural individuals.
in AOP.
No, individual.
Another good point. In body of individuals, only natural person should be there. In AOP, they need not be natural persons. Any type of persons can be AOP members. But very subtle difference you are yet to come. What is that subtle difference?
BOI it cannot be formed. AOP is formed with a specific purpose. A BOI need not be actually formed. When it operates by a particular
Law.
law.
You are right. That is the subtle difference. BOI means, I give a fine difference. A father was carrying on a proprietary business. Suddenly he died. He has 3 sons. All the 3 sons continued the business. Then, say for example, Rama Enterprises. Rama Enterprise proprietor was K. Ramnarayan. K. Ramnarayan died. So his 3 sons, Lakshmana, Bharata, Shatrugna, continued the business without any disruption. Then these 3 sons put together is known as body of individuals. They should take one PAN number in that body of individuals. Continue to file the return.
Sir, it can be treated as a partnership also, no?
You are right.
If it is registered.
You are right. Immediately after the death, by virtue of Hindu Succession Act, if the person died is a Hindu, all the 3 sons get equal 1/3 share in the capital of that business. Had they 3 decided, as on this date, father died, yours 1/3, my 1/3, my 1/3. Let us put together as partners. Our individual, our properties, liberties, forget. This business, we are equal partners. 1/3, 1/3. My profit I may take back. I will do some other, why should I? Without this 1/3 partition, if I continue as BOI, liability, who is managing, if it is a partnership deed, who is managing, who is responsible for sales, purchases, everything Partnership Act can. So if they come as individual shareholders and then become partners and execute a partnership, it is a partnership firm, it is not BOI. Without that, they continue the business, then it is BOI. Possibility is there, no? That may be possible, this may be possible. So the Act says that. If you identify your rights and then with your, what is meant by partnership? Indian Partnership Act 1932. Two or more persons coming together to carry on a business with an agreed share of profits and losses is a partnership. There is an agreed share. In BOI there is no agreed share. Commonly enjoyed, commonly enjoyed.
But will it also be evidenced by any deed or will, how will you apply for a PAN, sir? Practically.
BOI, no necessity of any document. Absence of document is BOI.
How do you apply for PAN, sir? Practically. PAN card.
You say that the death certificate, legal heir certificate, family member certificate, apply for PAN. That is evidence. Where is legal heir? We want to continue as BOI. BOI is one status in section 231 definition of person.
In the name of the Rama.
Rama Enterprise. That's how we should do it.
Like a chair.
BOI. Now come to AOP. Most of the income tax officers, when they go to a search of a real estate businessman, of some other businessman, they will find a diary. In the diary, Mr. K's share 22%, Mr. M's share 48%. No partnership deed, no firm PAN number, nothing. This unregistered sharing capital, doing illegal business. They will do real estate business in somebody's name. But the diary is something is natural, no? In the natural world. Now the officer, how to assess them? He went to a premises. In that premises, on record business, on record returns is all perfect. What they filed the returns, status, individual, partnership, this, that. Besides that, what is there? Some extra businesses, extra investments in the name of somebody, pooling of capital, expenses, sharing. It will happen in the real world, no? Then the officer, to assess this unearthed financial transactions, what is the possibility for officer? No other possibility except AOP. You should say, in the diary, your share, your capital, your turnover, your profit, everything is there. You four carried on. I want to assess four of you together as AOP. Nothing can do there. They have to accept. Because it is an evidence. It is a carried on. AOP is a status. Number one example. Number two. The department has to do it. You must collect the tax, no? Somebody has done the business, not filed the return in the status of AOP. They are not the thing. They have to do it. As a lawful officer, they have to give the notice. To whom to give the notice? To AOP. So now, there are situations, there are two decided cases, beautiful decided cases. Bangalore Metro Rail Corporation and Delhi Metro Rail Corporation. On this AOP subject, I have not given you in this, but I studied them. If somebody wants, I have put record also. So these two, what is a Metro Rail Corporation? A Metro Rail Corporation normally calls for tenders to have this metro rail system. So civil work one fellow, engines one fellow, the electrical system, signaling, automatic system one fellow. Three different countries. The Japan engines, the Germans, electrical overhead cables and the operating system, Germans, the Indian firm, civil construction, pillars, railroad, rails. So why should these three come? When they call for the tenders, the three tenderers, three work doing people are different people. Caste different. They should execute the work. But one fellow's work is depending on the other fellow. Other fellow's work is depending on the first fellow. Unless the first fellow completes 50%, second fellow cannot start. Unless the second fellow finishes his 75%, first fellow cannot finish his first work. These are all interlinked. Then only project will get completed. For the total project, time period will be given. Each individual period and some total period. But each fellow's duties, responsibilities financially, physically are defined. Now, those three will come to some understanding privately. They file the tenders. I will quote this price, you quote this price, you quote this price. So the Bangalore Metro Corporation enters into agreement, a tri-factory agreement. Your tender I am accepting, your tender I am accepting, your tender I am accepting. But all the three come together that you will do within your time this much, and based on your time you do this much, and based on both of you work third fellow you do this much. Seeing this agreement, department gave a notice. All the three of you put together is an AOP. Because a common understanding has come in between you. You are an AOP. I am a foreign company, I participate in the bid. My capital, my risk, my reward is independent of the other fellow. Only for coordination's sake, because this is a single project but divided into three technical parts, silos. Where is the question of AOP? AOP by definition, three persons should come together to carry on one business with agreed or undetermined sharing of profits. In AOP, what is the difference between a partnership and AOP? In a partnership, definite profit sharing ratio, profit and loss ratio. In AOP, there may not be definite profit sharing ratio. Even there is a. So the department took the stand that this project is an AOP. So similarly for Delhi Metro, finally the court said it is not an AOP. It appears as AOP, but individual risk is not shared by anybody. Each individual's risk, his capital, his profits, nothing to do with other fellow's risk, other fellow's profit. Then it's not an AOP. Are you able to understand the difference? So the AOP, I gave you the first example. When the department goes to a rider, they find a notebook, only one business. 3-4 persons investing their capital, they do the business. Buying the outside, selling, marketing, incurring some illegal expenses, paying mammoths to the municipal corporations, this, that, so many brokers, so much will be there. So illegal business, illegal expense are to be allowed, number of decisions. So all that, there is another type of AOP. Whereas here, legal AOP, 100% legal. Each individual's risk and reward is separate, nothing to do with the other fellow's income or capital. Then it is not an AOP. But department, because there is one common understanding, then one project, let us go as AOP. No. So when it will go as AOP, when it will not go as AOP, while drafting the agreements, the practitioner must be very careful. Unless he drafts the agreement in such a way, there is every possibility. I tell you a common example where blunders are done by some people, where blunders take place. Real estate business. Landowners enter into a joint development agreement. If the landowner says, you the developer, you construct a building, after you constructing the building, hand over me as a landowner 40% built up area to me, 60% for you. But you should sell this 60% only to particular community, Brahmins, Vaishyas. You should put this building only a white color. As a landowner, if I put some conditions for the business of the developer, it becomes an AOP. If no conditions are put, you sell your 60% to anybody, I will sell my 40% to anybody. Then I am liable for my 40% capital gains and the businessman is liable for his business 60%. No AOP between the landowner and the builder. But if some conditions of his business I put as a landowner, or developer put some condition to the landowner, you cannot sell landowner your 40%. You landowner first should sell to me, and then only you can sell to somebody. It becomes AOP. Finish.
So something like a condition, construction, completion of construction by.
They are normal. They are normal. No, they have nothing to do. You should complete within 6 months. It is normal. Nothing to do. Your business. But I want 6 months. You agreed.
So setting up of a profit margin, a cap on a profit margin.
Definitely it becomes AOP. I should not put a cap on him, or he should not put a cap on me. It becomes AOP.
Business.
There are a number of cases. So unknowingly the practitioners put all this, unless you know the difference between a principal to principal, principal to agent. Principal to, the whole, see, before 1932, Indian Contract Act 1872 was not having this Partnership Act. The law of agency was there. Out of law of agency, the Partnership Act has come into existence in 1932. So out of this, what is the primary principle of Partnership Act? Every partner is agent of the other partner, principal to agent. So this AOP is also no question of one AOP member acting as the agent of the other fellow. That is one principle. No law of agency in AOP. But in AOP, one member's decisions will affect the income profit of the other fellow. Then it is AOP. So this is how you should, very fine difference will be there. So the legal difference one should identify, then you should not fall into the clutches of AOP. Otherwise the department, AOP is the best source for the department to collect the money. Joint several liability, no question of giving deduction for partnership of 40 small b, partners remuneration, interest deduction, nothing doing in AOP. So for department, AOP is the best tool. So wherever there is a possibility, department I say, yours is an AOP, come on, I issue a notice. They would not, for the AOP also, for expenses, 40 capital A3, more than 10,000 cash pay. 40 AIA, TDS, they would not have complied in the AOP, nothing, no TDS section. So maximum income, maximum tax, the department will collect. If it is an AOP. So always department for yours is an AOP, I am saying, how it is not, you tell me. Then you will search the AOP law, your drafting error will come to light. So one should be very careful about this AOP. Why?
So under which law which can be registered, sir? AOP, any law is there?
Then unregistered only is AOP. If registered, then it will become partnership or limited company. If you don't register only, it is AOP. For AOP, there need not be a written agreement. Oral agreement is also AOP.
Is it defined anywhere in any law? What is an AOP?
Courts decided what is AOP. Income Tax Act has not defined. Income Tax Act has not defined the word trust. It used the word trust. Income Tax has not defined AOP. It used the word AOP. So one should be very careful. One should not by default fall into the clutches of this AOP.
No, like sir, for trust, there is trust act, anything you mentioned. For AOP, there is any act in.
No act is there.
Nothing is there.
Sir, you are a law-abiding person, you envisage the act to let me complain. The Income Tax Act says, no law complaining people should also be assessed, call them as AOP. That's what the Income Tax Act expecting. Because there will be people, without any law they make money. Let them bring to tax. That is AOP.
So in case of drafting the public trust deed, some people have seen some of the draft deed. They are saying this draft is drafted as per Indian Trust Deed, Trust Act 1982. But
1882.
But public trust is not applicable to private trust.
You are right. the drafting is also right. Please understand. In India, only one trust act is there applicable throughout India. That is what he is mentioning. In that Indian Trust Act, Section 3 says, these trusts, these provisions shall apply to private trusts, specified in Section 3. Then, we are having every street corner, one Annadana, one Bhajana Sangha, one flood relief fund. These are all public trusts. Which law is governing? There is no law for information. Only in India, 3 states have got Public Trust Act: Maharashtra, Madhya Pradesh, and Gujarat. Those 3 are having. It started originally with Bombay Public Trust Act 1950. In 1956, Bombay state has become Maharashtra state. So it has become now Maharashtra State Public Trust Act. Only in 3 states you have Public Trust Act. In southern India, no state is having. 3 years back, the Tamil Nadu government drafted one Tamil Nadu State Public Trust Act, passed in the assembly, realized their mistake. When it is going to the governor for assent, they dropped it, though assembly passed it. This is the situation. Maybe in another 6 months, some Public Trust Act will come in Andhra Pradesh with the new government for information. So, when you are drafting a Public Trust Act, Public Trust, mentioning this deed is to the extent not specified herein shall be governed by the Indian Trust Act is 100% valid. Court said whenever there is a absence of act referring to some existing act is always better. That's how it is. Okay, so my time up to 6, now 5:45. I have 50% only finished from 4 o'clock. So 1 hour 45 minutes. Anyhow, in another 10 minutes, I will not take much of your time. So I will go to, so I gave the example. A person died, his children jointly carried on the business. It is BOI. So case also I given, decided case up to Supreme Court it is. So then, so 167B taxation of AOP and BOI, how they are taxation. At AOP is normally taxed at MMR. So if any member is not there having any taxable income, only AOP will suffer the tax. If members are having taxable income, then the members are liable to admit the share income in the AOP, just like your partnership. For example, if you are writing a partnership deed on an invalid or insufficient stamp paper, it becomes AOP. Every state differs the stamp duty. As per the State Stamp Duty Act, you should write the partnership deed. By chance, you write a deficient stamp paper, it becomes, it's not a valid partnership. What is not a valid partnership is automatically an AOP. Be careful.
Partnership, for partnership, it is mentioned it should not compulsory, it should be written. It can be oral also, no?
Under the Income Tax, under the Partnership Act, it can be oral. Under the Income Tax Act, it cannot be oral. Section 184, next slide I am going to show you. Unless as per Section 184, the partnership is evidenced by an instrument, it is not a partnership basis under the Income Tax Act. Under the Partnership Act, oral partnership is valid. We are talking about the Income Tax Act.
So can you give me an example of a case where shares are not determinable?
In trust or AOP?
No, anywhere when we say shares are not determinable, what does that mean? Everywhere we know what the shares are.
No, I gave already 2 examples. I gave one example that my father left a will saying that I am appointing you as trustee. I have 3 children. When they all get married, you decide the income and property as you like. I appointed one trustee. So he decides which son is bright, which son is weak. He decides. Then it is discretionary trust. The person to whom I hand over the property will become discretionary. I gave this example. Similarly, in AOP, many number of times shares will not be determined. We all will do the business according to our real contribution. We will share the profits after 1 year. Illegally, no? They write in the notebook. all the people will sign, come on, do the business. I don't know my capital. Each one should contribute the capital as they like. Each one do the work as they like. After 1 year, we all together, by majority decision, decide the profit sharing. And then you know, describe.
Sir, let's assume a situation where a partnership firm is formed with what relevant stamp act allowed, means stamp duty is put, but it's not registered under partnership act. Then it's AOP or it stays as partnership?
It's a partnership.
It's a partnership firm, though it's unregistered partnership.
Registration will make only the difference. The third parties to proceed, or the firm to proceed against third parties, the firm to proceed against third parties for collection of money, the court insists that it should be a registered partnership firm. Otherwise, unregistered partnership or registered partnership, for income tax it makes no difference, and there is no legal difference. Third parties can proceed against the firm, but firm to proceed against third parties, it should be a registered firm. Firm 1 generally, unless you produce, court will not allow the firm to file a suit against its debtors. Okay, then, so the tax rate at which the AOP or BOI will suffer is there in the sections 167B, and then share income. Some important things in these remaining 10 slides, some important latest amendments and latest case laws, 2-3 I will tell you. By 6 o'clock I will try to. So share income of AOP members, how to compute. If you compute the share income, then how to admit that income. If you admit that income only for rate purpose, section 110 rebate is there, section 110 rebate. That rebate you can claim. That means only for rate purpose you are sharing, because AOP already has suffered the tax, no double taxation, like your partnership. But in partnership 10(2) exemption is there, whereas here no exemption but rebate is there. So that's how AOP income. Then 167C, this is only recently introduced. As we all know, LLP Act has come recently. So in the 1961 Income Tax Act it was not there. Again they have introduced the options. LLP. What is LLP? In between the partnership firm and a limited company, in between the partnership firm, what it is? Joint and several unlimited liability. What is a limited company? Shareholders are not liable beyond the share capital what they have contributed. Totally, these two are. In between, LLP, limited liability partnership. So what is this LLP? 3 fundamental benefits. A, just like your partnership, income is taxable one time only. First benefit of LLP is, just like your partnership, income is taxable one time only. Share income of a partner in the hands of the partner is not taxable. In the case of a limited company, share income is nothing but you name it as dividend. Dividend is also taxable second time. The first benefit of the partnership is there for LLP. Second benefit, limited company is liable for limited liability. LLP is also limited liability only, just like a limited company. The third and most practical benefit is, just like partnership, as much capital as you want you can put, as much capital as you want you can take, which is not there in the limited company. Once you put a share capital, you cannot take back your share capital unless you follow some procedure, buyback of the shares, so much restriction is there. Now the question comes. So far what you have seen in this past 1 hour 45 minutes, natural person death, AOP and BOI coming into existence, and if they vanish, AOP is dissolved. After 5 years the diary is found, real estate diary of the AOP. Even after 5 years, all the erstwhile AOP members jointly, severally are liable for income tax. That's what we are seeing, AOP. Similarly, BOI is also dissolved, disappeared. Even then, the BOP members are liable. Though the BOP is not existing, AOP is not existing. Similarly, LLP, nowadays, ordinary partnerships are becoming LLPs. conversion of a partnership into LLP. With the registrar of companies, you file a particular form, LLP is dealt by the ROC. So you file a particular form, the partnership assets and liabilities automatically taken over by the LLP. Number one possibility. Number two possibility. Private limited companies mostly held by one family members, private limited companies are becoming LLPs. So a private limited company, when it becomes an LLP, what is the liability of LLP? That private limited company income tax liability shall be discharged by the LLP. The partnership's liability, when it becomes LLP, shall be discharged by the LLP. So these provisions are there. But LLP itself is dissolved. LLP itself is dissolved. LLP designated partner, then finally LLP is also dissolved. Even after the dissolution of the LLP, partners are liable for the tax of the LLP, provided if they prove, I am not an active partner, I am a sleeping partner. Only other two are the active partners who dealt with the assets. Because of my negligence, because of my neglect, misfeasance or breach, this liability has not come. They have not complied. So, if he proves, he can escape. Otherwise, LLP partners are also liable. This is the section newly introduced. And then executors, this I have already dealt sufficiently. 168. Executors means the will nominated person who manages the estate is known as executor. The court appointed person who deals with the estate is known as administrator. All this I have dealt with when I was dealing with 159 itself, because it refers to these things. To the extent the specified assets are distributed, all these things. Succession of business, this is the most practical thing. This is the most practical thing which many practicing CAs fail to understand. This fail to understand. How many of you have heard about modified return, belated regular return, belated return, revised return, 139.1 regular return, 139.4 belated return, 139.5 revised return, 139.8A updated return. What about this modified return? How many of you heard? Modified return is for a succession of one business by another business person. This is the modified return. This has come into effect from 22-23 assessment year. It was there through the court law, but a particular section, this is the section, is introduced in 22 Finance Act, 21 Finance Act for assessment year 22-23. That is 170 capital A. So this is modified. What is meant by modified return? The practical difficulty is one big company will absorb the another company, known as absorption. In the accountancy first day itself you will know limited company. Absorption, amalgamation, okay, merger, demerger. All limited companies, all these words nowadays possible, no? Amalgamations, mergers, demergers. For all these cases, this section deals with 170 and 170A. 170 and 170A, succession of one business by another person, any person, other than death. Death we covered in 159. Now, other than death also, one business is succeeded by another person. Now, the previous person's tax liabilities, previous person's assessment proceedings, pending assessment proceedings. How to determine? How to determine means the successor as good as an actual person. You are getting that business, for that business you are liable. So this is this. But here also one beautiful thing. 2016 the Insolvency and Bankruptcy Code has come. So the IBC overrides the Income Tax Act. That means a company is owing 300 crores tax due. The company went into liquidation. Operational creditors, this financial creditor, this, that, the IBC code, all these procedures. Now, the assets are not sufficient to meet the liability of the financial creditors itself. The crown debt, what we learned from olden days is, income tax, crown debt is the top priority. From the assets of the government should get it, then only private people. In insolvency, IBC, Volta. Private people get what they get till last rupee. If anything remaining, let it go to government. That is the old law in IBC. So, whatever may be the dues. For example, your income tax liabilities are so much. Because income tax department nowadays, your 100 rupees income, 130 rupees also tax can be levied now. 115 BBE tax, interest penalty, this, that, all sorts of mistakes. Then it is better go to IBC, say income tax you cannot recover, let the financial creditors recover. That is happening in IBC now. Majority of the IBC cases are all, I am practicing for the past 45 years. Young CAs who started their practice 5 years back, only specialist in IBC. They are getting 100 times of what I get now. I read not less than 100 acts, section, this, that, what for? Do the proper thing, you will get what you get. Do all this Allah, what will you do? So where there is a possibility of somebody putting somebody's crown on somebody's head, you will get this. But if proper person, proper crown, you won't get, except Dakshina. So, these sections deal with 170, 170A, where that IBC code also is touched in the Income Tax Act. It refers to IBC 170 capital. What do they say? The predecessor's liabilities shall be discharged by the successor. Now, normally these IBC proceedings are 180 days, 360 days. If you go to High Court, some litigation, it will take 2 years, 3 years. Now, within these 2-3 years, the company is in Trishank Surga. Company, neither it is taken over by somebody, nor it is continuing its own. Then some company, so long as its name is struck off, should every year file the return. This company files the returns. Then the IBC will say, or High Court will say, with effect from 1/1/21, your assets and liabilities will go to this new person who has participated in the bid. With effect from that day. So, those 22-23 assessment year, 23-24 assessment year returns already filed by the erstwhile company, which now disappeared, shall be revised by the new person, is known as modified return. This section 170 capital A deals with such modified return. A modified return means from the day the final order of the High Court or IBC tribunal is given. So from the day it gives the order, within 6 months, the successor should file the revised return. So that is this thing. So the officer also, this is the latest case law, 2024 January edition. On this, the Madras High Court has given Pallava Textiles, which has gone for liquidation. So this is this thing. And then...
What is the gist of that Pallava Textile?
Madam, it's a lengthy case, High Court case, no?
No, what is the gist, sir, actually? What happened? Modified return they filed?
No. The portal could not allow the modified return. Even now, there are 5-6 situations. The act is amended, rule is amended, form is not put in the portal. Then what they have to do? The Pallava Textiles filed a physical copy. Ignored, the officer ignored. How can I take the physical copy? The court filed a writ. In the writ, High Court said, you have to take, when you are not enabled them, how they implement it? That is some substance of this Pallava. So, now we will come to finally the biggest on HEF. Minimum 3 to 4 hours one can speak on HEF income tax, one can speak 4 to 5 hours. What is HEF? HEF liability, what is partition? Only one section deals in the Income Tax Act about the HEF, section 171. Only one section deals. But the Hindu law is such a big law. Hindu law by Mullah, volumes you should read if you want to understand what is Hindu law. So this HEF, beautifully, the Income Tax Department for the past 70 years doing the mistake and continuing the mistake is, in spite of the Parliamentary Standing Committee giving to the Income Tax Department a report, a HEF which is hitherto assessed as HEF. A HEF which is hitherto assessed as a HEF only can be issued a notice. Otherwise, income tax department cannot issue a notice to a HGF, which is no more. In all the earlier sections, right from 159 to 170, what I have been saying, for a person who is not existing, somebody is liable for income tax. Whereas in this 171, if the HGF is no more, the department cannot give any notice. That is the summons subsection.
But the partition, but that is the distribution of the HGF.
I will give one simple example. It is up to you to practice. In the outskirts of Bangalore, a person is having 6 acres of land. The person got that 6 acres from his grandfather. That 6 acres land is worth 6 crores now. He and his sons come to you. Sir, we want to sell this 6 acres. What is our tax rate? How you got this? My grandfather gave this 6 acres. What are you doing? Individually, we are all having our own businesses, our own these things, all individual PAN numbers, everything. Then what is it? Best thing is, now in your father's name, father and sons have come to me, no? In your father's name, take a HGF PAN number. Take from the revenue department, this is ancestral property. Get the proof that Adangal, Pani, this, that tax paid, if possible go to 10 years back, satellite picture. Now possible. Apply, you will get cultivated agricultural land, though it is within 6 kilometers of Bangalore, city outskirts, everything you take, 100% HGF, everything. Sell all the 6 acres in bits and pieces with this HGF PAN number. Every sale, within 6 months, distribute the money to all the sons. There ends the matter. Income tax department cannot give notice to HGF PAN number. Why?
It's partition.
There is no deed of partition. There is no necessity of evidence. The money has come into bank. Seller nowadays all 269 SS, the money 2 lakhs more than 269 ST. So we opened with HGF one bank account number. The money has come to that. All the sons have got equal distribution, equal, unequal, whatever it may be, is possible in Indura. The Income Tax Act it said, because the word used for the past 1961 to this 24, 63 years. Only HGF which is hitherto assessed as HGF after its partition can be issued a notice and pursued and recover the tax. Where is HGF? Some 10 years back itself, the Law Commission has given a report to the Parliament. We are like people also as advisors to the government, gave so many advice, never government. HGF don't touch it. Hindu law, please Parliament, don't touch. Let the Hindu law be, where income tax, this law, that law. Don't touch. Don't touch, we cannot. So what this section 171 says, in case a HGF is assessed as HGF, during the previous year, in case HGF is partition, HGF partition can be partial partition, total partition, 2 types as per Hindu law. But the Income Tax Act recognizes only a total partition. In case the HGF is totally partitioned during the previous year, such a partition evidence and details shall be filed along with the return of income. Thereby, that is the last year of HGF, totally partitioned. Afterwards, the co-partners, being male members, got that HGF property in HGF capacity to be enjoyed with his wife and children. Then it becomes new HGF, new PAN numbers in the ranks. Otherwise, so. So this is the sum and substance of section 171. We can talk about this HGF, as I told you, for a number of hours, to be assessed in the same previous year. This is the last portion. Normally, previous year income is assessed in the assessment year. But previous income, previous year itself can be assessed. Some 5-6 situations are given. 172 shipping business.
Selling of the 6 acre land, sir, you are telling HGF. The 26 years, that 1% TDS will be deducted. If the property's value.
You are worried about that 1%, you want to get back the return and file the return, and you want to voluntarily file and get back, paying that 19% capital gains tax.
No, the department will track now that.
Let it track. Let the 1% go. When you are saving 19%, you want to get back that 1% TDS. Why you worry about that 1%? Why you worry about that 1%? Tell me. In the given situation, let's say if it is more than 50 lakhs rupees, buyer has to come. Let him deduct 1%, let the person go. Why you are worried? For 1% sake, you want to go file voluntarily.
20% research.
So don't do that. Don't do that. So this is 172, 173 shipping business. A ship is leaving. Before the ship is leaving, it's on tonnage basis. Sections are there. Section 115. There are several subsections deemed income. Then and there, air travel, air cargo, shipping. So non-residents leaving India. So like that. 174 is non-residents leaving India. So AOP BY dissolving. If they ask, department will give the tax rate. They can under this section wind up the AOP. Sir, we want to wind up the AOP, sir. We want to pay the taxes and then we don't want a subsequent. As we said, after dissolution also, anytime they can come. Better you pay in the previous year itself, before final dissolution. Pay the tax, department will collect the tax, finish. That's how we should do it. Okay? So, any discontinued business, any profession or business, if a person is discontinuing, this section say within 15 days of discontinuing, partnership firm, CA practice or winding up, it is the duty under this section. Within 15 days, you have to inform to the assessing officer, our profession, our business, we are winding up. Please, for your information, we have to inform. Many practical section is there. We should, if you don't do it, what the act says, if you don't do, there is a general penalty. So, discontinuation is not a succession. Earlier what we have seen all the sections, one business is succeeded by another person. Succession. This is only a discontinuation. In discontinuation also you may get some income. Bad debts of old one you recover. There I gave the example of an advocate becomes a judge. Advocate profession is surrendered. Judge means employee. But advocate old fees will come. Then what will happen? So then also it shall be liable. So that's what I say. The charging sections, AOP dissolved after business or profession. This section deals with it. Then companies under liquidation. This all I have explained you. Company. Liquidator, if he is appointed by the court, he is also liable to take a new PAN number and then file the returns. And then the SARFAESI Act, the banks now, to recover the loans, they use the word Securitization Act. That is otherwise known as SARFAESI Act 2002. NCLT I gave you know, there is no priority for this debts. That is the decisions, legal decision they decide case again. Lastly, the 184 partnership form. I told you, referred half an hour back. A partnership shall be assessed as a partnership form if it is evidenced by an instrument of partnership. It's basics. So, as you said, partnership shall be, this section is even now valid. You are filing the return. Nowadays online filing. But the firm will be assessed. When you take a PAN number, when you are filing the return, be sure that there is a deed. Be sure that it is an instrument. There is a difference between a word deed and instrument. On this number of documents are there. But better you make it a deed rather than an instrument. Instrument is loosely worded. Deed is a higher pakka as per the Stamp Duty Act. So these are all the, even if a firm is dissolved, all the partners, erstwhile partners, normally when a partner retires, what you will do? As on this date liabilities, in future, the retiring partner need not, we the continuing partners will bear. Even then the department can issue the notice to the retired partner, but the retired partner should prove that I am bona fide, I retired, not for a tax evasion. The remaining partners, they will be liable. Please continue. So like this, these sections are there. If the firm is dissolved, so what is succession of a firm? That means if a firm 100% is succeeded by another firm, nothing but sometimes unknowingly our people will write, 3 partners are there, it is having some land. Same day, 3 new partners are coming, old 3 partners are going, the assets will continue, you will write. Then it is the second firm succeeding the first firm, not the continuation of the firm. Because the lands are registered in the name of the firm, you think that you have only made reconstitution, but it is nothing but succession of one firm by another firm. So even after the dissolution. But nowadays, from assessment year 21-22, you must be very careful which I notice, I make a comment, please don't take otherwise. This section 9B and 45(4), which are brought on income tax statute for even a small change in reconstitution of partnership form, dissolution of a partnership form, big liability is coming unless you properly read these two sections which are introduced in the 2021 Finance Act. But as you have practiced for decades, simply write a new partner coming out, those partners are one partner retiring, come on, read the reconstitution. You are simply filing and then continuing. But this liability, new sections of 9B, 45(4), you have to read and then take care of. Otherwise, say it's there. So thank you for giving this opportunity of special liability in the Income Tax Act. This chapter normally is not dealt by majority of the people because it's a once in a blue moon. You are practicing means 95 returns, regular, surviving, continuing people only come. They don't they ask you to file the return. No death person will come to you. So you will not read this section. No opportunity for you. So, but this is the area where lot of ticklish issues are there. Because I deal all ticklish issues only come to me. This chapter is given to me for deliberation. I thank the Bangalore branch for giving me this opportunity. So any questions? 3 questions I will take. Come on.
Sir, last sentence is mentioned 45(4). The firm has to pay tax.
You are right.
So how to settle with the outgoing partner, the retiring partner? Should it be after taxes, share of after taxes to be paid to him, or
Sir, money to be given by the partnership firm to the retiring partner is up to them. Income Tax Act is nothing to do. Income Tax Act what it says, when there is a reconstitution is defined in section 9B. Reconstitution means all the existing partners only are continuing with a different profit sharing ratio. It is also a reconstitution. One partner is going out, reconstitution. One is coming in only, reconstitution. 2 are coming, 2 are going, it is a reconstitution. Whenever there is a reconstitution takes place or retirement dissolution takes place, then different situations read together with 45(4), read together with section 48(3), tax shall be computed and paid by the partnership firm. That's all the Income Tax Act. How to recover this tax because of the retirement, it is up to you. No formula, nothing is. How the tax has to be paid in the firm is there in the Income Tax Act. From the retiring partner, how to recover it is partners. They should calculate. Best way. Don't do anything in the partnership firm. Let the outside do. Retiring partner will take from the continuing partner outside the firm. Nothing, no 9B or 45(4) will apply. That's how you should do it. Okay. Next, any other question?
Sir, intestate, there can be a future beneficiary also, right? In that case. Say suppose the father, no future beneficiary can be.
Your question is contradictory. A person died intestate, can there be a future beneficiary? Is it the question? Your question is, a person died intestate, can there be a future beneficiary? Is the question. What is meant by intestate? Without writing a will, property going. Without writing a will, property going means, as per the personal law, I told you already 2 times. If I am a Hindu, as per Hindu Succession Act, without writing a will, my property will go. If I am a male, section 8 of the Hindu Succession Act, my wife and children will get equal shares. If I am a female, section 14 of the Hindu Succession Act, husband and children will get this. Hindu Succession Act. If I am not a Hindu, as per Muslim Shariat law, male children will get double the share of 3 ladies and 4 sons. 4 sons will get 8 shares. 3 ladies will get 3 shares. 3 plus 8, 11. So each son will get 2 by 11. Each daughter will get 1 by 11. That is Muslim law. So if a person dies without writing a will, the personal law will decide how much shares will go. Your second part of the question is contradictory to the first part. Can any future person get a benefit? That is only if I write a will. What I write a will? I am leaving a will. My property after my death shall go to my grandson who is not now existing. My son after gets married, if he gets children, Those children shall get my property. Till that time my son is only a trustee. If I write a will, then that is not called as intestate. For a future unknown person also, will can be returned. This is the law. Hindu law. Not Muslim will is different. Hindu will is different. This is the law.
My question was second example, I like to use.
You are right. I gave the example. I understood and I gave the example. Anybody else? Any other question?
So there is an HUF which has already been assessed. Okay, then the same planning can happen. Whatever.
I told you section 171. A HUF which is hitherto assessed, even if it is totally partitioned, notice can be given and then bring into the tax rate. If it is hitherto assessed.
Okay.
Hitherto not assessed, no possibility.
So once they file, it's gone.
Decided cases, all high court decided cases, not myself, my interpretation. All decided cases.
Sir, in practically, like in FD with bank, suppose the person died on 15th June. But if you practically, if you see the changing of the PAN, all the things, it will take minimum 1 to 2 months. And bank, they will deduct the TDS as on 30th June.
You are right.
That is what will be the same.
In the income tax return, there are 3 possibilities if you carefully see the income tax return. TDS of one person can be claimed by another person, provided the person in whose name the TDS is deducted is not claiming the same and gives to the assessing officer a writing, I am not claiming, it is not my income. Your question, a person died on 30th September, but his FD, interest is deducting, on interest the bank will deduct the TDS, not only up to the death of that deceased, till December also, December quarter interest also in the name of the deceased phone number, bank has deducted. How to deal with this is your question, is it? So that answer is, up to the date of the death, deceased is written as a legal representative paying, I must admit the income and claim the TDS. After the date of death also TDS is there, it is my income, TDS is in father's phone number. I should say he is no more, that TDS also should be given to me because section 199 of the TDS section says, in the year in which you admit the income, in the person in whose hands you admit the income, shall claim the TDS credit. Section 199. You read?
No, suppose it is on 15th June, person has died. And the 30th June, bank will credit the
totally
interest on 30th June, he will cut the T.
You are right, I understood. See, your problem is 75 days income, 15 days income.
Yes.
90 days TDS, 75 days TDS only should go to that person. 15 days TDS should come to me because 90 days, 1 quarter TDS they have made.
Yes.
You can proportionately claim, the officer is bound to give. It is the law. Whoever admits the income, their income related TDS shall be given to him only, irrespective of the TDS in somebody's. This is there, 199, read with, I think there is a rule also, 37BB. Rule 37BB is also, rule is also there. Both read together.
TDS schedule also it is there.
You are right, TDS schedule written also it is there.
Transfer to other.
Actually last, before year Finance Act 22
TDS
is given.
Either you can transfer full, either you can
You can do whatever what as said.
Sir, sir, one peculiar situation was there which chartered accountants were all suffering. Only 2022 Finance Act has solved the problem. What is the problem? Chartered accountant normally admits the return of income cash basis. His income giving people normally deduct the TDS on accrual basis.
Yes.
For 24 March you would have deducted the TDS. For 25 March only it is my income. So 24 March in my AAS 26AS TDS I will claim in 25 March. Normal part. Carry forward. Reverse will happen. What will happen? Some client gave me advance fees. While giving the advance, he deducted the TDS. I as a chartered accountant following accrual basis, that advance TDS I will not claim. Second year I will claim. Then also carry forward. So there can be a ulta situation that when I admitted the income, that fellow has not deducted the TDS that year. Second year, for him it is a deductible, then he deducts. First person on accrual basis admits the income, no TDS. Second person cash basis deduction the second year. Then no income, because 199 says in the year income which you admit, you claim TDS. I already admitted income earlier year, no TDS. Now no income but TDS. For that also amendment has come. So all the situations, now the act is 100% clear, you can take it. Any other questions? The last question.
And just hope you all had a good session. It's quite tricky sections which sir has dealt with a lot of ease and made it simple for all of you. So on behalf of Bengaluru branch, I would like to thank CA Palgun sir for coming from Tirupati and then taking this session for us. I request CA Shripad, the SICASA chairman, to hand over a memento to sir as a token of gratitude. Thank you so much, sir. We'll have a quick tea break and then assemble 15 minutes. We'll assemble back at 6:35, please. And welcome back. The next session is on advanced tax and TCS provision. So we have CA Nishchal R.B. with us for this session. I request SICASA chairman Shripad to escort him to the dais and greet him in the floral bouquet. My apologies. Welcome to you, Nishchal. Thank you for being here. Please take this. A quick intro about Nishchal. He is a partner at R. Badrinath & Co. and a corporate trainer for GST Income Tax and Company Side. He has assisted in writing a book to CA Ravikant Meriala on the book of accounting standards, and his experience ranges in income tax, statutory audits, indirect taxes, accounting, and internal audit of concurrent audits of banks. And he's been a topper in accounting talent search examination conducted by NATS. So welcome to you, Nishchal, and thank you for being here. Over to you.
Audible? Audible? Okay. So, can we start?
Yeah.
Maybe are we waiting for someone else? We can start, right? I guess it's time we can start. So, unlike the previous topic where only strange cases were dealt, this topic is general cases, mostly like simple topic, very easy to understand. Of course, most of us already know it, but as a part of refresh and revisiting income tax, we are going to conduct through this few small topics on advanced tax and TCS. Let's start with advanced tax. So basically, meaning of advanced tax. So during the simple wordings, let's take it. During the course of earning income, the department is also going to collect tax, and the person who is liable to pay tax will also pay the tax during the course of earning. Means to make sure the income tax gets its cash flow regularly instead of once in a time in a year, they are making sure they get advanced tax regularly. So let's just read the section. Liability for the payment of advance tax. Tax payable in advance during the financial year in accordance with the provisions to 208 to 219. I will highlight on those few important sections within that range, definitely. And it shall not apply for people who does not have income from business or profession and who is aged above 60 or above. Okay, the senior citizen who is not having business income, then the advance tax rules will not apply. There are still other options where advance tax rules need not apply. Let's see that as well. Conditions of liability to pay advance tax. Advance tax shall be payable during the financial year in every case where amount of such tax payable during the year are computed in accordance to the provisions of the chapter, means all the tax calculation chapters, and it is more than 10,000 or more. So if it is less than 10,000, advance tax is not applicable. If it is a senior citizen not having business income, advance tax is not applicable. Yeah, so I just summarized the same through a chart. When will the liability to pay advance tax arises actually? Okay. First condition, resident is individual whose age is 60 years or above. Income chargeable, then we'll have to see the next condition whether income is chargeable under the business or profession. If it is yes, then it's taxable. If it is no, I mean it is advance tax is applicable. If it is no, no advance tax is applicable. Then of course, any other case, we have to see the next criteria. Let's assume there is a senior citizen who is having business or profession, and of course advance tax will be applicable. But there is another condition we have to see it as 10,000 rupees limit of tax payable. Okay, how is advance tax computed? Let's see. So first we'll find the tax as per tax calculation provisions. Then we'll add education cess, we'll add surcharge wherever it's applicable, and we'll give relief of 89, 90, 98, 91, these all sections which will provide reliefs. And they can also reduce MAT or AMT, which is alternative minimum tax credits, if any. Then TDS, TCS is also reduced to understand advance tax. So it's not like we calculate a percentage and then reduce TDS. It's not like that. But for calculating the tax payable under advance tax, we have to reduce the TDS in prior from the tax payable. Now we will get the total amount of advance tax to be payable. Then how much to pay, when to pay, we'll see next. Payment of advance tax. There are two ways, of course. Simple one is they declare it themselves voluntarily. Simple, of course they have to do that. Or the assessing officer can have the power to pass an order and ask for payment of advance tax through a notice. So basically, there is an option for officer also to ask advance tax if the person is not paying advance tax through an order or a notice. Okay. Payment of advance tax on his own record. Mandatory liability if liable. We saw the conditions where advance tax rules will apply. The 10,000, 60 years, PGBP, applicability, these and all. So first, if it is liable, they have to follow. They have to pay on or before the due date specified in section 211. That due dates will come to that next. And calculated as in the previous page we have just seen calculation of advance tax, like reducing TDS, reliefs, MAT, adding cess and surcharge. These all should be adjusted for calculation of advance tax. So in these three criteria we have to be followed for doing the advance tax calculations. Computation of advance tax by AOs. Advance tax on the income higher of the following. There are two conditions on which assessing officer will take his view for calculation of advance tax in a specific assessing case. How? Total income of the previous year, latest previous year, in respect of which assessee has been assessed by way of regular assessment. In the previous year, already there is a regular assessment. Based on that, they can charge advance tax, or total income returned by the assessee for the previous year subsequent to the previous year. Example, financial year 23-24 we are saying, 21-22 income will be taken into picture, for which regular assessment has been passed. Regular assessment we can also see the other way around as well. Next. Condition for order or amended order for assessing officer. So assessing officer passes advance tax order. What are the conditions? Assessee has already been assessed by way of regular assessment, first point. Assessing officer is an opinion that person is liable to advance tax. First thing, he should be also have an opinion that it should be more than 10,000 or the 60 years limit and all. Order must be in writing, it should not be in oral, of course. It should be in writing. Of course, now DIN number is also mandatory. Notice of demand must specify the amount of advance tax and installment in which amount is to be paid. Let's assume second installment. What is the percentage? They have to mention the percentage and the amount, both calculations. Order can be passed latest by February. So they cannot pass it in March. So they can they pass it in September? Yes. Can they pass in October? Yes. Can they pass in June? Yes. But generally, that means it's not allowed to pass after February. It means March they should not be passing an order to pay an advance tax. So installments of advance tax, we all know that. We'll just brush it up again. 15% by 15th June. So
we are very close. Tomorrow is the first installment of advance tax. So you can inform your clients or friends or family, whomever is applicable to pay advance tax, they can comply immediately, wherein just like a day before. 45% minus amount paid before 15th September. Why is it minus amount paid? They could have just told additional 30%. Because let's assume a person has forgotten to pay by June 15th, or he has paid excess, or he has paid less. For giving that adjustment, they will recalculate the income into 45% minus the tax already paid. And of course, there can be revision of calculation of income also based on the conditions of the business or some XYZ reasons, whatever. There will be capital gains, whatsoever it might matter. There should be a recomputation at every installment of advance tax. Then third installment, 15th December, 75% minus amount already paid. By 15th March, they have to discharge 100% of the total liability. The remaining means of whole amount minus what is already paid in last 3 installments, if any. And another point we can bring in is before 31st March, whatever is paid still will be considered as advance tax. That means the period between 16th March to 31st March will also be considered as advance tax. Might help for interest calculations, might not help, that we'll see later as per 234B, 234C, whatever sections will apply. Next, the main point here we have to keep in mind is calculation of income, first point, next calculation of tax, and then finding the percentage. Definitely there will be changes every single quarter. Based on that, the assessee has to recompute the tax, or maybe even assessing officer as need be. So these are the, according to 211 section, these are the percentages we just saw. But in case of 44AD ADA cases, the advance tax previously was not available. It was previously previously there was no advance tax applicable for 44AD ADA cases. Now as it new section amendment has happened in 211. So even for estimated income under AD or ADA, they have to pay advance tax, but they have only one installment which has to be paid wholly by 15th March only. So they don't have to pay during the year. They can choose to pay, but they can just pay in single installment before 15th March. That is also fine. They can avoid all the interest applicabilities of 234CA.
Okay. 44AE,
Yeah.
other law,
AE.
The other, that is normal. No?
That is normal. Only for AD, ADA, they are specifically given. AD, ADA is only they are given specifically. Okay. Sorry, I didn't stop anywhere because I thought the topic is almost self-explanatory. At least when I come to TCS, there is at least 5-10% to understand. Any kind of doubt, please stop me and ask. We'll clarify right there. So interest payable by the government. Till now interest was always paid by the assessee. Now interest will be paid by government also. When will interest be paid by government? Only when there is excess TDS or excess advance tax paid. If there is any advance tax excessly paid, the government is liable to pay at 15% per annum rate of interest back to the assessee. Only in case of advance tax. Excess advance tax paid.
So much of interest, 15%.
15% they are paying, yeah. So make sure you pay extra advance tax if you don't want to keep it in FD.
Get good.
They will make TDS there also on interest.
Under which section that interest comes?
214.
Is it coming there?
Sorry?
They are issuing like that? Like
Yes. You have to see the order. You have to see orders in the cases where advance tax was excessively paid. This is the question.
That is passed with the TDS or what? Who is passing that order?
Who's passing the order? 140. Generally, even 143.1 order also is fine. The intimation under section 143.1 also they are passing it. It's all system computed.
Whatever interest government is paying, 0.5 only was given.
0.5 was only given, correct. Only for advance tax portion they have given such section in addition.
Nice investment option.
Sorry?
If government gives on time, that is okay, but nice investment option. 15%.
Investment option.
Where we will get 15%?
No, that
But every year
it will not happen every year.
Next year it will
They will see the provision. If it is misused, definitely they are going to. And if it goes to income tax department, we don't know when it will come back. Let's assume you suddenly put some 20 lakhs tax. They will give a note 143.2 notice or 142.1 some notice they are going to give, and they are going to call you for a scrutiny.
Such cases get selected Okay.
They'll be selected automatically.
Advance tax refund. What is the basis we estimated the income?
Exactly. There is always a view. I had my own client who had gone through this. Because he went through futures and options, suddenly he made 1 crore profit. He paid 40 lakhs advance tax. Later, by the year end, he made the equivalent loss and came into losses. Now he wants refund. Now it's stuck. Of course, he's going to get interest, but we have to go through notice, delays, 1 year, 2 year, we never know when the refund will come actually, even if the order is passed by 143. Intimation is passed by 143. So, better don't misutilize the benefits given by the department. Section 218, when assessee deemed to be default. If assessee does not pay on the specific date under section 211 any installment of advance tax, as is required to be paid by the assessing officer under subsection 3, and does not honor before the date which such installment is not paid before, such assessing officer and intimation under section 210 does not get any basis of estimate of current income. Basically he is going to estimate it himself and then give an order, and if you don't follow, nothing is much going to happen, but it's the mandatory process. In general, penalties might apply if you are not following the assessing order, but there is no specific penalty for not following the order of advance tax. So let's assume there's a very big company, the AO passes an order to pay 4 crores advance tax and this person does not do. What happens? General interest provisions will always apply for non-payment of advance tax, and general penalties will apply for not complying with the notice. Credit of advance tax. Any sum other than penalty or interest paid by or recovered from the assessee as advance tax in pursuant to this chapter shall be treated as payment of tax in respect of income for the period which would be previous year for the assessment year for next following the financial year in which is payable. Simply they are telling whatever is paid as advance tax, they will consider it as tax for computation of your tax in your income tax return. That's all. So I assume there was not much ambiguity in advance tax, but still if there is any doubt you can ask me, we will go to TCS. Sorry, I had to be fast because I know the topic is pretty dry and known by everyone. Any doubts? Shall I go to TCS? Is it fine? TCS also mainly we have one major section which we all know. The remaining are only strange sections. Tax collected at source. Yes, sir, please.
Advance tax paid after the due date.
After the due date means which due date?
15th March.
Okay, so after 15th March, yeah. That will be used for only for calculation of 234B. 234B you remember, right? Only for calculation of that penal interest, it will be reduced. Not for 234C. 234C 1% will anyways fall, even if it is paid on 16th March. But 234B is saved, still it is saved. And another major reason is, the government does not know what to call a tax which is paid between 16th March to 21st March. What are they going to call? They can't call it self-assessment tax, they can't call it advance tax, then it will go to Sri Shankaswarga.
No. We are paying it as advance tax.
Yeah, definitely, of course. So they call it advance tax and they are giving that benefit of 234B interest purpose.
Delayed payment.
Huh.
The department is considering it as self-assessment tax.
No. If you are paying under self-assessment tax, then the chalana by itself is wrong.
No, department is considering it.
No.
Only 234B purposes.
Purpose, yes. And there can be an order. Let's assume the assessing officer has passed an order to pay some XYZ amount of tax. This person could not pay by 15th March. At least by 16th, 17th March, if he pays, it will still stay as advance tax. Let 234C fall, 234B is saved. That is not mattering the assessee. At least he is complying to the notice provided by the assessing officer. Let's assume the officer passed an order on 15th February to pay so and so advance tax for the full year, so and so calculated. So this person has some money, he has paid before 15th March, some money is not there, he is paying after 15th March, but still it is advance tax, he is safe. He is complying with the provisions of that notice specifically. Got it? Anything else? Can we? Anything else, sir? Okay. Okay. Tax collected at source. So what is TCS? Generally, we all know TDS. This TDS session is not yet over, right? Tomorrow or something. Okay. I'm assuming we all know TDS. So generally, when we are paying something, we'll deduct something and pay the remaining to the supplier. TCS is reverse. When we are paying something, we'll add something and give it to the seller. Well, that is very strange. In few specific cases, it has been made mandatory. We'll see what all sections are there under TCS provisions. Some are not very regular, but at least for the understanding and study sake, we are going to learn a few sections of TCS. 2-3 TCS sections are very popular. We all know that. We'll go forward. So what is TCS? It is an additional amount collected as tax. It's an additional amount collected as tax by the seller. So this point is seller is important. It is collected by seller, not by buyer. At the time of sale and over and above the sale amount. So X amount is there, X amount plus TCS is collecting more than the bill amount above the sale amount and is remitted to the government accounts, the same like TDS. As per Income Tax Act 1961, certain persons being a seller must collect. It's a must, it's not an option. It is must. Collect a specific percentage of tax at the time of receipt of the amount from their buyers or at the time of debiting the account by the buyers. Okay, now this is another point. Receipt or debiting the account. Why is this wordings coming? Let's assume a person is raising a sale bill or just by giving it on credit. Yes, TCS is collectible right then. First point. Or let's assume he has not raised any voucher or bill at all, but he has received the payment. Then also TCS is collectible. That is what they are trying to mean. That doesn't mean that somebody has received X amount as an advance for so-and-so product or taxable act. They cannot avoid TCS. Even on basis of payment, the TCS will trigger, whichever is earlier generally. So there will be exceptions, we'll come to those also, but generally by raising a sale bill, it is collectible. By raising, by debiting the buyer's account means, by receipt of the amount means receiving an advance or payment, that is also attracting TCS. Okay, next. We are going to go through sections 206C, 1C, 1F. So there are few subsections which are missing. Sir, why sir you have missed? That means they're simple, they are already been deleted by the Act. So whatever is available, I am trying to cover every provision of TCS. Okay, 206. Profits and gains from business of trading business of trading of alcoholic liquor, forest produce, scrap, etc. Who should collect? Every person being a seller. Is there a limit? No. If you are a seller, you have to collect. Okay. When should the tax be collected? While amount debiting or receipt, whichever is earlier. So we have a case law confirming the same. In fact, Act is only having that wordings, but there was a case law as well. When such, why did that case law come? Of course, before that wordings in the Act was missing, so there was a case law. Then later the amendment happened. When should the tax collected be paid to the government? In the same day. Imagine this person is some scrap seller. Every day he buys. Every day he has to. Every day he sells. Every day he has to pay. Every day he has to pay. He keeps selling scrap. Every day he has to pay TCS. Of course, there is a saying or also. So or 7 days from the end of the month. Same like TDS provision. 7 days from the end of the month. Let's assume some transaction has occurred on 13th April. By 7th May, they have a chance to pay.
Is there any logic specifically for this section they kept like that on the same day without production of income tax challenge?
No, there is no logic specifically, but this was erstwhile created that way and then they added or. It's literally impossible that one XYZ private limited selling their scrap, immediately they pay TCS on the same day. We don't know how many accounting things are there, maker checker problems are there, finance department approval is there, so many things are required for one transaction to happen. It's very difficult if there is day in and day out, every day there are transactions in few places. selling of tender leaves, XYZ, which will cover.
There are so many sections, no TDS sections. They will sell within 7 days or
7
25
days.
days like that.
Yeah.
Specifically
Specifically, they have mentioned. They have given all also. We'll go by all.
There should be some reason, I think so.
Okay. On what should it be collected? On what? So we'll see examples. Alcoholic liquor for human consumption, 1%. Tendu leaves. Tendu leaves means nothing but the product, the leaf used for making BD. 5% means basically it's for all cigarette industry also might use this. Timber under forest produce. Timber obtained at any other mode other than forest leaves. Any forest produce not being timber or tender leaves. Basically any product forest produce other than tender leaves, the rate of tax is 2.5% and 5% in case of tender leaves. What is tender leaves? BD. So, okay, next scrap. This is popularly being followed in general business. Scrap 1%. Minerals being coal, lignite or iron ore. These three minerals will attract TCS of 1%. Exemption from this TCS provisions. So there are exemptions from this TCS provision. In what cases? If buyer uses the above mentioned specified goods for manufacturing, if they use it for manufacturing, TCS need not be collected with the buyer. I don't know how are we going to verify that. Hoping that person is a factory and going by a declaration on email or a letter from the buyer, the person could be exempted. So there is no other method to verify whether he is actually doing trading or he is having a manufacturing unit but he takes tender leaves and he is doing trading. How do we know? So we have to take the declaration from the buyer and then only take him as a manufacturer. Or you processing or production of articles. Basically processing and production of articles also might lead to manufacturing only. So it is used for some other purpose as B2B, not just as trading but as production or manufacturing or processing, or for purpose of generation of power. Generation of power. So these are exempted and not for trading purpose. Specifically mentioned trading. Traders should not use this benefit. For this, the buyer of the goods should submit Form 27C in duplicate under XYZ rule, that is 37C, to the seller, and a copy of the same shall be submitted to Principal Chief Commissioner. We don't know how will we find this Principal Commissioner, Principal Chief Commissioner. Whenever we want, we have to go and submit those documents. So they are saying when you take this exemption, then we have to take the declaration. The declaration should be submitted to Principal Chief Commissioner or Chief Commissioner. Those are at such high level, they expect we to go to Principal Chief Commissioner and ask, sir, documents sir. Literally impossible.
And that is not for trading purpose.
No. It's not like that. That is continuation of these 3 points, madam. These 3 points not for trading purpose. For this exemption only, they have to take the declaration and submit it to commissioner.
That means alcoholic drink liquor, that form is required then. They're trading, they will trade it.
They're trading, yeah. TCS is applicable. Form is not required. If they collect TCS, no problem. If they are using the examples, the alcohol is purchased and been used for purpose of some manufacturing of some chocolate, then they have a chance to give a declaration, avoid TCS and submit it to Principal Chief Commissioner. Don't know how will we find him, that's all. We have to just put a post, speed post, and assume it is being reached and read by them. We will be bona fide with that acknowledgement.
Like that will get written, it will get reflected in the TCS returns.
No ma'am, we will not, if they are giving exemption, they don't specifically mention and get into troubles. I would not suggest. Let's assume XYZ person who is selling alcohol to a manufacturing unit. I would not suggest him to put it in TCS, this much I have sold 10 lakhs. So that TCS is 1% but I have not collected. This if you have done, we do not know, the system might process with demand only. Differential not paid. So I would not suggest you to even put it to TDS. Like how we put it for salary cases, though it is not TDS deductible, but this is so and so income is there, so and so deductions have been claimed. End of the day, income is this and tax paid is 0, or interest paid. Interest we do 0 is the rate. We would not suggest to do that in this.
Specifically, you are checking on these declarations normally. It is
That's what I'm asking. Where it is coming, specifically it is going to some. This one TG.
They will, I'll tell you, any seller blindly will take TCS until unless the order is extremely huge and it's a very big B2B transaction, then only they'll come to all this process, because the seller will be responsible to collect the TCS. The buyer will escape. Buyer has nothing to do with. Buyer will escape. But seller will face all the penalties, paying TCS from hand, interest, everything. Thank God it's not TDS where expenditure is not getting disallowed. So there is nothing to disallow. They should not disallow any sales. They can't disallow sales. Of course. They will not disallow sales, so it will stand.
It's a turnover. So that turnover when they take for any verification, they'll see whether how much is that TCS portion. All that. Then
Yeah, of course, that limits will be there. Can we go ahead? Okay. So that was on products. First, I forgot to tell. This was this section we first read about goods. Next we are going.
Here scrap. Scrap. If I am doing any manufacturing of any biscuits or any food products, then the extract of the waste that comes out, if I am selling that time, I have to collect it.
Correct. So let's assume this need not be a regular transaction.
Yes.
Scrap, let's assume most of the manufacturing units will always generate scrap, especially if they are into steel related products. Steel and maybe wood products also. So that scrap, no one wastes it. They will sell it to a scrap dealer. They have to collect this. This is the general place where people do mistake.
Yes, there is one High Court judgment I remember where their cloth. They import the cloth and they will cut into the pieces as per the customer demand. Order. Now the cut pieces is there. No, the pieces he is selling. That company is selling to as a waste.
They are selling it as a waste or as a product. This is a point here.
So the buyer, how the buyer is using, he is combining and he is selling as a cloth again. The buyer.
Okay. So now the point here is that is a specific case law where we have to decide whether it's real product or scrap.
Now
this is what we have to decide.
Has opinion is that is a manufacturing and it is for the purpose of
manufacturing is also a view which they can take. It's manufacturing purpose, then it's still.
My doubt is any food company something
okay, some food is there. They'll again use that food to some other manufacturer.
Wheat. See, I have a mill. I will do husk. I will separate rice and a husk. This husk I will sell to a cattle person. Cattle.
Yeah, maybe he'll pack it and then sell it. Let's assume.
Then
that we have to establish manufacturing.
That is used for cattle feed.
Got it. That is also product. That is also product. Now see whether we are selling it as a product. See, husk is generally being used in your specific example. Husk is generally being used as a product.
Okay.
There are even human consumption products which are developed from husk. They grind it and give it, which has a high fiber content. So they can sell it as a product, no problem. Again, this all comes into picture whether when the officer takes the view. Officer takes the view is scrap and you will take a view as a product. Then we have to see the amount involved, whether it's sizable. These all things will come in. Shall we continue?
Yes.
Okay. I am okay with stopping for doubts because we have good amount of time. I don't have much topic to cover anyways. Okay. So on service. On what services TCS is applicable? So in case of a person who grants lease or license, or enters into contract otherwise transferring any right or interest. Okay. Who grants lease? It's not, let's assume you go to parking lot tomorrow, you park your car, let's take an example here. Parking lot, 2%, toll plaza, 2%, mining quarry, 2%. So this is not for the person who is using it as a customer. Let's assume I come and park a car in the parking lot, so TCS will be collected. No. It is for person, example, there is a land which is developed as parking lot, example, and that is been subleased or leased to some Mr. X. Now what payment the first landlord takes from Mr. X, that TCS should be collected from the lessor. Okay. So that happens in parking lot, toll plazas, mining quarry. Quarries does not include mining.
This parking lot, no? say for example, something like 1 acre is there.
Correct. They give it
Nearby
for
my company is
parking.
there.
Yeah.
Nearby my company is there. I told this area will be only for me specified.
Got it.
Then in that case also it is not applicable, no? Because I
No, that is debatable.
Debatable.
That is debatable, but generally we can take a stand of not applicable.
Because
We can take a stand because you are taking it as a customer. You are not taking it as a business where you take that lot and then the same thing happens. Let's assume he takes in 1 acre, half acre he took it as for his company and then he gives he charges his employees. Then it might be applicable. Then he is also into business of parking lot.
Okay.
You're able to understand. Let's assume he doesn't charge employees, he's using it for parking. It's fine. Even if they are charging, then we have to see what way they are charging, whether it should be considered as business of parking lot. These all views come into picture. Always take a pessimistic approach. That is what we suggest in TDS TCS rules, because mostly there is no loss, only a temporary cash loss until and it's a very big amount. So go ahead and comply if it is possible. Mainly where litigation comes is in huge amount of scraps. TCS. Because let's go. And mining and quarrying does not does not include mining and quarrying of mineral oils. So mineral oils, if you see mineral oils, that includes petroleum gas, natural gas. These related mining lease amount TCS is not required, specifically excluded. Then next point, goods based on value. So 206(1)(f). It's again a popular section. We all know, maybe we do not know the number 1(f). In case of purchase of motor vehicle for a value exceeding 10 lakhs, then the tax shall be deducted at source by the seller from the buyer 1%. Like we go and buy a car and showroom will collect TCS of 1%. Can we go ahead? 206(1)(g). Who is authorized dealer who receives an amount for remittance from a buyer, being a person remitting such amount under liberalized remittance scheme of RBI. The certain conditions related to such are as follows. So what is liberalized remittance scheme? So in India we have an option to transfer outside India foreign currency up to $250,000. In dollars, they have mentioned it, to up to $250,000. Any Indian is ready to, is free to spend, invest, or take it outside India. No problem. Up to $250,000. So they are specifically mentioned under LRS scheme. So under that scheme, if they are going to pay, then they shall be liable to collect only if the amount or aggregate of amount transferred are 7 lakhs or more during the financial year. So there is some X payment. Let's assume school fees, tuition fees, popularly used. Some Mr. X is there, his son wants to go to US and study. Then in that case, the TCS will apply. Okay, there are of course exceptions, exemptions also available, or concessional rates coming up. But up to 7 lakhs, no TCS. Beyond 7 lakhs and above, TCS will be attracting it. So we have to, again, 7 lakhs is in rupees, LRS scheme is in dollars. That has nothing to do with income tax, but they have used the word LRS as per RBI guidelines. Okay. Provided further that the sum to be collected by authorized dealer from the buyer shall be equal to 20%, see the wordings, 20% of the amount or aggregate of amounts in excess of 7 lakhs remitted by the buyer in financial year where amount is being remitted for the purpose other than education or medical treatment. If the same payment is made for other than education and medical treatment, so it's very much possible people go to foreign for their medical treatment, some operations, some specific procedures and all. Only for medical and education, which is considered necessity, rest all beyond 7 lakhs they have been charging 20% TCS. They want to cut down losing foreign currency from India. Provided also that authorized dealer, so who collects this? So let's assume I choose Cox and Kings or some Axis Bank or something through which I will transfer. So the bank will be responsible to collect this TCS. They will collect it from the person who is remitting. Provided also that authorized dealers shall collect a sum equal to 0.5% of the amount of aggregate amounts in excess of 7 lakhs remitted by the buyer in a financial year if amount is being remitted out of loan obtained from financial institutions as defined under 80E. What is 80E? Education loan, interest on education loan. They talk about education loan. So as per that section, if it is an education loan, if it is paid from loan amount and it is more than 7 lakhs, then the TCS will be 1/2. It's very confusing word in income tax. Everywhere they use 1/2%. 1/2 means only half. It's not 1.5. It's 1/2 is what the wordings they use in income tax. 1/2 means 0.5%. Only 0.5% will be charged if it is paid only through loan amount. Again, for the portion which the father or mother is transferring, normal rates apply. But for specifically for loan amount transfer from the bank directly, bank or financial institution, then the 0.5% will be applicable. Mostly taken care by the banks. But we have to go through all the provisions so that we are knowing when we are having clients of banks also. When we have to go to bank audit, we might have to verify these as well. Okay, of course, authorized dealer is defined in RBI who deal in foreign exchange or foreign securities as specified under so and so 10(1) of MI Act.
For pursuing education, it is if I take a loan and then pay, it is 0.5%.
Only for the loan portion.
Only for the loan
portion.
If it is not loan portion from my pocket, if I am paying, then other than there is no TCS. Is it excess?
No. 20% in general case.
Other than education and
sorry.
Other than that is for the purpose other than education or medical treatment. No.
Correct. Then only 20%. 20% in case of other than education and medical treatment.
Okay.
Education means will come. We're still there. We are still there. First we are seeing if it is paid through banking, 0.5%. Okay. Being the seller of overseas tour program. Okay, this point has not come. Anyways, we'll complete this and come back. Being a seller of overseas tour package, let's assume some XYZ company which are into tour package operators who are giving tour packages. And wording here is overseas tour. Overseas tour. So Indian tours are excluded. Only overseas tour program package. Who receives any amount from buyer, being a person who purchased such package. The certain conditions are as follows. The seller of overseas tour program package shall be liable to collect TCS at the rate of 5% from the buyer who is purchasing the package. So all your foreign trips they want to cover. So making sure people who are enjoying going to foreign and doing many expenses, they want to make sure they are complying with income tax rules. So let's assume the person is declaring 5 lakhs income and making 0 tax, or 7 lakhs income and making 0 tax, but he is going to US spending 20 lakhs package, don't know how, so they can issue notice. That's the reason. And if they don't have PAN or other, then it will definitely be 10%. They have given the option of other clearly here as well. Provided also the seller of overseas tour program package shall collect 20% if the aggregate amount is excess of 7 lakhs. Again, they are killing here. They don't want to lose foreign currency and they don't want people to go outside India. Let them be in India only and see India first because we have hundreds of places. We should be very clear. Sir, is it 10 rupees there applicable? Yes. 1,000 rupees applicable, 1 lakh applicable. But if it is crossing 7 lakhs, then 20% straight. Up to 7 lakhs, 5%. Beyond 7 lakhs, 20%. Sir, I have PAN card, Aadhaar card, everything, still 20%? Yes.
So if I go...
It's already penalized, yeah. Tell me,
If
sir.
I go abroad and I incur expenses for air travel, then that also will be...
See, that is what. The tour operators are very sharp nowadays. Now they call it up, they will, let's assume it's a customized trip. They can choose to take the tickets separately. They book tickets, they will only be a reimbursement agents. They'll only charge a commission, whatever commission, 400 rupees, 500 rupees from us, close. The ticket will be ignored from that limit. First step. Second step, then they'll book land package in US. Let's assume they are going to US. They'll book a land package in US. There it will be 5 lakhs, let's assume. they will collect TCS on that 5 lakhs. Example I am trying to say, I don't know the numbers. So they are trying to split the flight bill, but they cannot split when I will tell you. When it is group package, group tour they won't split. They directly.
Suppose it's a business travel, then what happens?
Business travel. Yes, you are going for whatever purpose. You are going for recreation, you are going for business. You are booking only flight ticket, no problem, sir.
No,
Booking of flight ticket services.
This is a travel agent whenever they travel agent is
Package.
for traveling, tourism traveling for that purpose. It is not like a
Sir, we have
travel.
definition coming up.
Okay.
I'll explain. Overseas tour program package means any tour package which offers visit to any country out of India and includes expenses for travel, hotel stay, boarding, lodging or any other expenditure for similar nature and relation hereto. So that is the game few tour operators are doing, where they are giving only reimbursement they are giving, as if we have booked through their portal. If this is true, if I book in Make My Trip should be collecting to 5% or whatever, 20%. Make My Trip never collects because they are only giving a route for booking. They are only collecting that commission for using the portal. They call it portal charges, 400 rupees, 500 rupees, 1000 rupees portal charges. That's all. So they are escaping the TCS portion for the flight ticket if it is in general cases, but if it is group tour, most of the tour operators are not taking any risk. They are collecting on the full package. If they are booking tickets separately, then they will avoid TCS on that. That is how tour operators are planning this.
7 lakhs is per person, is it?
Per person. So that is also a way. Let's assume we are going to US. There are 3 assessees, put 3 people traveling, put all the PAN numbers of all the 3 people, okay, no problem. Let's assume father, mother, child is going. Child is also more than 18, but he is not filing income tax. Why should you give his TCS, his PAN card? You will fall into trouble. Not suggestible, but actually they have, whoever is travel, their PAN card is only taken generally. But you can ask your tour operator to use the TCS PAN of the father for son or wife as well. That is not an option. But if you use clubbing in one PAN card, then your 7 lakhs crosses, then you are done.
This definition is under this section only.
Yes. 206C1G.
Tour package which offers visit.
It's mentioned clearly what is tour, overseas tour program package. Okay. However, provision shall not be applicable in following cases. If buyer is deducting tax under any other provision of the Act and he has deducted such amount. So why they have given this provision? It's a general rule where always TDS prevails over TCS. You can keep this as a general rule. TDS prevails over TCS. Why? Because TDS has expenditure involved. TCS has no disallowance of expenditure, and they will take TDS more seriously than TCS if both are clashing. In anywhere, in any condition, TDS prevails over TCS, and there can be clashing sections. Maybe if there could be clashing sections of TCS alone. As we go forward, other sections might come in with 10 do leaves, 206C1H overlap. Then when there is a specific section, you use the specific section. If it's then come to general section. We'll come to that also. Deducted source under any other provision of the Act and has been deducted in such amount. So TDS, if it is done, they need not come to TCS provisions. Central government is exempted, state government is exempted, embassy, high commission, legation, commission, trade representative of foreign state, local authority and any other person as central government might notify specifically, like United Nations people, they might give any kind of exemption through official gazette. So these people are specifically exempted from TCS. Next important section, 206C1H. So again, this was new in 2001. Now it is normal for everyone. So this section came into effect from 1st October 2021. Where on sale of goods, wording says goods. Where on sale of goods, the seller shall be liable to collect TCS at the rate of 0.1% on the consideration received from the buyer in previous year in excess of 50 lakhs. In case of no PAN or other, 1% will be applicable. Of course, 206cc1 means I will come to that section also, which says you 5%, whichever is higher, double something which is twice the rate, normal actual rate, or 5% whichever is higher, they will tell restricting to 20%. That section will not apply for this section. Means they are limiting the TCS amount to 1%. It will not go to 20%, it will not go to 5%, it will not go to any other rate. They are limiting this section to 1%. Important wordings required. Consideration received. The word received is important here. Why? Because TCS is not supposed to be collected on sale bill. It is to be collected on receipt of amount. This is important. Where in practical scenarios they are not able to follow strictly, but actually TCS is clearly to be collected on receipt basis, not on accrual basis, only when the payment is received. Okay, certain conditions under section 1H are as follows. Only those sellers whose sales, gross receipts or turnover from the business carried on by it exceeds 10 crores. So 10 crores in the previous year, during the financial year, immediately preceding the financial year. So for finding applicability for 2024-25, we have to see whether the client has, the SC has crossed 23-24 turnover has crossed 10 crores. Okay. However, the provisions shall not be applicable in following cases. The seller is liable to collect TCS under provisions of 206C. What is 206C? All these sections we read till now is 206C. All the provisions of TCS we have read till now are all 206C. C1, 1B, 1H, 1F. Okay, 1H they are talking about. So if let's assume there is 10 leaves where 5% is applicable, this is not applicable, this provision of
something like alcohol.
Alcohol is already applicable there. Then again it need not be reapplied here. Scrap, whatever. Let's assume it is crossing 50 lakhs. Then 206C, 1H has to trigger, but it should not trigger because there is more specific provision otherwise. As there is a more specific provision, general provision should be ignored. And when it comes to TDS, if it is already done under TDS, TCS should be ignored. So basically TCS is last position in case of collecting the tax. In that also 206C, 1H is the last of the last. Okay. Or the buyer is liable to deduct tax under any other provisions of the Act and has deducted such amount. So where it comes 194Q, they have to deduct to 0.1% from the purchase amount before paying it to the seller on the purchase bill. If it is already being deducted under 0.1% under 194Q, then 206C1H will be exempted. Got it? So 194Q is again confusing. That is based on accrual basis. This is based on receipt basis. So litigation always stays. But how to take this, sir? How to make sure, sir, I am assuming that client has more than 10 crores turnover, so I will just not do TCS, sir. We cannot take that decision. Make sure the assessee takes a written letter or email stating that they are going to make TDS and the assessee did not do TCS. Because we have no control on what TDS he is paying, what he is deducting, whether he is filing, whether it is more than 10 crores, we will never know all this. Until we can take a declaration from their end, every single financial year start, then only you should avoid TCS. Or it's mandatory for the assessee to collect TCS. Sir, their turnover is petrol bunks at 50 crores, so what? That person is not making TDS for Indian Oil. So Indian Oil only collects TCS from the petrol bunk. So what happens then? The 30% disallowed for petrol bunk. There is internal circular between the department stating that even if TCS is done but TDS not done, please do not disallow the expense. That is internal circular of the department, not Act. The officer might not come out and say, yes, I will tax it. But as per law, it's not allowed. He has to make 194Q, 0.1%. Purchase is first, sales is next. So TDS comes first, TCS comes next. You should always suggest the assessee to make TDS under 194Q until unless you are the seller where you have not got the declaration, and making sure the 10 crores limit. Because every year declaration, why is it important? Because previous year he would have crossed 10 crores, running year he misses 10 crores, next year he doesn't want to do TDS, you also don't do TCS, then you are caught because you don't have declaration. So every financial year start of in the first week of April, it's a general exercise to take declarations from all the customers, whether they are going to make TDS or you are going to make TCS. Take that clarification. If they are not giving clarification or reply, every bill TCS should be charged right from 1st April. Okay, of course they will get a refill of 50 lakhs, hoping so it doesn't cross before the declaration comes. We can wait. And provisions will not apply to same people, central government, state government, high commission, legation, commission, something. Those all people, all government people, all foreign affiliates, everyone are exempted because they don't know to tax themselves. Okay. Understood? Any doubt in 206C1H? We'll come to a detailed example to understand how it works. 206C1H. What is received, when to collect TCS. These are all detailed example. We have a real-time example where we can see how is the TCS being calculated. Okay. 206CA. So these are other 3 provisions under TCS which we have to just see general provisions. We'll just read it out. 206CA. This section speaks about the person who is responsible for collecting tax to apply for tax collection at source number, and where number has been allotted, a number shall be allotted to the specified documents whichever is necessary. Wherever it is necessary. Simple. They are saying you apply for TAN number. Instead of collecting tax deduction account number, tax collection account number they are talking. Irrespective of that, this is all the TAN number which we are going to apply. So they are saying you have to apply a TAN number if it is applicable. 206CB. As per section as per this section, collection at source or correction statements shall be processed in the manner specified under this section. What is it specifying? Similar to 143(1). Automatic processing by the system, intimation under section 143(1). Same provisions apply here also under 206CB. They have just copy pasted the same provision and called it separate section for TCS alone. 206CC. This is important. With respect to TCS, in case if buyer fails to furnish the PAN, then the tax shall be deducted at the following rates unless otherwise specified. So what are the rates? Twice the rate specified under the relevant provision at the rate of 5%, whichever is higher. So 5% or 2 times the rate, whichever is higher. Let's assume some example of tendo leaves. The rate is 5%, twice will be 10%, or 5%, whichever is higher, they will go by 5%. We'll take example of this one, 206C1H. 0.1 into 2 will be 0.2% or 5%, whichever higher, it will not be applicable. Specifically mentioned, only 1% is the ceiling. It's mentioned here. 206CC is not applicable for this provision of 206C1H. Okay, so this stays at 1%, but in general twice the rate of 5%, whichever is higher. Important definitions. Few definitions which are important. Who is a buyer? Subsection 1 means a person who obtains in any sale by way of auction, tender or any other mode goods of the nature specified in the table in subsection 1, or right to the survey receive any such goods but does not include. So this is important. Buyer we all know, but who is not included in buyer is important. Public sector companies, so they are exempted, that government company themselves. Central government, of course they will exempt themselves. State government, embassy, high commission, same people, all people will be exempted. Next. A buyer in retail sale of such goods purchased by him for personal consumption is exempted. If you purchase some goods for personal consumption, TCS can be exempted. He might not come at the definition of buyer itself. So let's assume somebody goes to alcohol shop and says, give me 1 bottle. Okay, tell me your PAN number, I have to put 1% TCS, they will not ask. able to understand. So he's taking the alcohol for personal consumption. The same person, the alcohol trader will take it from a brewery, let's assume, or the factory, that transaction will have TCS. But this person, this retail outlet selling it to the person, TCS is not applicable. So imagine if that is applicable. Already the liquor shops are already crowded. Let's assume he's saying give PAN number, whether it's active, it's not active, then what to do? These many problems will be there. One person will be sold, the rest all will go. They'll throw stones on the shop.
They will not go, they will go inside.
They'll go inside, take it and go. That is what, they'll throw stones and go.
So
after taking. Imagine, give me PAN number, show me your Aadhaar, how much you are consumed, how much, what is the limit as per government, how much you are drinking. If they ask all this, then gone. Okay.
Nothing.
Person who is having all the documents will work and correct it selling black.
Perfectly. He will take 10 products and then go. 1% TCS, oh, they only that adding to the cost. They get it refund from department again. Department will be wondering what is he doing with 1,000 bottles. I don't know. Okay, subsection 1F means a person who obtains in any sale goods nature specified in the subsection but does not include. For 1F, what is 1F? Let's come back. Remember what is 1F? Okay, we missed it. Motor vehicle, yes. Motor vehicle. For that, the definition is slightly different. Okay, next. Again, central government, state government, they will never pay tax. They will not come to tax. They don't want TCS, TDS. They will deduct tax, but they will not pay to government. Those are all free. Legations, commission, consulate, trade representation of foreign authorities.
What is legation?
Legation. See, it is a special status given to a specific person. Very difficult. I would suggest you to Google it, read it in Wikipedia. Still, you will not understand. Ignore it. That is what I will suggest. Commission. We don't know what is this commission. Legation. Legation, you will get a definition, but you will not understand it. But that is something decided by the government. Who is legation? Okay. You will get confused if you start learning. But if the person claims that I am legation exempt from TCS, okay, give me some document that's showing that you are legation. Okay. That's all you can ask, maximum. Or ನಾನು ಗೊತ್ತಿಲ್ಲಪ್ಪ TCS ಮಾಡ್ತೀನಿ ಹೋಗು. That's all. A local authority again part of government. Public sector company which is engaged in business of carrying passengers. Okay. So let's assume KSRTC buying a vehicle, buying a bus, so they are exempted. So they are making sure they are safe there also. This is only for 1F, buyer definition or for subsection 1F only. So they are making, rest all are all similar, local authority is also added smallly, and public sector company which is into carrying passengers. Not into trading of vehicles again, it's only into carrying of passengers which can be BMTC, KSRTC, like that. Seller. Who is a seller? Subsection 1 and 1F means for both the subsections.
44 AB person, sir.
Sorry? No, we'll come back. We'll read that. Yeah, of course, 44 AB persons. That is what I'm just reading it for you. Means the central government, state government, local authority, corporation. So now you see, when they are deducting or when they are collecting, they are included. But when they are getting deducted, they are getting collected, they are not interested to give tax. So they will deduct, but don't know whose PAN number they will mention when filing the TDS. They might not even file TCS returns. Central government, state government, local authority, corporation, authority established under central, state, provincial act, or any company or firm, cooperative society, and also includes individual. They could have easily told any SSC. Simply they have given all the words. Hindu undivided assembly. We don't know who is not included. So should I assume what is this? AOP is not included, BOI is not included. For your information, all are included. They might have missed the wordings. Don't mind. Whose total sales, gross receipts, turnover for the business or profession carried on by him exceed 1 crore in case of business, 50 lakhs in case of profession during the financial year immediately preceding the financial year in which goods of nature specified in the table 1 are sold.
AOP BOI is not there, no, actually.
It's not there. No, it's applicable. They forgot to mention. It's applicable even for partnership forms.
Partnership form it is applicable. But
AOP, BOI, everything is everyone is similar. Let's assume if somebody central government is been applicable, state government is applicable, local authority is applicable. Don't mind. That is what interpretation. They could have easily used the word assessee. Instead, they have put this.
But actually, it is not there. No, that word is not there. No.
That word is not there. The provision is not showing. But don't take any risk. I'm just telling you.
First of all, AOP, BOI is
we don't know. No one does it. I understand. So that is why I only specifically told AOP, BOI. Don't miss that also. They forgot to use the word assessee. They wanted to make it full coverage.
Forgetting in the law how it will work.
I'm just trying to tell. They will say deemed understood. Central government is only doing, state government is doing, local authority is doing. We are exempted from collecting on getting collected. We are still collecting. Why are you asking BOP, BOI partnership firm? What are you talking?
I don't think so.
No, I understand your interpretation. This is called as lenient interpretation. You take your view, it's left to your client. I would not suggest. I would never suggest. Where generally people, this is called government is only exempted everywhere. Now they are only included. Imagine AOP. I am AOP. I am not included. Like how sir told, HUF I will create an HUF, simply buy one property, sell it. I mean, the ancestral property I will sell it off, divide it, close it. Who knows what will happen? He can't do it. It's all into litigation. Is it required? Might not be mostly. Until unless it is such a big amount and that the officer has caught and this person has not done TCS, then only it will matter, then it will go to litigation. I would not suggest clearly. They could have easily used the word any assessee, they didn't use it. So I have just given you the braille provision so that you get all your interpretations. Okay. Rule 31A, Papa. Rules no cover madbitra. Sorry. How to file quarterly statement? We have to file quarterly statement under 27 EQ. EQ is nothing but another form, like how you file TDS returns 24Q, 26Q, 27Q. Here it is 27 EQ. Generally, TDS is filed the month end, the subsequent month end of the quarter. Example, June they were filing at 31st July. September they will file at 31st October. But here it's not like that. 15 days earlier, 15th of the succeeding month of the quarter. 30th June quarter, April to June, 15 July is the filing date. July, August, September, 15th October. October, November, December, 15th January. Jan, Feb, March. Now this is a comedy part. I mean not comedy part, it's a relaxation given, but not completely given. For TDS it is 31st May instead of 30th April. For TCS it is 15th May instead of 31st. Got it? So they have given a 15 days reduction in deadline in comparison to TDS. For people who are following TDS and TCS filings, make sure you keep this in mind or else they will be subject to that penalty of 200 rupees per day, everything. So special provision for collection of tax at source for non-filers. Non-filers, what they are not filling, they are only not filling their income tax returns. Non-filers of income tax returns. So this is also been amended, we will see the wordings. As per Finance Act 2021 has inserted two new sections, namely 206AB for TDS, 206CCA for income tax, with effect from 1st July 2021. It is anyways passed. I don't want to talk about that intermediary provisions. Both the sections are inserted to encourage regular income tax filing. Further, both the sections impose higher deduction of TDS and or higher collection of TCS in case of specified person. Who is this specified person? We will see. Who has not filed the income tax. So a person has not filed the income tax, he will have to pay more TDS, TCS. Simple. So TDS means 206AB, TCS means 206CCA, where tax is required to be collected in accordance to the provisions of 6BB. Okay, don't worry about the chapter number, it is general number of TCS. That is collection at source, and where any such sum is received from a specified person. Who is this specified person? Let's see later. Tax shall be collected at higher of the following two rates. Higher, twice the rate specified under the provisions, or rate at 5%, provided that the rate of collection of TCS under the section shall not exceed 20%. So it should be twice the rate or 5%, but it should not exceed 20%. This was not mentioned previously, they mentioned now. Okay. Now tell me, if person does not have PAN number, he has not given PAN number, he doesn't have PAN number, then what happens?
20%.
Why 20%?
Shall not exceed 20. Oh.
No PAN number means remember twice the rate, 5% TCS. Remember twice the rate, that will apply. That fellow doesn't have PAN number, where will we file income tax return? Forget it. So don't imagine there you make twice, here again you make twice, we don't know what will happen for his life. So it's not twice the twice, it is a PAN. Without PAN that provision, with PAN but not filing this provision, almost not having, like not having PAN, same provision. Okay, who is a specified person? Is like a specimen only. Specified person for this purpose of section shall mean a person who has not furnished the return of income for the assessment year relevant to the previous year immediately preceding the financial year, in which tax is required to be collected, for which the time limit for furnishing the return of income under 139(1) has expired. An aggregate of such tax collected at source and tax deducted at source in his case is rupees 50,000 or more in the said previous year. Now this is an amended provision. Previously, when the provision was introduced, it was saying in immediately two preceding financial years immediate to the preceding financial year. So 2 years were considered. Any one of the 1 year, if he has complied income tax return, he was safe. Now it's not like that. They have amended to make it only 1 year. So every year that fellow should have to file an income tax return. 1 year I will file, 1 year I will not file. 1 year I will file. They don't want to give all that leeway. They want everyone to file every year. Don't know how to verify that 50,000 limit. But there is a software, I suppose, where it can also find whether the TDS limit has exceeded 50,000 or not. At least there is a software in Traces which will allow you to find whether he has filed income tax or not. That is one way. But again, important thing is whether 139(1) time is over. Sir, last year he has not filed, sir. No one has filed. The time is there, 31st July. Till 31st July, you can assume that he is a regular filer. If he has filed 2023 March, means 23-24 assessment year. 24-25 assessment year, you have to see after July 31st. Or extended date if any. Or if it is tax audit, then
whenever I am in case if a buyer from whom I have to collect a TCS, if it is exceeding 50,000, I have to set.
No. Making sure we should see his income tax return. We should open his 26 years, see how much TDS he is getting, how much TCS is getting, total it to 50,000 or more, then decide whether you have to do more or not. Specified person. This is the problem. How will we see his 26 years?
In his case,
he should have crossed 50,000 also. No, he has not filed his income tax return, but TDS plus TCS plus. It's not TCS alone. TDS plus TCS is more than 50,000 in previous year. And it's only 1 year you have to see. So let's assume he has filed, he is just missed filing the due date. He has done it in August, but this first week of August he wants to do it in September, 139(4) belated return. Suddenly Papa he has to face all these TDS TCS provisions. Don't know how will the seller find it.
It is not about the TDS and TCS between me and that.
No, that is what. It is about his total TDS TCS.
In his case is 50,000 rupees.
One second. Deducted at source and collected at source in his case is 50,000 or more. See, if you see declaration is given, they are saying whether total TDS and TCS of your previous income tax return is 50,000 or is more than 50,000, yes or no. I don't know if you have seen the declarations. The declarations given by the companies. So they are asking them only to declare whether your TDS TCS total is crossing 50,000. The best way is see whether he has filed income tax return or not. Half of the problem is done. Then you see whether 50,000 or not. Next half is solved. Income tax return is the best way to verify. So make sure 31st July you have to be ready to shoot in emails, call them, give income tax return, give income tax return, or else I'll make more TCS. Practically very difficult, but that is how provision is. Previously it was 2 years, they made it 1 year. It's made life even more complicated.
TCS at the time of the transaction only to be done.
No, I didn't get your point.
TCS. No, 206, all that at the time of the transaction.
Yes, time of the transaction only. That is what. Before that, you have to take his declaration. Let's assume scrap dealer come give your income tax return. Sir, ಏನು ಸರ್ ಬೇಕು ನಿಮಗೆ ಸರ್ ಪ್ಯಾನ್ ನಂಬರ್ ನಾನು ಕೊಡಲ್ಲ, ಏನೋ ಮಾಡ್ತೀರಾ? ನಾವೇನೋ ಮಾಡಲ್ಲ, ಜಾಸ್ತಿ ಇಟ್ಕೊಂತೀವಿ ಅಷ್ಟೇ ದುಡ್ಡು. ಜಾಸ್ತಿ ಕೊಟ್ಬಿಟ್ಟು ಹೋಗಪ್ಪ. That is what happens. Can we continue?
Yes.
We are going towards the end. We have only one practical problem to understand 206C1H. Actually, not as per industrial standards, but actually as per Act. So let's assume this is an example where 2019, 20, 20, 21, 21, 22, 23, 22, 23, all 4 years transactions have been mentioned. So there is a sale. Sorry? Shall I continue? Okay. So let's assume in 2019-20 the total sales is to 1%. Let's assume his total sale of the company is crossing 10 crores, preceding 10 crores or 100 crores, whatever you want. He's crossed 10 crores. But this is related to 1% transaction with one client or Mr. X Limited. Sale 60 lakhs is being sold. Outstanding opening balance 0. Total received during the year 20 lakhs. Outstanding balance as on the year end 40 lakhs. Tax collected at source 0. Why? Sir, 60 lakhs sale, we have to collect TCS. No, because only 20 lakhs has been received. And over and above that, this year it's not applicable only TCS. TCS provision only was not there. Okay, next. Opening balance 40 lakhs. Sales during the year 70 lakhs. So total received during the year is 1 crore. Out of which 55 lakhs was received before 30th September 2020. And closing balance is 1 lakh. So 10 lakhs. TCS to be collected, how we should calculate? Calculation of 50 lakhs happens throughout the year. So 50 lakhs is crossed before September only, means 55 lakhs. So we should not worry about the sale amount, first point. Sales is not a matter at all. Only the receipt is what the decision we have to take. And whether we first 50 lakhs we have to give exemption. So 55 lakhs he received before 30th September. We should not tax that 5 lakhs because it was 30th September. First year October 2020 only this provision came into place. So from 1st October he has been collected 45 lakhs. On that 0.1% means 4,500. On 45 lakhs only we are calculating. Got it? No, should I repeat, sir? Oh, sorry. Okay. Then we go to next year, opening balance, so sale for the year 50 lakhs, sale during the year, I guess it's 10 lakhs, okay, it's 10 lakhs, total receipts for the year 45 lakhs, outstanding, closing 20 lakhs. Now this year there is no TCS at all. Why? Because every year we get the refill of 50 lakhs exemption. Every year we get a refill of 50 lakhs. So this year we lost 50 lakhs. So this year why should we not deduct TCS? Because every year we get a refill of 50 lakhs, they are exempted. Next.
Aggregate of the sales, no aggregate.
Not the same. It is the receipt alone.
Aggregate.
Aggregate of receipts, correct. For that financial year. So every year you get 50 lakhs. First 50 lakhs you exempted. Then next thereon you can collect.
So for example, I made a sale of 1 crore.
Okay.
Then the person made only 10 lakhs during the year.
Correct, no TCS. But in industry norms, on full 1 crore, 0.1%. That is how it is happening. That should not happen. Actually, provision does not allow you to do that.
Only payment we should see.
Only the receipt of amount is to be considered.
But
Provision clearly says received.
accounting will be problem.
Accounting will be problem. That is what income tax wants, no? That is what income tax wants. There should be problem. Then only our profession is staying. They also want that only. More problem, more enjoyment.
It's becoming very headache, sir.
Very difficult.
600 customers.
How is it possible? If it is a very big B2B brand, they are gone to toss.
That's what.
Imagine Hindustan Unilever, Indian Oil. We don't know. In the bill only they are collecting left and right, whether payment received or not.
If I go on a sales basis, then it is against this section.
Correct. Against the section. Clearly it's given.
If I go on payment basis, accounting is the problem.
Correct. Accounting is extremely a big problem.
Yes.
So only on receipt you have to account the TCS. Very difficult. Practically very difficult. Clients will never understand. For understanding whether TCS to be collected, they will not understand that. On top of that, receipt on like ಮಾಡಿ 50 ಲಕ್ಷ ಬಿಡಿ ಅದರ ಡಿಫರೆನ್ಸ್ ಮೇಲೆ ಮಾಡಿ ಹೋಯ್ತು.
To collect from them extra, I have to give certain document to them that TCS you pay like that. I have to ask them.
Exactly. So they will not understand what TCS is. They will ask, what are you telling? Where is the problem? Give it in writing. Give me email. After
That,
giving
okay, one time we will give. That is not an issue. But for accounting them, no. They will tell, okay, you give me certain document, I will account like that. It is very difficult. Practically, it is becoming
very difficult. But it's mandatory. No excuse. No excuse.
Even though we don't like it, we have to follow.
Whether you like it or not, please continue. Next, last year, sales is 55 lakhs, so crossing 50 lakhs, but doesn't matter. Outstanding opening is 20 lakhs. Received during the year 65 lakhs, 10 lakhs is closing. So 65 lakhs minus 50 lakhs exempted, 15 lakhs. 1 to 0.1%, 1,500. Okay, here I have given explanation. 206 E1H is applicable from 1st October 2020. No tax to be collected in 1920 for this one. Tax will be collected only in respect of sale consideration received on or after 1st October 2020. For 45 lakhs into, that's the difference amount. 45 lakhs into 0.1%, 4,500. No tax will be collected on as the amount of sale consideration received during the year is less than 50 lakhs. Though turnover might be more than, let's assume there was a sale of, here it's given 55 lakhs, still TCS is not there because he got only 45 lakhs. The tax shall be collected on receipt, the last one, the tax shall be collected on receipt in excess of 50 lakhs. So out of 65 lakhs received, only 15 lakhs will be applicable for TCS as an assessable value into 0.1% to 1,500. So let's take some doubts before I say thank you. If any simple topics, at least TCS had some content, advanced tax had nothing. Just brush up, okay, 10,000, senior citizen without business or income. That's all, over. That's all is advanced tax. We all know 15, 45, 75, 100%. These all we already know.
No, I don't know that 4480, 4480.
4480, it's not applicable. Yeah, okay, it's not applicable. So you know, now you know. So it is only one installment, only 15th March. Previously it was not applicable at all.
Yes.
So there was exemption
When
of.
they made amendment this year or when?
No, this was done 2-3 years back. This amendment happened. They make sure they collect 234B properly. 234C 1% only. No, they're okay to collect it, not to leave it. They're okay to collect it. But 234B, these people file after 12 months. They file it into that ITRU after 24 months, 36 months, whatever they want, they'll file. So they want to collect funds. They are creating opportunity. They don't want to wait. For example, 31st July katre agala nange. Let him pay before 15th March. No, I'm not asking full advance tax. You feel full before year end. That's all. Their view is. So we have slight brush up of advance tax, good understanding of TCS. I have tried and actually covered complete TCS provisions, not skipped even one section, including that boring sections. So because we had only less content. Anything else? Anyone has doubts? Surely I'm ready to clarify.
Scrap related, if my company even 100 rupees also I have to collect.
No option. So make sure your turnover is less than 1 crore.
Because of his 1%, how I can get it?
The scrap is always a hassle. Simply they will throw one paper scrap, that fellow will give 100 rupees, for that I have to ask PAN number.
To manufacturing related only scrap.
Mainly manufacturing.
Manufacturing.
Let's assume there's a general service sector, which is a professional who is crossing, your chartered accountant crossing 50 lakhs, you are selling waste paper, he says 200 rupees, due PAN number, 20 paisa tagobeku. 2 rupees ಆಗ್ತೀನಿ to go. Who is going to listen giving PAN number? ಬೇರೆ ತಗೊಳ್ಳಪ್ಪ.
If my plant and machinery I am selling as a scrap, it will not be applicable, no, definitely.
Plant and machinery, if you are mentioning scrap, it's applicable.
No.
You are scrapping plant and machinery. If you don't mention the word scrap, sell it as plant and machinery. If you are mentioning scrap,
it's like a waste I am selling, no?
You sell it in case as a scrap. Okay. If you are selling it as plant and machinery scrap word can will apply. Scrap can be a full machine.
No? It should be that scrap should be derived from the manufacturing, no?
Need not be. The word scrap is enough for the officer to take the litigation.
Okay.
Don't take the risk at all. Scrap word coming, put it. How is the machinery sold? First point, whether it is being considered as laser cutting machinery or into 2 tons steel. This is what is the condition. You are able to understand 2 tons steel scrap. Able to understand? 2 tons steel means it is a machine only, but 2 tons steel you are selling it as kgs. It's a scrap only. End of the day, you will say plant machinery sold in kgs. You can't avoid. No, it's clearly scrap. You'll understand. Even the word scrap also, you let's assume you sold the machinery. Scrap sale of machinery, or you are selling a sale of machinery 1.5 lakh. Then no problem. Scrap sale of machinery, laser cutting machine 1.5 lakh. Okay, TCS applicable. Don't call it scrap. If you are selling it a sizable amount with the name of the product having its own use, maybe he will restructure it and use it. Maybe it will. But many times this kind of transactions happens in this cigarettes related manufacturing industry. They mainly buy machinery as scrap only. Then they rework it and then reuse that. In the low quality BDs and all are made through that scrap machinery only, literal scrap. Anything else? Okay, so I guess I end the session with this short topic. Thank you very much.
Thank you, Nischal, for taking your time out and then coming here. And I request Shripad, the CICASA chairman, to hand over the memento to the speaker. Thank you all. And tomorrow it is going to be TDS provision, so we'll see you tomorrow at 10 o'clock.
Correctly, it's TDS.